Well, good morning, everyone. And after such a long time, it's just amazing to see so many of my friends here today. And we're all here for the Global Trade Facilitation Summit 2022, connecting the trade world and shaping the future. And today is a really important day because today we're down to the nuts and bolts of trade finance. So the Trade Law and Compliance Conference. And without solid law and without compliance, well, the business just doesn't flow. But we got to work hard over the next few days to make trade easier, smoother, and we need to actually find solutions to problems that have been going on for a long time. So we're going to get underway with our Trade Law and Compliance Conference. And I'm going to ask Ahmed Loutam, our chairman of the ICCUE Banking Commission and dear friend, to come up and share some words of welcome. Ahmed, please.
Thank you very much. Vince, good morning, everyone. Would like to welcome you to Dubai, who has been visiting Dubai for the first time, or people who are online who would like to come and visit Dubai. So we welcome you all. Good morning, everyone. Welcome to the ICC and IILBLB Trade Law and Compliance Conference in 2022, hosted here in the wonderful scenic auditorium of Dubai Chamber. The ICC has been working with the Institute for more than 10 years, and it's wonderful to see so many people participating here from more than 40 countries. And also, we would like to thank the people who are online for joining us. This technical and legal conference is an essential component of the Global Trade Facilitation Summit that is happening in Dubai and taking this action this week. Today, we have a lot to talk about, a lot of work ahead, and I'm sure it's been an enjoyable visit to Dubai, who's coming, and it will be also a very informative day for everyone. The program I have looked at, and it's practical and focused, covering the challenges for paper bills of landing in the modern digital world, the recent legal cases involving commodity trade, the Pandemic Court of Injunctions, the UAE Guarantee Facilitation Project. The project has been driven forward by the ICC Banking Commission in the UAE, and we are very proud of this project and whoever participated in it. The technology to fight financial crime, the de-risking of banks and customers, and the sanctions update, as well as trends in default of trade finance ratings during the challenging times. Indeed, this is a very full agenda, that will give you a lot of information, and the speakers will be giving you a very good insight into these subjects in terms of compliance, legal, and trade experts. I wish you all the best for engaging in this event, and so good to see so many people in here in person, and hopefully very soon without any masks. I'm sure the people online don't need masks, they're more comfortable than us, but hopefully everybody will be having no mask very soon. Thank you for coming here today, and I'm leaving you in the hands of the directors of ICC, our famous and infamous Vince O'Brien. Thank you very much.
Well, thank you, Ahmed, for those wonderful welcome remarks to such a wonderful audience. Well, we're going to move ahead, and we're going to start off with, let's say, the trade and compliance update. So, my colleagues Alex, Derek, and Christopher from the IIBLP, if you can take a seat and get comfortable, and we will get underway. I'm going to stand because I stand a lot, you know, at these conferences because I'm so short, people don't see me. But if I stand, you know, you just can't miss me. So to kick off with a general overview of what's happening in terms of trade law and compliance, I'm joined by three of colleagues important. Chris here is from the Institute of International Banking Law and Practice, our partner, as we've heard from a long time, from our chairman. Alex is from London Institute of Banking and Finance, who run a huge amount of training programs and supports for international trade and finance. And Derek, Coastline Solutions, who has also been a partner of IIBLP for a long, long time. So you're all very, very, very welcome. But Chris, maybe I'll kick off with you with the Institute, and maybe you can brief us on up-to-date developments at the Institute. But maybe just first, a few words about the Institute, because maybe not everyone is aware or familiar with IIBLP, if you don't mind.
Sure. Yep. No, thank you very much, Vin. It's delighted to be back here. It was exactly 2 years ago that travel plans had been made. I was supposed to be here, and that was March 2020, and then the world shut down, and it's almost as if that 2 years has been a vacuum. Now we're picking up here March 2022. Delighted to be back here in Dubai. Vin referenced the Institute. You know, the Institute is the shortened form of our name. It's Institute of International Banking Law and Practice. And we were formed in 1987 in the States. That was a very pivotal time for the industry because at the time, the Uniform Commercial Code, U.S. codified law, was changing. Article 5 governs letters of credit, and there was, at that point, a need to revise the Article 5, and what the Institute, its objectives were, is to put the bankers and the lawyers together, because the bankers worked in the industry. They knew their craft day to day, what needed to be done, whereas the lawyers could deliver the precision to writing the law the way it needed to be written. So the lawyers could not get that done without the bankers. The bankers could not get that done without the lawyers. And that alliance led to UCC revised Article 5. That was in the early to mid-90s. About that time as well, the Institute was instrumental in the UNLC Convention, the United Nations Convention on standbys and demand guarantees. And then in the last part of the 90s was when the ISP 98 was drafted and approved by ICC. It's ICC Publication 590, governing standby letter of credit practice. And from there, the Institute played a role in helping with the ISBP, as well as the revision of UCP from 500 to 600.
Yeah. Great, Chris. That's really wonderful. So the IIBLP is playing a continuing role in facilitating this engagement between the lawyers and the practitioners. It's really, really important. So what we're going to do is the CEO of the Institute has a very short welcome message that we're going to actually play for you right now, which will help set the scene as well for the rest of the day and give you a feeling for some of the parameters that we will be dealing with as we work through the day today. So please, if we can play the video, that would be wonderful. And of course, I see our sponsors are in the room as well, China Systems, IHS Markit, TradeSun, and of course, Documentary Credit World of the I.
Good morning, everyone, and welcome to the annual Trade Law and Compliance Conference. Welcome to Dubai. It is very exciting to have you all here. I'm very sorry that I can't be here in person, but our spirit is here, and the spirit of these events is here. We have interactive events. We want you to raise your hand, to ask questions, to speak. We are here because of Jim Byrne, my father, and in his spirit is interaction. We want you to disagree. We want you to agree. We want you to participate. We don't want you to sit back and just watch. I want you to walk out of this event and go, hey, I learned something that I can apply today in my practice. And you will. That's the hallmark of these events. And again, I'm very sorry that I can't be there, but Vin is here. Vin is right over there, and Vin will take care of you. Vin knows how to run an event like nobody can. And we're so excited to partner with the Dubai Chamber, with ICC UAE, and Vin will go through the rest of the sponsors and partners if he hasn't already. We look forward to a wonderful, incredible, exciting event, and you should feel free to reach out to us with any questions afterwards. Thank you so much for joining. Vin, I'm going to hand it back to you.
Great, Michael. Thank you very, very much. So that's what it's all about, a dialogue, discussion, disagreement, and having fun while we do it, because this is how we make progress. I'm going to move on to Alex in a moment, but what Michael said, his father was really the champion of dialogue and discussion between bankers and lawyers, and we a lot of us here have had a long friendship with him. But just to tell you a little story about Jim and me. I knew him for more than a quarter of a century, and when I was a young guy in trade finance a long time ago, I knew Jim for a year or two, and I kind of thought I was a hotshot in trade finance. Everything, yeah, I know everything, you know. So we were at an event in Singapore, having known him for 2 years, and we went out for a meal and we're having a chat, and I just couldn't resist asking the guru. I said, Jim, if you don't mind me asking, what do you think of my expertise in trade finance? You know, and he said, well, Vin, actually, you're better than most. And I said, I kind of knew that already, you know. I said, but could you be a bit more specific? He said, well, I guess that you're correct about 10% of the time. I said, what? He said, you get it right about 10% of the time, okay? And I said, okay, I got to work hard. He said, you do. And then maybe 3 years ago, I met Jim, and as you know, Jim is no longer with us, and he was just getting a little bit feeble at the time. And I just couldn't resist asking him, because, you know, he may be departing sometime, how I had improved, you know. So I said, Jim, you remember when I asked you the question, how was I, you know, and, you know. He said, oh, yeah, I remember. I said, have I improved? He said, oh, Vin, you have improved immensely, immensely. And I said, oh, I kind of knew that, you know. He said, yeah, you have improved immensely. Now you're correct 50% of the time. So if you ask me a question today, it's kind of 50-50 that you're going to get the right answer. So bear that in mind, and it's also a learning lesson, because with practitioners, lawyers, etc., discussing technical things, on one hand you get a view, on the other hand you get the other view, and sometimes that's how we need to learn and move forward. And speaking of learning, let's move forward. And Alex, come to you.
You did that well.
Yeah. Getting a catch up on LIBF and your activities, short and, you know, up to date.
Well,
thank you.
I got the short. Don't worry.
Go ahead.
No, but thanks so much for inviting me here, and thanks for the team from ICC UAE. It is like the Oscars. We've got people coming in who can't be here. We've even got seat fillers, so I'm very impressed. Excellent, and it's great to see so many people. Not with a square around them, and there's a few people that I'm looking forward to meeting. This whole bringing people together is excellent. Same thing as Chris, 2 years ago, everything has changed, so it's great to be out there, because a lot of what we do in these kind of environments is in the room, but also about discussing things. And when we are planning our conferences, say a session lasts for about half an hour, before we do those sessions, we've probably spoken about 2 hours, and there's a lot of that debate, sometimes quite heated debate in a good way, and different practitioners, different discussions, and that's what I'm looking forward to here today. A lot of people we're meeting. I'm also, as you know, working with one of the sponsors, TradeSun, so we'll be hearing from them later, but it's great to see my colleagues from the States, and Manoj, who's going to be speaking later, because I've never met him in person, so once more, and then meeting everybody here. So in terms of what we're doing, I was here yesterday working with our partners at LIBF MENA in Abu Dhabi, and I did a short presentation on compliance as a sort of warm-up.
Very good.
Coming to here today. And also made sure the suit fitted, because first time I've worn a suit for a couple. And in terms of stories, I was in LIBF office last week, and I was going to check my suit, which had been hanging there for 2 years, and it was riddled with moths. So fortunately, this one was at home and is intact and ready for today.
Looking good.
So I've got it dry clean, so I've not brought any moths into the UAE,
Okay.
because that could be an issue in itself, really, couldn't it?
We would have detected them anyway before they got it.
Yeah, and that's the thing, the technology that in this room today, seeing it yesterday in Abu Dhabi Global Markets, our partner with LIBF, so it's all very exciting. So I'm looking forward to everything, and back to you.
Wonderful.
You did say shorts. I mean, I could go on forever, you know me.
I know, but that was really good, Alex, and it's great to have you here, and it's great to have your support. So, Derek, moving on to you, you've been involved significantly with IIBLP and other stakeholders in developing training in trade law and compliance, and also in the traditional rules going back for many, many years. So I know you've had a few interesting initiatives recently regarding an association, regarding the expansion of training programs, etc. So I'm going to ask you to come over here and maybe give us a presentation, 15 minutes or something like that, just to get us up to speed.
Thank you, Vin. Good morning, everybody. Good to be standing up, properly dressed in a suit and everything. First time in 2 years. We should have been here 2 years ago, but good to be back in the room now. I'll just get my clicker. I'm just going to give a quick update from Cosine Solutions. We've been a partner with the IIBLP and with the LIBF and ICC UAE in these conferences for probably 15 more years now at this stage.
Yep.
So it's very good to be back. I'm going to give just a quick update on some of the Cosine Solutions initiatives. I would usually say in this situation in the last year, but actually it's in the last 2 years or more. So let me click or not click. I hear binging. That's all I hear. Anyway, while they look at that, I'll give a little bit of background. I mean, Cosine Solutions have been involved in education primarily for, there we go, online training for the last 20 years in trade finance and letters of credit. A lot of you will be familiar with this. I'm not going to take time going through all the different products we have. We have online training and collections in UCP 600. That's our Mentor 600, is our UCP 600 product. We have advanced training in LCs. Again, a lot of you will have probably been through this, or some of your staff will anyway. I'm not going to go through all of these. That is the aforementioned Professor Jim Byrne, who worked on us with our ISP 98 training. And then we have a course in the URDG 758, which we worked on. With all of our courses, we worked on with all of the leading world experts. So, for example, for URDG, Dr. George Afaki was the chair of the drafting committee for that. He worked with us on that, with Gary Collier on letters of credit, etc. Incoterms, we've a whole course. More of interest today for some of you will be our trade-based financial crimes training. Now, this is something that we worked on in partnership with Alex from the LIBF, the London Institute of Banking and Finance, and with Chris and his team from the IIBLP. It's a certificate in trade finance compliance. The target audience for this training is compliance training for trade staff. So for those of you who are working in trade who more and more need to learn about compliance, this is for your trade staff. But more than that, it's also, you'll find in your organizations, there are so many compliance staff now in the compliance departments, and actually they have no idea what goes on in the trade world. So the idea of this is train compliance for trade staff, but also training your compliance staff in what goes on in trade. That's just a quick screen grab of the start of the course. But in general, what it covers is every aspect of financial crime regulation for trade finance people. It covers a compliance program, what should be in a compliance program, the elements of a compliance program, how you should build your compliance program for trade in your bank. Exercising due diligence, enhanced due diligence, know your customer, KYC or KFC, as some people say, or KYCC, your customer's customer. We look at all of the indicators of financial crime. This is what the people refer to, the red flags, all the different indicators from FATA, from Wolfsburg, from all the different organizations. And then, of course, we cover all the main topics of anti-money laundering, countering the finance of terrorism, sanctions, huge issue at the moment, particularly with all the new sanctions going on, WMDs, anti-bribery, commercial fraud, anti-boycott. So it covers all the areas of trade-based financial crime. As I said, it's an initiative that's a joint partnership between the three organizations. So the IIBLP wrote the text. It was actually written by Professor Jim Byrne, who won for the LIBF, and Alex's team in the LIBF run the certification program of the program, so the actual examination. These are just a few screens covering some of the content. The training itself, of course, is fully interactive on movies and animations and sound and everything. But just to give a few samples, we cover things like what are unusual transactions, in terms of what's unusual transaction, in terms of the type of goods used, the scale, the price, different things. How to identify significant deviations in business patterns. But not only identifying that, but what then should you as a bank have to do with that if you identify something like that? So what should the bank do? What could it signify? What's the action you should take if you identify something like that? We were very conscious as well that a lot of the information and training in this area is very US focused, because obviously everything is led by OFAC and the US regulators, and most other countries are following that. But it's a much broader world than just the US, so we've also looked at what's done in other regions, like the UK regulators, the HKMA, the MAS in Singapore, etc. So we tried to really build an international program. So that's it, that's the CTFC. Anybody who's interested in taking the CTFC, and I really think you or people in your organisation should really look at doing this, it's £845 per candidate. The contact details are there at the LIBF website, and myself or Alex or Chris will be happy to talk to you for the rest of the day about anything like that. The next thing I want to talk about briefly is one of our programs that we launched in the last year, a little over a year. It's a training course in sustainability and trade finance that looks at all of the United Nations Sustainable Development Goals. We have, I think, 7 lessons covering global environmental and social issues and themes. Again, very quickly going through them, how those issues relate to trade. So for you people working in trade and trade finance, why are these things relevant? So factors contributing to the increase in trade, complexity of global supply chains, etc., etc. We have a third lesson, why does this matter for banks? In terms of financial risk, legal risk, reputational risk, of course, is a huge area in environmental issues. And the various conventions and regulations related to that, so things like the Convention for Responsible use of things like palm oil, responsible soy, the Mariupol Convention, all the different conventions related to sustainable finance. Then we cover the international E&S standards and guidelines for banks, and then risk management frameworks, so how banks should be applying their risk management frameworks to this whole area. Again, don't want to spend too much time looking at the detail, but managing environmental and social risks in trade finance. What we also do in this course is we try to place the trainee in a simulation of a real-life situation. So we have case studies where if you're working as a trade finance banker, we look at your situation where somebody is looking at a particular trade request for somebody covering furniture manufacture, for palm oil, for beef. The case study is in South America, where obviously there's a whole issue of clearing rainforests for the production of beef, for coffee in Africa, for hydropower, for wind power. So what we do there is we try to put the trainee in a simulated situation of what they might have to do in the real world. The final thing I'd like to talk about, which I think is of particular interest, is our new initiative. It's the Association of Trade Finance Compliance Professionals. So this is a new association we have just launched for all of you who are working in trade finance and who are working in the compliance area. That's the website, just a few little quick screenshots of what you get as a member of the ATFCP. It's a community association which gives you membership resources, access to online training, to webinars, to the certificate in trade finance compliance that I spoke about earlier. There we go. It covers, for example, all of the conferences. This conference which is on here is only one of a series of conferences which is run internationally. So for any of your colleagues in banks in other worlds, we also run an event in London in May is coming up. We've just had one in Singapore, although virtual, about a month ago. We have this one for the Middle East region, and we have another one in New York for the Americas in probably late November, early December this year. So any of your colleagues who are interested in this area, please encourage them to see that. It has a whole news flow, so a whole list of news articles. We've employed a journalist who writes articles specifically in trade finance compliance news. They're just a few headlines from recent stories. We've probably 4 or 5 articles a week on what's going on in trade finance compliance. So, for example, you probably can't see it from down the back there, but crackdown on TBML to battle the world's kleptocrats from a US senator. Russia amongst non-cooperative tax jurisdictions on the EU grey list, and Turkey. Counterfeiters moving online. So all regular stories about what's going on in the trade finance compliance world. So that will keep you up to date. That's just one of the detail of one of the stories. Again, you can't read the detail of that from back there, but just to give you a bit of background. It's the home of the CTFC certification, which I spoke about earlier, the joint initiative between the 3 organizations for training in trade finance compliance. You have access to various online training courses. We're running quarterly webinars. The plan is to have a quarterly webinar in trade technology. It's a big issue at the moment for the various providers who are providing technological solutions to some of the problems you're having in the whole area of compliance. So, for example, in Q1, the webinar we're having is tools for shipping registry, ownership and sanctions. We're also planning webinars in compliance. Again, quarterly, the 3rd quarter will be concentrating on sustainability compliance requirements. And we'll have things like discussion forums for members to share ideas, to ask questions, to exchange ideas. So the whole idea of the association is to build a community of you people who are working in this area, who can actually work together, discuss, participate, learn from each other and help each other. There are 3 levels of membership of the association. The first level is free. That gives you access to things like the news flow, the news articles online the whole time, the different webinars, the quarterly webinars on trade tech, on compliance, and discounts then to things like the online training and to the ATFC conference. Then there's 2 levels of paid membership, standard or premier, which both give you access then to more discounts on participating in the various items. Let me just go back there. The membership for everybody participating in this conference, you will all qualify automatically for 1 year free membership of the standard membership. So after this conference, you'll all be given access to go and sign up so you can join and be a free member at no cost for the standard membership, which will give you access to the conference materials, the news, the webinars, the quarterly briefings, etc., which is normally $150, but you'll get that entirely free for the first year. And I think that's
Yeah,
pretty
that's
much
great.
it, Vin.
Yeah, that's great, Derek. And just something that's interesting with the CTFC, we've seen some, because it can't cover everything, but it's a very good training program. But what we've seen actually is some institutions taking it as the pre-course training and get their people to go through it. And then they bring in some experts, local experts, etc., on particular topics. But it means before they get into the technical, complex area, everyone is at a kind of the same level, and that is just working extremely well. Alex, I think you wanted to jump in there.
Well,
Please go ahead.
Actually, I've just
Yeah.
been talking to somebody about that this morning, about
Okay.
the ability to use that as a level and then to do even higher grade qualifications potentially. But what I like about what we're doing is that community aspect.
Yeah.
And with the situation at the moment, with people come to these conferences using it to get CPDs, continuous professional developments, to help for their recertification. But they'll be able to do that with the website. There'll be a lot of things on there. One of the things that with our qualifications at LIBF, they're now available to be done online. So therefore, during the pandemic, for CTFC, you could actually sit at home remotely.
Okay.
So that is a major advantage, because this is where a positive of COVID is the digitization agenda has moved forward.
Move forward.
So that's one of the things I just want to stress. It's you have to make sure when you're doing the exam that you haven't got lots of books around you. You have to be in a clean environment, because there are people watching you remotely, literally a person watching you, but it is available for a number of people. I'm actually doing the qualification at the moment, and I wanted to try and pass it before I came here, but my boss said, you know a lot, Alex, a bit like you with a 50% type thing.
Yeah.
And it's for trade people who want to do compliance and compliance people who want to do trade. So I may be weaker on the compliance side, being a trade person. So that's why I'm stressing to the people maybe watching and listening, you might think you have experience, but it's a robust qualification. It's deliberately, none of our qualifications are easy. It's there to be, so that when people are employing people with the qualifications, they know that they've done a lot of work to get it. So hopefully next time we're on a conference, I'll be able to report back that I've passed. I'm putting it out there.
Okay.
So that puts pressure on me. That's the way it will work.
We're putting the spotlight on you, Alex, going forward. And please, yeah.
If I might, I think it's important to say for a lot of the training courses we have on things like the UCP 600, UCP 600 changes once every 15 years or something. So you can do training and that it stays the same. Yes, there are developments in the area, but it's the same. But in the area of compliance, every day it's changing. So it's very important to stay up to date, and what the association will give you is the ability to stay in the network and keep up to date with all the different things that are happening.
Yeah, I think it's a wonderful idea. And in terms of compliance, coming back to you, Chris, putting you on the spot a little bit. IIBLP have Documentary Credit World, which is probably the only really technical and legal publication available now in trade finance. But when we get kind of into trade law and compliance, our day-to-day is structured following exactly what our agenda. In the morning, we have the trade law morning. So it's predominantly, once we finish this here, we will be getting into legal issues, starting at some foundation principles of trade finance. We'll be starting with foundation principles of bills of lading, which you are all expert in, but maybe there's something you're going to learn that's new a little bit today. Then we'll be moving on, and we'll be looking at some of the key cases that unfolded predominantly in many jurisdictions, but I think two of our cases today are focused on Singapore, and because it was felt that the judgments that came out of Singapore had a very good balance between what the trade professional would expect and what the lawyers would expect. So it's really, really good. And we'll also be looking at something that's really topical right now, and that's that's a pandemic of court injunctions. Because I know some of you in the room and I know some of you watching are actually in bother with court injunctions stopping payment under guarantees, particularly counter guarantees. We'll be dealing with this as well. So we're going to be dealing with some real substance, with real people, real practitioners, but I want you to engage as much as you possibly can. There is no stupid question except the one you don't ask and you wished you actually asked it. So I see we have a few more countries that join us, and I'm so happy to see the delegation from North Macedonia, Skopje, North Macedonia. They have been planning to come to Dubai for our conference for the last how long it is, I get confused. But now they're here. We have commercial bankers here. We have the central bank here. You are more than welcome. So I hope after all this long time, it will be worth it. You're making me nervous now thinking about this. But Chris, I'm coming back to you. And before we move on, and putting you on the spot, you came here from the US, you're in the US. We've kind of heard from Alex and Derek in a very positive way of where you can find information, but I find it overloading, quite frankly, okay? And I used to be the guy who felt he had control of everything. Now I'm out of control, totally out of control. But putting you on the spot, maybe, Chris, if I had to say to you, in the US, or I'm looking at websites, I'm looking for core key information to try to keep up to date with developments in terms of US compliance, sanctions, etc. Because really, that's where we got to look. Give me your top three, or where we might look, or where we might go.
Sure. Well, in the U.S. jurisdiction, a lot of tension, rightly so, is on OFAC. OFAC is a segment that falls under the Treasury Department of the U.S., but also Department of Commerce and State have economic sanctions requirements that covered institutions are required to follow as well. But to answer Vin's question, did want to go back to OFAC, because just within OFAC alone, for instance, over the past few weeks now, there has been increase in Russian sanctions, 3 different sanctions programs, because there is Ukraine and Russia related sanctions, and then there is another problem, there's another program called the Russian Harmful Financial Activity Sanctions, and then there is yet another OFAC problem which dates back from the past administration in 2017 called CATSA, which is the Countering America's Adversaries Through Sanctions Act, and that's from 2017. So all 3 of those areas are constantly changing nowadays, every day. And just to add one more thing, FinCEN, the Financial Enforcement Crimes Network, has put out an alert at the beginning of this month advising covered institutions again to be on guard for efforts to evade Russian sanctions. And it is the key components of that alert say that covered institutions need to be swift and diligent in filing their SARs. They need to be cognizant that they are looking at risk-based customer due diligence as well as enhanced due diligence. And just one example that they gave is that Russian sanctions could entail efforts by Russia and Belarus financial institutions that are not yet sanctioned, but might be opportunities and fertile ground for sanctions evasion.
Okay, so OFAC, and if you were to just give a quick list of the top 3 sources we were going to Google for information.
Yeah, well, there's OFAC, which I covered, and then also Department of Commerce's Bureau of Industry and Security also has sanctions requirements there, and the State Department's Bureau of International Security and Non-Proliferation. And if I could quickly add, with regard to what Derek had to say about the certification program, banks certainly are in the competitive space in a lot regard. When it comes to compliance, there is almost an onus and obligation for banks to cooperate in that space, because if you see red flags and are trying to make sense of them and figure them out, the bank down the road might have other red flags that they're recognizing, and in large part, these scams and frauds and breaches of reputable banking occur because the illicit actors are looking for a weakness within banks. And if they can't find one at this particular bank, they go down the street and they try to go after the other bank. So that really, I think, demonstrates why it needs to be a collaborative space for banks in this industry for compliance reasons.
Thanks, Chris. And that's why a standardized knowledge is the foundation of all of this. And then the second thing is how we're going to analyze all of this information, deal with it. But that's why we're lucky, because immediately after lunch, we have our colleagues from TradeSun and otherwise regarding the technology who will be giving us some insights on what can be achieved and what can be done if it's actually going to be done properly. But you reminded me, Chris, when you mentioned FinCEN. Just a little story for 30 seconds. We had the ICC Banking Commission meeting in Jakarta a few years ago, and Chris was speaking and he was talking about FinCEN, and then we had a coffee break and he was saying how the sanctions can be quite challenging for everyone, and we know they are quite challenging, you know, and a little Chinese lady came up and said to me, "Why FinCEN you have such sanctions?" And I said, "Me?" I said, "Yeah, FinCEN. Vincent," she thought. So it's not me, okay? Let's just be straight about this. It's not me. I have nothing to do with it. I'm just sharing the information. So we're going to move on, and thank you, Alex, Derek, and Chris. That was very insightful. I think it helped us set the scene. But now we're going to kind of go right down back to basics, and we're nearly 5 minutes ahead of schedule, but it's always good to be 5 minutes ahead than 5 minutes behind. But here, Khalil has a question, so please, Khalil, yes.
As far as we are ahead of schedule,
Please, by all means.
Question to Derek regarding, please elaborate on the mission of the Association of Trade Finance Compliance Professionals. What's the mission and what do you do?
Yeah, so to repeat for our people abroad is what is the mission of the association?
The mission of the association really is, as I said before, in some of the areas like letter of credit practicing, things are not changing very much. In the area of compliance, every week there are new regulations, new practices, new things that are going on. So to be sitting at home on your own, in your office, trying to deal with all of this can be a challenge. So the idea is to build a community. So as a community, you can share ideas with fellow practitioners to understand what is going on. As Chris just said, everybody's dealing with similar issues, but people quite often are in their bank on their own thinking, I have this problem, how do I deal with this? I have this transaction, I have this situation, what am I going to do with this? But the reality is somebody down the road has the very same thing, or had it last week or last month or another time. So the idea is to put people together so they can share ideas, share experience, to try to help each other. So through discussion forums and webinars and the conferences obviously like this, we allow people come together. So when you're all at the coffee breaks, or when you're listening to a presentation like this, please ask your questions, because there's somebody else sitting down the back who is probably dealing with a similar problem, may not want to put their hand up and say, I'm dealing with this, I have a problem, because people don't like to show that they don't know something. But the reality is all of you and all of your banks are dealing with the same things. And it's changing so quickly in terms of sanctions, in terms of trade-based money laundering, all the different aspects of financial crime, trade-based financial crime, that we really want to create a community who can share their expertise.
If you think when people come together for these conferences, there's a lot of work being done, and then we go back. This enables the conference, that interaction to continue, so that when we get to other sessions, you know, we've already been communicating and not restarting again. So I like the whole aspect of the community because there isn't that at the moment except when we meet together like this.
Great. And so again, any other questions? Please raise your hand. Please be ready.
When you said 5 minutes, Ben, you blew it, didn't you? Because it's already been filled up now.
Yeah, but we're okay. We're still okay. We've about 3 minutes left. So any further questions from the audience? We've one here at the back. Thomas, I think.
Thomas Smith here from Ireland. Do you have CPD credits for membership of the association? Do you have CPD credits for membership of the association?
Good question, actually.
Sorry, the question for those who didn't hear is, are there CPD credits? By CPD credits, I presume you mean for the various qualifications from the LIBF.
Yeah.
Probably.
Go ahead.
Well, it's interesting because this is a relevant question to somebody yesterday I was talking to about recertification for a number of our qualifications, and he said he's not been able to get to events. And that's where maybe at LIBF we need to make people more aware of the various bits of material. But you know, if you're reading for an hour or so on various information of the latest up-to-date news, you can use that as CPDs. You just put that into your log and say, I read about US sanctions for an hour and I learned this. So it doesn't have to always be at conferences or the webinars, but generally, for CPDs, you would just log. So that's a very good point because I was just asked this yesterday, and I think I need to do something about increasing the awareness. CPDs can be done from many different opportunities, so that's why it's a great channel.
Yeah, and that's a very good idea. I think it'll broaden the spectrum. I think it'll add a lot of value. Yes, so something you need to actually work on. So we're going to. Oh, one more.
Just a comment.
Yeah.
I think that the association should not be confined to a self-help group. It should try to influence the regulation.
Yeah, we'll let you repeat that, Khalil, because you'll have the microphone. Habib, have you the microphone?
No, I think,
Okay.
I think what Khalil said was it should not be limited to a self-help group, but should actually try to help influence regulation. And I think as something like this builds a critical mass, that will happen automatically. And I think then people will get involved. I think what we will probably build up to as numbers grow in the association is probably regional sections in the area. So we'll probably have an Asian Pacific section which will feed into the regulators in HKMA or MAS, and in the European section another, and hopefully in the US, although the US regulators are not typically famed for listening to input. They more express their view. But yeah, I think if we build a community, that should happen.
Yeah, I think inclusiveness is the key, and having events like this and a structure like this enables regulators informally to monitor and hear from practitioners in kind of an open, positive way. And we've one last question here, and then we will move on, and then we'll be 1 minute ahead of schedule. Okay, please.
Nowadays, international trades has been settled under a letter of credit. Obviously, it's a law, but nowadays all exporters and importers, that is buyer and sellers, desire to settle the international trade through contract. Here, I think a lot of risk involved here in this international trade, settling international trade.
Okay.
What we should, I propose ICC to analyze the problem and to settle the international trade under a contract.
Okay, we're going to analyze the problem and we're going to come up with a solution before 5 o'clock this afternoon. That should be easy for me, okay? But that's what we do. No, seriously, we do need to analyze it, and that's why we're here today to discuss. And in terms of international trade, contract between the seller and the buyer, and contracts of carriage, I didn't pay this gentleman to say that because that's where we're going next. We're moving on to contract of carriage, not exactly, but talking about bills of lading and related. So, gentlemen, Alex, Derek, Chris, thank you for your wonderful input. Really,
Thank you.
Great. Give them a round of applause. Wonderful. Okay. Right, KP, if you can join me on stage, and I think I can stay where I am, which is wonderful. And you know, usually when KP joins me on stage, he stays over there. Come over here so we can have a conversation. So, dear friends, in the last 2 years, there have been many challenges, and well, one of them has been compliance, and now sanctions is at an all-time high. But we're talking about that a little bit later on today in detail from a technical expert who is advising governments. But right now, we're going back to basics, and we're going back to something that we all feel we know, but sometimes we find we don't know. Because in the last 2 years, there have been some landmark court cases that have shaken our understanding of certain fundamentals of international trade. Shaken our understanding. So we're going to go back to basics. And after I have my session with KP, we're going to move on to specific legal cases concerning our little conversation here. So we're having an open, friendly conversation, but with KP, sometimes it's not so friendly. He gets quite aggressive, okay? But we're trying to have a friendly conversation. And after that, we're going to hear from the legal cases with Robert Parsons. So what are we talking about? Right now, bizzle-aiding. Subsequently, cases regarding bizzle-aiding, letters of indemnity, and the obligations of carriers, etc. But now we're getting back to basics, KP. So all of us, well, not all of us, but most of us here in this room are trade finance professionals, trade finance operations professionals, and we do our job checking documents, etc. And we're interacting with bizzle-aiding every day. In my life, I've seen so many bizzle-aiding, okay? But you're Institute of Chartered Shipbrokers, So in terms of you tell us simply what is a bill of lading, and I'm sure it's consistent to what we think, but it might be slightly different. So let's start with you telling us what is the bill of lading, its role and function.
Yeah, good morning, everyone. But Vin, you've already scared everybody that I'm not friendly. So
he's friendly most of the time.
You put me in a difficult spot. Okay.
Yeah.
Coming to the document called bill of lading, I think almost every one of you would have handled it somewhere or other, directly, indirectly. Perhaps this is a very unique document, and that's what probably made you invite me here, right?
Yes, exactly.
Which document in a world which is not issued by any authority or any particular body? Anybody, any carrier could issue a bill of lading? And not controlled by any authority, anybody, you can change ownership. You can change the title. Is there any other document in the world like that? Worth probably millions of dollars? Half A4 page document issued by somebody like an entity, just a carrier, changing hands without anybody controlling, that makes it different.
Yeah, that's really interesting. Yeah, and I can't really think of another document other than a bill of lading. I could kind of make a half-hearted effort by saying a warehouse warrant or receipt, but that's half-hearted because it depends so much on the local jurisdiction. So I'm inclined to agree with you that, yeah, okay, so you really think this bill of lading is special, KP?
Very, very special because you as bankers are involved in it. You tend to, or you are advancing funds against that, against maybe
Millions.
taking that as a collateral or seeing that as a collateral. So it's very important. Something very special.
Yeah, and but going back to something you said a little bit earlier, you said what document could be involved in the transfer of millions of dollars worth of goods on a or billions on a day-to-day basis. No argument. We agree. But you kind of use two words together that I want to go a little bit deeper on. Somewhere along the line you said transfer ownership, and somewhere along the line you said the word title. So, can we talk about that a little bit? But before you start, because he always jumps in when I try to get here, okay? But you're not today. You're out, okay? So, when we're talking about title, in most reasonable people's mind, in a reasonable person's mind, when I hear the word title, I think title means ownership. I have title to something, I own it. So does the bill of lading as a document of title mean conclusively I have ownership of the goods? Let's say the bill of lading consigned to me to order off a bank and I'm the bank. Does it mean ownership?
But Vince, you call yourself my friend, but then you keep cornering me like this. Now you call me unreasonable. Eh? Any
I didn't-
reasonable
no,
person?
No, I
Your
didn't
Honor.
say you're
Okay.
unreasonable. See, he's escaping again. I said
All
a
right.
reasonable person. Maybe you're a reasonable person, but maybe you are unreasonable. I don't
No.
know. Answer the question.
All right. This is something perhaps quite often misunderstood, not just probably by the banking community, but also by the carriers, the logistics practitioners like myself, that the bill of lading, that the title is real, or rather it's complete. You own it when you own the bill of lading, when you have the endorsed bill of lading in your hand. But actually, it's not so completely, because you only have a title to possess it. But the actual ownership depends on what is the contract of sale. What does that say? Right? Now, for that contract of sale, neither you as bankers are responsible, nor we as a logistics practitioner, somebody who issued a bill of lading, or who would be handling it for delivering the cargo to a so-called owner, we are not party to it. So that will actually depend on the contract of sale. So what we have is a possessory title, a title of possession.
Okay, now that's really interesting for me. So, in my mind, because I'm very kind of yes and no, yin and yang type brain. You know, I can't figure out this stuff in the middle. So for me, you either own it or you don't own it. Okay, but I think what you're saying, that you have possessory ownership. But in my head, you know, but you're using the words we keep hearing again and again, and correctly. But possessory ownership really means to me, and going back to Jim Byrne as well, he explained this to me years ago, because I'm a slow learner, and he explained to me that what this title means, and I just want to check it with you, what this document of title means, you are entitled to take delivery. Would that be thereabouts it?
Yeah, you are entitled to take delivery, of course. But what we need to understand is that ownership of the person who is taking delivery is not complete.
Okay.
Maybe he has got, let's say, he has got 60 days to make payment, right? According to your document of credit, as well as the contract of sale, he has got 60 days to make payment. But he is now taking delivery of the goods,
Okay.
right?
Yep.
So until he makes payment, he doesn't fully own it.
Okay.
He has only a right to possess it for that point of time.
Okay, so getting a little bit deeper into your story about the bank, because you brought up the bank, I didn't bring up the bank, okay? So we have a letter of credit that's maybe payable 60 days, well, let's say 90, because it just keeps it simpler in my mind. A letter of credit is issued, and it's issued and has expiry date, and it's available by acceptance or deferred payment 90 days. So I think what you're saying is this: the goods will be shipped, and I'm no expert in transit times, but just imagine it's 10 days, okay? 10 days, port of loading, port of discharge. The bills of lading are in the bank, consigned to order of the bank, okay? But surely if the payment term is 90 days, but the bills of lading are in the bank, the full set that we'll talk about in a minute, surely there's some natural pressure on the system to release these bills of lading, but the credit risk doesn't actually happen until the maturity of the 90 days. Or am I being unfair?
No, you're not unfair, because you need to, I mean, transit times are often short, or even if it is a little longer transit time, perhaps much before the documents reach, or before the payment due date, let's say,
Okay.
the goods reach, and you can't hold the ship and the cargo together. Today, particularly in today's world where the ship's costs are extremely high, very, very high, where, a couple of months back, what we saw, and today is probably charter rates are 3 times high, or 2.5 times high. So the cost on holding a ship is very, very high. You can't hold the cargo. You need to release the cargo, and then there are other pressures as well. The cargo, you may not be able to store the cargo. You need to take delivery, get it out of the port. So there are pressures like that. So you're right. There is a pressure to probably release the document. But then comes the question of, you have probably thought that this is a collateral, or this is
Okay.
where you have a security.
Okay,
Right?
okay, that's really good. And actually, we're keeping it very simple right now because these issues are going to come up in our next session regarding the legal cases. Okay, so just moving on a second. So I do see very clearly that if we have a bill of lading consigned to order of an issuing bank, it's quite powerful at a certain point in time.
That's right.
because I have, it's quite, very powerful, I'd
That's
say,
right.
because I have control over the release of the cargo. But this is competing with commercial pressures outside. Okay, let's move on a little. I'll come back to you later. I'll come back just, in a moment, Just want to get through the story, but you're the first question. Okay, so moving on a little bit, and again, we all know bills of lading are, most of the time anyway, bills of lading are issued in a set of 3 originals, okay? Like, an original is an original, so tell us a bit of background why we have 3 originals, why you guys came up with this, and why in this modern world we're still using 3 original bills of lading.
But
Bit of background.
you guys are asking for 3 originals. When you get into a documentary credit, or then there you are saying that you need 3 originals because you use standard formats of LCs. You take what is being used for years together, and where there is a word saying that 3 marine bills of lading. So probably it starts. You ask a question. Where did it all start?
Yeah, first,
Okay.
but that's a good point.
We go back hundreds of years back. The trader and the ship owner were the same. He used to take the ship, buy the goods, go to another country, another place, sell it. At some point of time, the ship owning got separated from trading. So then the trader buys the goods and gives it to somebody else to carry it and deliver it to the other side. That's where probably the bill of lading and its importance comes
Okay.
in. Probably of those days, I've read it somewhere where they used to send 1 BL by the snail mail, the old mailing system. They used to keep 1 bill of lading on board the ship with the captain of the ship, because in case the mail doesn't reach, the receiver still gets it, he can pick it up from the captain of the ship and then take delivery. And then the shipper keeps it. In case the other 2 lost, he still have evidence that he has shipped out the goods. So
Okay.
the shipper used to keep it.
Okay.
Right? Now, why do we need this in today's world? 3 bills of lading, 3 originals. I have fought with many people that why do you need it at all? Definitely, the surrender of bill of lading is a common practice in shipping these days. And when you are surrendering it, why do you need 3 originals to surrender? And there are many times this 3 originals creates a lot of confusion, a lot of complications.
And, really, in most cases, most cases, the 3 go together. Will you
Yeah, they
agree?
go together, yes.
Okay. Right, your insights are wonderful because KP, I'm blaming you guys, shipping guys, why the heck are you issuing 3 bills of lading? Well, I think 1 is enough, but he's after giving me a very good answer. One of the reasons we're continuing to issue 3 is because you guys in the banks, you keep asking for 3, okay? So we need to talk about this, KP.
Yes, we need to, not just talk,
Okay.
you need to act.
Okay.
You have to probably somewhere get it changed to having only 1 original
We need to
document
act.
with it.
Well,
Yes.
that's easy. 'Cause
That's a job for you.
I'm acting every day of my life. Okay, so right, we move on a little bit. So that's clarified regarding the number of originals. We're agreeing. Actually, something came into my mind. If we picture the Ever Given, the ship, stuck in the Suez Canal, okay, and on this ship there could be 20,000 containers, 18, 20,000. We'll keep it 20, so the maths are easy. So the ship is stuck in the Suez Canal. There is 20,000 containers on it. If we're looking at part shipments, etc., there could possibly be, don't hold me to it, but it possibly be 10 bills of lading at least for each container, maybe.
Right.
So that's 20,000 containers multiplied by 10, that's 200,000 bills of lading. And because it's issued in 3 originals, that's 600,000 pieces of paper.
For 1 ship.
So, and you're telling me that 400,000 of these pieces of paper are...
Useless.
Wow, we're making progress.
Okay.
I think
No,
we're making progress. Okay.
When you missed out, this ship is probably on a round the world voyage calling 12, 15 ports, and each port is dropping in 3,000, 5,000 containers and picking up 3,000, 5,000 containers. So now I leave it to you to imagine probably how many documents are involved in that one voyage.
Okay. Just 10 seconds, I'll give you a question. So we need to rethink something. Before we start trying to digitalize anything, the first thing you do, you need to look at its role, its function, how it operates, and then you re-engineer it. But right now, I kind of feel a lot of people are going the other way. They're taking this document that is not working effectively, and they're trying to digitalize it. Look at its role, look at its function, re-engineer it, and then digitalize it. But my friend here in the front row has a question. So please, Habib, could we get a microphone to our... Habib, your question? Microphone? Yeah, okay, well, we'll move ahead. Please.
Morning,
Yeah.
sir.
Yeah.
I have come from Uttarakhand, Bangladesh.
Welcome.
I have a question.
Yes.
We know bill of lading is a negotiable instrument.
Okay.
It can be changed its ownership
Right.
Title.
from one to another.
Yes, title.
Bank received bill of lading with various documents
Okay.
and endorse in favor of importer.
Right.
Okay.
Importer released the goods
Okay.
from shipping line.
Right.
Okay.
In practical, the importer released the goods from vessel or shipping line
Very good.
without the consent of, without the endorsement of bank, as per agreement among exporter, importer, and shipping line.
Okay.
My question: how is it protected?
How is who
How
protected?
can we protect?
How is
The
the
bank.
bank protected?
The bank fall in risks.
Yeah, the bank can definitely probably move against your importer on a legal action because you still hold the document.
You're absolutely right, KP, but just to highlight something, but you're right, because I've been involved in many legal actions and occasionally an illegal action, but mostly legal actions. And like when you issue the LC, you're taking your credit risk on a particular party that you've analyzed, you've taken the risk. But all of a sudden, if you're not going to get your money and you're suing the carrier, whatever, all of a sudden you have a credit risk that you haven't analyzed, that's forced upon you. But I agree with your answer.
Yeah, you're right. You have not analyzed the credit
Good question.
risk of who is a carrier, who is a customer. You are not even seeing the contract of sale.
Okay.
Which is, our friend, our common friend, Captain Norman in Australia calls it the grandfather document, the contract of sale. That's where everything starts. No, we have not seen that. We
Okay.
don't know what they have put in there.
Okay. Okay.
Right.
Okay, that's really important. And before, I know we've questions coming, and we'll come to them in about 5 minutes, okay? But you're absolutely right. The title or the ownership is governed in the contract of sale. There can be, like we hear here, a presumption of ownership, but presumptions are dangerous things, okay? You presume one thing, but it's something else. So that's a very good point you actually brought up. But following this gentleman's comment, or going that direction regarding the release of the cargo, it's very common, okay, that if for many reasons, but if, for example, the ship has arrived, and we saw the transit times are now shorter, ships are faster. The ship has arrived, okay, but the bills of lading are still stuck in the banking system, or for other reasons, okay, that comes later in our court cases with Robert. The cargo may be released by the carrier, okay? The cargo is released by the carrier without surrender of this bill of lading. You said it's so special at the beginning.
Yes.
So what is the situation of the bank or another lawful holder in the event that the cargo is released?
They will have to initiate legal action against the client who has, not only probably client, probably also the carrier.
And I guess in your
Because
experience...
the carrier should not deliver the cargo without the original document, but that is not the practice. Let me also add to that. It is not the practice because of, again, the practical reasons.
Okay,
Because
okay.
you need to have a mechanism to clear the cargoes when the ship comes.
Yes.
Because you cannot hold the ship, as I said, ship is very
Very good.
expensive. You can't hold the cargo, even for other reasons. There'll be pressures from the port, there'll be pressures from other areas where you cannot hold the cargo, till the document comes, or till the document is released, or till the payment is made by your client. So there has to be a mechanism for that.
Okay, I agree. So we need to work on this mechanism, but just you've mentioned 2 times that you can take legal action. I agree. And from your experience, I guess when you take this legal action, it takes 2 or 3 weeks to get the money, or a month,
It could take much longer.
2 or 3
Oh,
months. 2 or 3 months.
I-
2 or
again,
3 decades.
When don't
You
forget,
gotta say something.
there it in as far as shipping is concerned, then it's got much more complications
Okay.
than air or road transport. Is it? The other day we did talk about this.
Okay.
Shipping is much more complicated, and it involves many other factors, so may not be that easy.
Okay. Well,
May not be that easy.
we're gonna wrap up in a few minutes, but we've 1 or 2 questions. Oh, Nasser, please.
My friend from the bank, what he want to tell is basically under a FCA Incoterm, so the nominated carrier is actually from the buyer. Transaction is under documentary credit. So the ship is moved to the destination and carrier, the buyer take control over the goods, but document is discrepant. So they send back the document. Bank is not involved in issuance of any shipping guarantees or others to release the goods. Unfortunately, the transaction size is very low, so it is very difficult to think of to go to the court.
Sure.
Yeah, so that is the real scenario in the ground.
Yeah, and all I can say, Nasrul, is just I agree with you. I think you have summarized that it is a problem. It's an ongoing problem, and there's no easy solution. Thomas had your hand up again for another question. I don't know, is there a microphone there that we can get him? That would be great. And then this gentleman here and here. If there's a microphone there for, can you provide him, please? Over here, Habib,
there.
at the back. Habib.
I know, I think.
Okay, we'll go with this question first. And we'll take 3 questions or so. And Thomas, you're next. I know you're very keen, but hang on a second.
Are you
Yes, sir.
listening? Okay. We have a case. We had a case with Debenham, UK. The bankrupt case said, we found some of the goods released by the carrier without the endorsement
Okay.
of the consignee. And it's been years that the administrators haven't paid us all the invoices. And the consequence is, this is under court.
Yeah.
It's been years we're not having the money.
Habib, at the back,
So-
please. Thomas is waiting.
Is it really working as a security as a question? Is it really working as a collateral as a question? This is a real life case.
I'll just answer, because that question you mentioned, we could talk about for 3 days, maybe 3 months. But just to highlight to our audience and our viewers that the question you've asked is one we need to really look at. In that situation, given the transit times, the supply chain, is it really a collateral? And I won't answer the question, but I think we've kind of answered it already. That is the question. KP, I think you want to add?
No, that's what we, in fact, that's what we discussed earlier as well.
Great.
Is it really a collateral, or there are challenges in that?
May I ask a question?
Yes, please, go ahead, and then we've one at the back.
See, all
and
the
then-
case studies that we're talking about, it's basically the bill of lading being a printed document, a physical document. So
Yes.
I was thinking about an idea, like in the
Okay.
future, can we use any concept like blockchain for the issuance and the management of bill of lading?
Well, the answer is yes, and the answer is we'll be hearing about it later today on 2
Then
different
that
sessions.
would be nice because
Yeah,
all the
wonderful.
stakeholders would
Yeah.
be connected along with the
I
banks,
agree.
the shipper.
I agree.
Yeah.
Right?
You're right. In fact, it's already in practice. But as Vin said earlier, the probably one of the issues is that we are carrying the legacy system of the pre-originals, etc., onto probably the digital space also. This is where we need to re-look into our own working systems, our own practices. Yeah.
Great, and Thomas, I think you're at. You had a question.
Yeah, Ben, just
or maybe we
one
answered
small
it.
question. Could you take us through the steps of the customer giving a pledge over a bill of lading?
Very short, okay? Typically what happens is when the importer, the applicant, is applying for the letter of credit, he will complete security documentations before the bank takes the credit risk. One of those documents in terms of commodity finance is often a pledge. And that means it's a promise. It's a promise from the applicant, the customer, that he will hold the bills of lading, the documents, and in turn the goods on behalf of the bank. Okay? So then what happens when the goods are shipped and the documents are presented to the bank under the letter of credit? That is really when it crystallizes. The bank becomes a lawful holder of the bills of lading, and the bills of lading and the rights thereunder have been legally pledged to the bank. Now, I'm no lawyer, and this will come up actually in our next session with Robert Parson, but it's a very good question to ask, Thomas, and I hope I give you 50% answer, and hopefully Robert will give you the other 50% in our next session. So I think we have one last question, and then we're done. Yeah, was there one more? Yep. Thank you. And is Robert here? Because he's next. Yeah. Oh, you're here, Rob. Great. Yes, please.
Someone wants to got a question there.
There was one more?
Yeah, there's a question.
Oh, Paul. Yes, please.
Certainly the bank to have a collector would have to be holder of that bill of lading and also to have that agreement of pledge to the customer. Certainly if you have that bill of lading and the goods are released without surrender, when you as a bank, as a holder of the title, you can sue the shipping line for this delivery.
You can sue the shipping line, and it sounds very good, but as we heard from the man himself. Okay, well, with that, I think we're making progress. We're starting at something from the Attar. Sorry, yeah. Sorry about that. We'll take one or two more because it's connected to the next session. Where is the questioner?
This is Ataur Rahman.
Oh, please.
Ataur Rahman, Secretary General ICC Bangladesh.
Yeah.
Ben, I just wanted to inform that you know that ICC is now trying to have this URDTT.
Okay.
Uniform Rules for Digitization Trade Finance. And they are trying to digitize the bill of lading. The ICC is already working on it. Yeah. And what happens once it is digitized? Do we still continue with these 3 original bills of lading, or?
I won't really comment on the URDTT, but I'll tell you that the step to move to one bill of lading is a very important one, one original, and you know what? It's not that difficult, okay? It's not that difficult. So thank you, Athar. And we've one last question from the lady in the audience, and then we'll move on. Thank you.
Assalamu alaikum. This is Hasina Akhtar from Bangladesh. I'm working for United Commercial Bank Limited. I'm talking about bill of lading, the title of documents.
Yes.
Very nice discussion here going on. Just I like to add here one thing. The purpose of bill of lading, issuance of bill of lading is firstly the title of goods of the document described in the bill of lading. Secondly, the receipt of goods described in the bill of lading. And thirdly, finally, is it's represent the terms and condition of the transactions depends on the contracts or LCs. So if the bill of lading, if the shipping line delivers the good without the consent of the banks, the importers, to the importer, is it the violence of the rules or regulation? How can we address the violence?
Well, you said we said a number of very important things, okay? But the key ones for me that you said, but you said many important things.
How can we address this offense? Violence of these rules or regulations or agreements of the contracts?
I agree, but just to come on 2 points. How can we address it? It's a big question, okay? But it's not that difficult to solve, but it's a big question. But the second thing, I just want to highlight something really important that you said. The function of the bill of lading as evidence of shipment. In the modern day world, authenticated original evidence of shipment is the key. Because we've already seen that the ownership at the very beginning is predominantly covered in the contract of carriage, not the contract of carriage, the contract of sale between the seller and the buyer. So you're absolutely right. And of course, we all know in letters of credit, credits by their nature are separate transactions from the sale or other contract on which they may be based. Banks are no way concerned with or bound by such contract. So we just need to take your good ideas, and Even some of your good ideas, KP. I don't like saying it, but I think
Okay.
I think we need to take one or two of your good ideas.
Thank
So
you
we're going.
again.
Thank you very much. We're going to finish
you.
the
My
session, but continue on the same theme. KP, final word.
Thank you.
Yeah.
Final word, as we said, we need to probably look into our own working practices. I'll take the question the other gentleman there asked, are we going to continue with these 3 originals even in the new digitized practices which are coming up? I'm pretty sure that it will probably not be there, but we need to probably start from the practitioners, that is the bankers, the traders, the carriers, because what I have seen in many years is that neither, whether it's the logistics practitioner, whether it's the banker, whether it's the trader, all of them, they don't see the contract of sale, the contract of carriage, and the contract of insurance as part of the same process. They all 3 have to move together.
Yeah.
If one is left out, I mean, you are not dealing with one part of it, then probably there is a risk factor there, or there is a mismatch there.
Okay, wonderful. So we need to re-engineer the process and then digitalize it when we have one original. Wonderful.
Right.
So thank you, KP. And
pleasure.
Robert Parson is going to go ahead with our legal cases, etc. Robert, please join us on stage.
Well, thank you, Vin. Thank you, ladies and gentlemen. I'd like to ask my panel for the next session to come and join me in no particular order. Kyle Matar from Alinabak, Madhavan Thupal from National Bank of Fujura, Pradeep Taneja from ICC Bahrain, and Nazar Ul-Hoko from Mutual Trust Bank. Thank you very much indeed. Give a welcome to our panelists. And thank you very much indeed to ICC UAE and to Vin for organising this event today. It is always such a fantastic pleasure to be standing in this auditorium right above the Dubai Creek, which has been and continues to be a hub of international trade. And there aren't many places in the world where you can sit and see exactly where the business goes on. This session, following on very closely from the session which Vin KP have just had, we'll be looking at and focusing specifically on a couple, I think, of very interesting cases that encapsulate both the issue around bills of lading and about letters of credit. And I can see from the questions we've just had from that session that we're going to have some very interesting dialogue during the Q&A on this session as well. I want to give a little bit of background to the session we're going to have, particularly in the light of the fact that one of the cases arises very much from the spate of very significant trade and commodity losses which hit the markets in 2019 and 2020. And for those of you who need reminding, and probably none of you do, there were a series of losses incurred by major banks in 2019 and 2020 in Singapore and in the Middle East, and those continue to have a really significant ripple effect across international trade and the availability of trade finance today. And that's why we're going to be concentrating on one of those cases now, and partly because the cases that arose from those losses, of course, are still filtering through the courts. And we've had one of those decisions fairly recently. And while banks like BNP Paribas were probably already withdrawing from that market when those losses hit, we've then seen significant major players, SocGen, ABN AMRO, ING, significantly retrench from this market. And that's had a really serious impact on the availability of trade finance across the board. It's reduced liquidity, reduced the opportunity to get working capital. So how big was that problem? Let me just give you some of the figures, which are eye-watering figures. Just in sort of reverse order, 2019 saw the Inter-Pacific Petroleum losses, $168 million, mostly suffered by SocGen and other banks. 2019 was the Coastal Oil disaster, 354 million, and that particularly hit a trio of Singapore banks, OCBC, DBS and UOB. Then in 2020, the incident which we're going to be discussing in the case this morning was the Zenrock Commodities failure. $166 million, HSBC, a significant loss there, as well as Crédit Agricole, as we'll hear in a minute. 2020, the Hin Leong Trading collapse, $3.5 billion, HSBC, and about 22 other banks, very few banks left untouched by that disaster. 2020, Agritrade, $670 million, ING and others. And again in 2020, the Hontop Energy failure, another $473 million with CIMB and others. Absolutely colossal amounts of money, which of course necessarily hit the headlines, but also helped make decisions for banks about what they were going to do. So in the light of that, I want to talk a little bit about a case which came at the beginning of this year. There was a High Court hearing in Singapore in a case between Crédit Agricole and PPT Energy, which arose out of the Zenrock failure. Let me tell you a little bit about that case, but to mention that it pulls together a number of interesting issues. So-called round-trip trades, which became very popular as part of a structured exercise, and indeed, in many respects, continue. Transit trades are also the name given to them, where a series of companies effectively pass goods in a circle and they end up pretty much where they were in the first place. A bit like the children's party game, Pass the Parcel. And, as you guess, when the music stops and someone fails, someone suffers a loss. And that's exactly what happened in the Zenrock case. So, let me give you a quick picture of what happened there. In this particular transaction, there was a crude oil cargo sold by Total, the major oil trader, to a company called SOCAR Trading, which is a Geneva-based trading company. SOCAR sold the cargo to Zenrock Commodities. Zenrock sold the cargo to Shandong Energy International. Shandong sold the cargo to PPT Energy, the other party in this case. PPT then sold the very same cargo back to Zenrock. And finally, to complete the circle, Zenrock sold the cargo back to Total. So the cargo went all the way around in a circle and ended up with the people with whom it started. Now, the key to this case is that Zenrock, in relation to their contract with PPT, applied for, and Crédit Agricole issued a documentary LC in favour of PPT. And as is quite common in commodities transactions, the LC actually allowed PPT to be paid on presentation of a commercial invoice, and if you couldn't get hold of the original bills of lading in time, which of course is very common in energy transactions, they were allowed to present a letter of indemnity. A letter of indemnity which essentially says, I can't get the bills of lading now, but I'll pass them on as soon as I can, and I'll indemnify you in respect of any losses which occur as a result of my failure to produce it. So, in support of the application for the letter of credit, and this is crucial to understanding the case, Zenrock submitted a copy of a sale contract with PPT, showing how much they were paying for the goods, and, crucially, a fabricated contract which showed that the on-sale price to Total, with whom, remember, these goods had started off life, at a far inflated figure, so that when the bank looked at the documents that were presented to it, it could see, apparently, that Zenrock were going to make a fantastic profit from this transaction. In fact, they weren't. They were going to make a stonking loss from the transaction. But it was crucial to getting the letter of credit. No banker is going to issue a letter of credit to its customer to help it in a loss-making transaction, it was crucial that it appeared to make a profit. So Zenrock had created the impression that it would earn a profit under the contracts rather than a loss. It had also assigned the receivables from the sale to Total to Crédit Agricole, but Crédit Agricole later discovered that Zenrock had in fact already assigned the receivables from that contract to another bank. So there had been a double financing of the receivable from Total. So, winding on to the presentation, PPT presented its invoice, a letter of indemnity, which is impossible to get wrong because it's printed out in the body of the letter of credit. That was produced, and the letter of credit incorporated UCP, which, as you will all know, and Vin will have taught you on many occasions, requires the bank within 5 banking days to have either rejected the goods or to have paid. In fact, Crédit Agricole did neither of those things. It had already been alerted by Total that there appeared to be something funny going on with the receivables. The receivables had been double financed. So in fact, on the basis of that, they then did not pay. What they did was, in fact, they didn't refuse to pay, but they sought and obtained an injunction from the Singapore court restraining payment to PPT under the LC, and then the matter went on to the court. So, what did the courts decide, and what was the issues? Well, the first thing that had to be decided is what constitutes fraud in the context of a letter of credit. And really this is one of the perennial issues that we look at in these sorts of transactions. A letter of credit, of course, is an independent contract. It's long been established that in order to prevent payment under a letter of credit by reason of fraud, you have to show dishonest intent by the beneficiary, either in relation to the documents it's presented or statements it's made or otherwise. But the real fraud actually in this transaction had been the obtaining of the letter of credit in the first place. Because without the falsified documents, Crédit Agricole would never have actually agreed to issue the letter of credit. Was PPT a part of that fraud? Crédit Agricole said, well, they must be a part of it, because this transaction in itself is such an odd transaction with the goods going round in a circle that everyone must have realized that something odd was going on. But actually, the court's decision was that these transactions, as odd as they might look, are nevertheless perfectly lawful. All of them involved a proper sale contract in which the goods were going to be passed, in which title was going to pass. All of them provided for payment. There was no fraudulent scheme generally in the transaction. And on that basis, PPT themselves were not a party to the fraud. They weren't, there was no reason for them to have known that the documentation that had been presented to obtain the letter of credit contained a falsified contract with an inflated price. And so on that basis, the court decided that PPT were entitled to be paid, and they were paid. It is a case which I think in general has really solidified the view that obtaining an injunction or defending payment against the letter of credit on the basis of fraud remains an extremely difficult thing to do. The benchmark for proving fraud remains very high. So, part of the fun of these sorts of occasions is that having heard all of the boring legal stuff from a lawyer, and I enjoy just reading this stuff, we actually hear what bankers who are actually touched by these decisions and have to explain them ultimately to their clients. Why am I not getting a credit line? Well, it's because there were these cases, and we're all very worried now about fraud in international trade and how letters of credit used. So, what I'd like to do is to get an idea from the bankers present how they view the result in this Zenrock case. And Khalil, can I turn to you first and ask you what your view is?
Good morning. I find the transaction as very complicated with so many fabrications. However, I think the decision is simple. Presentation of documents that comply or the bank did not reject entitles the beneficiary to payment. There is no evidence or proof that the beneficiary is part of the fraud or could not be proved in the court of law, so it is entitled for payment. This is from a banker's perspective. This kind of decision provides the bankers and the holders of bills of lading with comfort and certainty to do their business.
And I know Vin and I have sparred even on this platform for many years, because as a lawyer, I see both sides of these transactions. I put together a lot of the structured trade transactions that are out there in the market for the big agricultural commodity companies and others, the structured trades, the transit trades, and so on. The vast majority of these transactions are valid and legitimate. Of course, there are a handful where people take advantage of the market's knowledge of the fact that these transactions are out there and they do something illegal. But I think you're absolutely right. The key is there is no obvious fraud here. Many of the parties to these transactions are perfectly honest.
And I should add that the bank which financed or issued the letter of credit, in this case is Crédit Agricole, should have known its customer better than that. They should have known its customer and its customer's customer, because you deal in a large ticket transaction without properly knowing your customer is a high risk. And this brings the question as, what are the incentives for the relationship managers to pass on such transactions? Because maybe they think short-term financial incentives on a personal ground. But this could be harmful for the bank on the long run. Their KPIs should be balanced regarding the fees they bring and the risks they expose the bank to.
Thank you very much indeed. Madhavan, bankers, you made a very good point, Khalil, that of course many of the banks who are involved in issuing letters of credit know very well that they've got clients who are doing these transit trades, these intermediation trades. They know it's happening. They can tell very often by the nature of the way the letter of credit is expressed because of what it will allow. But tell me, Madhavan, from your perspective, what do you take away from this, and how would it affect the way that you would see operations, or what you'd be saying to your colleagues about how they should behave?
Actually, there are multiple things. Okay, while said, Khalil said it's a KYC. Yes, KYC is the fundamental. But when you have a history of transactions over a period of time for a client, the continuous KYC is probably diluted somewhere. Okay, we have seen as a bank, actually in this industry or in the specific trade finance industry over 30 years, we have seen a number of transactions like, few of my colleagues here may remember Solo Industries. Solo Industries is the case which shook the trade finance world, especially in UAE and across the globe, where the similar amount what we have seen in Zenrock, etc., we have seen in 2000, that ICC has come out with a specific case study on that. So that's ever probably, when I started my banking career, maybe 7-8 years by then, we learned, Pradeep Saab may know. Okay, so we were all involved in discussions as a forum. So it's been evolving and it is going. What we see actually, KYC, actually at this point in time with the compliance thing and anti-money laundering thing, KYC, actually we keep collaborating with businesses. We do have cases, like in the previous case where bill of lading, 3x3 bill of lading, 2x3 bill of lading, there are ways to handle. But continuous due diligence on the client, let it be actually how big they are, how big corporate they are, is a mandatory requirement at this point in time. We see big names, actually after so many years, they collapse. Or we see certain transactions like this. And in the supply chain, we also do, actually, we have a supply chain and as well as structured trade financing teams. What we do is all, people actually from business and operations and facilitation team will sit together and analyze. If it is a traded to trade deal, we see a lot of risk. If actually we are part of, as a banker, as a financing bank, if we see, because we have seen coal supplies, okay, and also, oil trading, all those things. But oil trading mostly happened like Zenrock, because the banks actually not given that who is the end user, because that's how the market works like this. As actually Prasad mentioned, that the banker should know, okay, where it is being used at the end. Let it be bill of lading to get a document of title. We presently fight a court case, okay, in one of the actually jurisdiction, where the cargo was released when we were holding the original bill of lading, which is we are holding due course. Generally, we bankers do consider. We finance a huge value cargo, and we thought, okay, the cargo is under our control, but the cargo was released against LOI. While we understand it is a practice, so we should actually, as a banker, in a day-to-day BAU activity, we would not know how to just go and retrieve, how to fight. But we don't, in the charter party bill of lading, we don't find where the ship owner. In one case where we were trying to just identify a case, the vessel, the ownership has been changed. Where do you catch hold of them? So this becomes a challenge, as probably some of my colleagues may agree here. So that becomes a challenge for most of the financiers and bankers. While bill of lading considered as a document of collateral from the credit perspective, we do agree it's a document. But and also actually, thing is in a containerized shipment, things are becoming better. But in a non-containerized shipment, it becomes all the more challenge for the bankers as a financier.
One of the interesting things, you mentioned Solo Industries there, and I've been in the job long enough to have been involved in all of that at the time. But, you know, when the investigators went into Majid Patel's building in Essex, they found one computer, a printer that didn't work, and an empty filing cabinet. But, you know, his business had started off as a genuine business. The interesting thing about all this long list of losses that I described earlier, these were not companies with one computer and a broken printer. We were talking about money lost with major, Zenrock was not a Mickey Mouse company.
True.
You know, Crédit Agricole were not banking them because they'd met them in a bar the previous evening. These are people who'd enjoyed large facilities. So many of these frauds are actually death of company frauds, where people are desperate trying to get the last bit of money out of the system. And really, to some extent, these are failures of bank due diligence, aren't they? Good old-fashioned, go and kick the tyres, have a look under the bonnet of the car. Is there still a real company going on? Are there still real trades? I mean, is that the lesson from many of these cases?
True, that's right. Actually, the thing is, as I said, what we do, what we have, maybe it is an expensive lesson, many of us would have learned as a financier. When we do trader-to-trader financing, that becomes more risky, as I said. So when you know who is the end user of the cargo, even if there are financial losses in the supply chain, we are able to retrieve the money, recover the money. When you do not know who is the end user, that becomes a challenge. Like not only in the present bank, in one of the previous bank in Qatar, we had similar incident. So these are all the lessons. Probably we need to work it out. Okay, while that industry, the pattern, like logistic industry, they work. And then bankers, we need to just align. Okay, understanding, because see, in Incoterms, how many people actually, as a banker, we understand. So we try to just do it because in Incoterms itself has catches. I was actually discussing it on one of the previous conferences. Whether do we know that there are traps into Incoterms when customer use certain Incoterms. When we do a supply chain financing or when we do structured financing, we insist we can work only on certain Incoterms. If the customer brings, okay, where the supplier gets the control of the cargo through incorporating certain Incoterms in the contract, then the second thing comes, vetting the contract and charter party contract itself. Okay, as rightly said in one of the previous session, okay, while documents is a type, bill of lading is considered as a document of title, whether the underlying contract, whether it depicts the same thing, that's a question mark. Like sometimes in some of the court, it helps, the contract does not cover that the bank as a title holder in any way. The contract says otherwise.
I've got an interesting point we'll discuss later about bankers' knowledge of contracts and LCs. But Paddy, can I come on to you? I mean, this is a tale we've seen many, many times. You know, if I had five dirhams for every time I'd stood on a platform and talked about another LC fraud case with similar cases, I'd probably have, I don't know, maybe about 1,000 dirhams by now. But tell me, Paddy, what's your takeaway from this?
Good morning and thanks. My takeaway was one. These fraudsters, they know how to misuse the mechanism of letters of credit by presenting documents which appear to be in compliance with LC terms and conditions, and then they walk away with money. Solo industry, of course, Madhavan has touch-based, was a classic example. At that time, back in 1999, 2000, this was the first major trade finance fraud where more than 26 banks in UAE lost more than $500 million under letters of credit. And he walked away with money by presentation of fake, falsified, and sometime with no existence of the cargo, such bills of lading were presented and walked away with hundreds of millions of dollars. This has raised its ugly head repeatedly after every 3-4 years, at least in the Middle Eastern countries. I'm seeing it happening every 3-4 years. 1999, 2000, it was Solo industry. After a few years, it was Ali Mizan in Oman. After a few years, it was Saad Alman Group. And every time the new fraud or the series of scams come up, you see the amount of the transactions inflating every time. First, it was hundreds of millions of dollars with a big amount. Now we see, common for billions. And now you have Singapore, you had Hin Leong, $3.5 billion outstanding, as you said. Then you had Agri-Trade, another $1.5 billion outstanding. So these two companies alone had $5 billion outstanding towards the Singaporean bank. And this led to, banks like SocGen, ABN AMRO, you said, and then BNP Paribas, trying to or deciding to exit the commodity trade finance market altogether. They were, banks lost money, people lost their jobs, and this happened. Now, what happened in the Zenrock trading? The court ruled that CA, Credit Agricole, had to honor the documents for the reason that the documents were in compliance. Notwithstanding whether the underlying contract was inflated, notwithstanding the fact that bill of lading actually was made in favor of Total. And secondly, as you also, I made a note, you said for fraud to be established, dishonesty by beneficiary has to be proved. So Credit Agricole actually was trying to prove dishonesty on the part of PPT. And notwithstanding the fact that there were a series of the same, like musical chair or something called round tripping of the same cargo being bought and sold to different companies by different entities, and the same cargo comes back to Total at a high and inflated prices. So what happened was the court did not find PPT to have committed a dishonest act by trying to fraudulently withdraw the money from Credit Agricole under the LC mechanism. The court has, I think, touched a passing reference, made a passing reference to Hin Leong. That what happened was in Hin Leong, that had, as you said, ripple effect. Hin Leong failed, which was one of the largest, I think the largest oil trading company in Far East. And when they failed, obviously it had ripple effects on other companies, and they started trying to make more money out of the mechanism of LCs, because the fraudsters know that we can walk away with money by presenting of documents which are falsified and fake. So by fraudulently presenting or misrepresenting the documents. So as a result, I personally had this feeling. Of course, KYC is one thing. Then the transaction due diligence is something which has been coming up, because due diligence or the KYC on the clients very vital. But what about the due diligence on the transaction itself? So transaction due diligence is normally not being done. Whether Credit Agricole was supposed to have or expected to have checked on the price, the last price on the chain of the transaction which was fabricated. They didn't, because they thought they don't. But there is a regulation coming up that banks are also supposed to do. This not only the dual checks of the cargoes and the goods under shipment, but also the price checks. So the price check nobody does, nobody, the banks, they don't do. Volkswagen principles said that it's not possible for the banks to do, price checks. But this is a regulatory requirement. Can you walk away from the transactions? So this is my, I think, and the last issue was the LOI, the issue of LOI. Everybody knows that LOI in lieu of bill of lading is being presented under oil letters of credit, and LOI probably is a comfort. People thought that this is a comfort to the bank, but in this case, it was not a comfort. For the reason, even if there was an LOI, the original bill of lading could not have been presented because it was never there to Credit Agricole, and even if they had the original bill of lading, they could not assert their right on the cargo for the reason that it was with the Total. So that's, this is what I understood from this.
That's very helpful. And I'm going to come up to you, Nezra. You've been waiting very patiently at the end there. And I think one of the things that Pradeep mentioned there was the fact that there've been passing reference to previous scandals. And of course, Solo Industries is something most of us remember. I think one of the key things I recall from that is that at least in a couple of the cases that went to the court in the UK, the courts were pretty concerned that the banks that confirmed the credits knew exactly what was going on or had a shrewd idea of it. And this is something I suppose is ingrained in sort of every banker in the region here. But what was your take on this? You've heard your fellow panelists. Do you agree strongly or disagree with anything they've said? What was your feel for the direction of travel that we're seeing in the courts?
Thank you. It is very difficult to say as a last person, particularly in a case. Everyone agreed that there is no fraud involved. So I don't want to repeat it. But what I find in the court court findings is very interesting. What usually we see in a fraudulent transaction, they look at the transaction, seeing that whether a standard match to decided that whether there should be a fraud exception or not. And generally what we understood as a practitioner that in a fraud transaction, there must be a one victim. But in these particular court cases, the court actually allowed that there is no fraud and Credit Agricole must pay, but they didn't see this particular transaction as a one transaction. The courts actually saw this transaction, total circular transaction as a one transaction. And when they're describing this court actually explaining the things that there is no fraud involved from the PPT side, court saying that since there are no common subjective pretense to do the transaction to deceive others, that means all parties are not in a common subjective pretense to deceive others, and every party want to purchase and sell under the letter of credit and try to get payment and paid under the letter of credit. So that's why actually court actually decided that this is not a fraudulent transactions. So one of the key findings of this court result is that in a circular transaction like this, court actually don't give the result based on the particular transaction rather than seeing the transaction as a whole. So that is actually a key interesting fact what I found from the court case in addition to what other panel members are saying. So that's all from my side.
To some extent, I think the courts have become inured to this sort of structure and transit type trade because, of course, there's a lot of it going on. Do you think that's right? Do you think that's a worrying sign?
Basically, this is a one court case, but I'm not sure actually whether other court case also take this as a whole. But definitely, this is a condition precedence for other court also, particularly if it is happening in Singapore. If court want to decide the particular case, like this circular transaction on a particular transaction, the lawyer may actually take a precedence over this court cases to come into the to actually make his argument before the court. But this is quite interesting to me that the court actually goes beyond the transaction, look at the whole circular transaction as a whole to decide that there is no fraud involvement. So it is quite interesting in that front.
Thank you very much. Now, I know we're hard up on time, and Vin's giving me the sort of passive-aggressive, I think we're out of time look over there. A couple of questions from the audience, though.
Hello?
Hello, I'm Natasha from National Bank of the Republic of North Macedonia.
Welcome.
I have one more general question maybe. In case of a suspicious fraudulent transaction for trade finance instruments, does the bank has an obligation to report the suspicious transaction to the financial intelligence unit of a country before opening a court case? Because if I make a parallel with other payment transactions, that is the procedure. In case of the bank compliance unit to identify a fraudulent transaction, first the transaction is reported to the financial intelligence unit of a country that deals with such transactions and makes additional investigations. And if the transaction is determined as fraudulent, maybe then a court case needs to be opened. And the second question, if after the transaction is determined that is not fraudulent and the bank did not realize the transaction, did not issue the letter of credit, what is the obligation of the bank towards the client in case of financial losses and other losses of lost business relationship with its client? Thank you.
Okay. Well, answering the first question, this is very much a jurisdictional issue because everyone has got different rules. Take in the UK, for example, there are a variety of anti-money laundering, anti-terrorism, sanctions, of course, issues. So there's a plethora of regulation which banks have to fight their way through before they can even do a transaction in the first place. So we're assuming that in a transaction like this, that all of the names, the destinations, the origins, the nature of the goods have been fed through that machine which checks out whether there's anything which triggers any of those sorts of regulations. And if there are, of course, the way that that works, particularly in the UK, for example, there is a specific rule that you cannot disclose to a customer who's bought you a transaction which has triggered one of those suspicious, particularly on the anti-money laundering side. You cannot disclose that you're going to the authorities to tell them. It's what's called a tipping off offence, and you're not allowed to do it. So the answer is that happens almost in a parallel universe. And sometimes you get a very swift response from the authorities, sometimes you don't. But in the meantime, and I think this is the question you're going to, what do you do? And of course, you've then got to make a decision about whether, given that you're in a state of limbo and uncertainty, about whether or not you've got clearance, and what, if you're still in a position not to issue the credit at all, which of course you're always in the position to do that, it's a credit decision ultimately, and it can be swayed by a number of issues. Of course, very different from the situation we had in this case, where the fraud actually came to light long after the letter of credit had been issued, and in fact, as the bank was looking at the documents to decide whether or not to pay. So, of course, those sorts of points, those regulatory, anti-money laundering, anti-terrorism things, hopefully would have fished out a rotten transaction at a much earlier stage. And of course, if you're provided the bank are doing this the right way round, they won't incur any losses because you simply won't accept the transaction if you're worried about it. Nearly all of these letters of credit are issued on uncommitted lines. So in principle, if there is something which does not pass the smell test for a banker when he's asked to issue a letter of credit for a transaction and he hasn't heard back from the authorities as to whether he's got clearance to issue, he can make a decision, usually without incurring any direct loss himself. Hopefully,
If
that
I
answers
may,
the question.
Robert, if I may.
Yes.
From a trade finance perspective, given that this case did involve issuance of a restraining order by the court preventing payment, and the bank did not seem to examine the documents and issue a notice of refusal. This is a practice of many banks, that if there is a court injunction or a sanction, they do not examine the documents and issue a notice of refusal. And later on, if the sanction or the injunction is lifted, they would be precluded from claiming that the documents were not compliant.
Yes. Any other questions before we move on? I know we're running out of time.
I just want to make one comment. I think we are actually discussing on the previous session on the bill of lading title of goods, and we are also now discussing on the LOIs. So for this forum, I think it needs to be clear that in the commodity trades or oil trade, basically there are multiple transfer of the goods. So there may be multiple invoices has been presented to the bank. So it is quite international standard banking practice on that front. But when we look into the particular transaction, not where goods are actually destined to the particular country, not in string sales. So in that case, using of photocopy of bill of ladings and others, basically, is actually, there is a big difference between these two type of trade, which is, in the second case, is very interesting, is related to fraud, maybe the possible case.
Vin, I think we're done. I think we're done. Wonderful. We had another case to look at. We can maybe weave that in later in the programme. Many thanks to our panellists and to all of you for listening in. Thank you.
So now we'll go for coffee, and we will be back. We'll try and be back for 11:30, but I'm sure we'll lose 5 minutes. But if we lose 5 minutes, that's fine. That's fine. Great. Great job, Pradeep. Great session. Good. Good job. Good job. Well done. Yeah. Oh, yeah. That was good. You're very welcome.
দুবাইটা তোলে না এদিকে দেখি এই যে ডায়াসের ইয়েটা তোলে থ্যাংক ইউ
Okay, we'll be starting in 5 minutes. 5 minutes. Thank you very, very much. Thank you. Okay, everyone, we're starting in 2 minutes. Please take your seats. Thank you very much. 2 minutes, please. Take your seats. Excuse me, could you take your seats? Thank you. Great. Okay, everyone, we're about to start. If you could take a seat, please. Yeah. Thank you. Thank you very much, Alex. I appreciate that. Great. Please come in and close the door. Yeah, Thomas, you can come in now. Yeah, okay, let's go. Let's go. Well, everyone, you know, it's always a good judge of a conference if at the coffee break you can hear a hum or a noise, okay? Well, at the coffee break here, it was like a turkey farm, okay? Really, so that is a very, very, very good sign. And just as I was coming in the door, I got a WhatsApp from a friend who said to me, I'm watching you on YouTube and you look wonderful. And I just want to say I look wonderful every day. So, you know, just it comes easily to some people. Okay. All joking, I'm joking, as you know, apart. Okay. We're going to move on to something really serious, and but it's continuing on the theme we're talking about. We were talking about some challenges in relation to bills of lading. That then brought us into court cases regarding bills of lading and letters of indemnity. In the last session, injunctions were mentioned by 3 of our speakers. Injunctions, a court order or action stopping generally in letters of credit a payment. So let's have our conversations afterwards. Can we pay attention? Very good. Okay. So now our next guest speaker, and I want us to be silent, is Pavel Anderle, if he's here. Pavel, you are here. So join me on stage, Pavel, and we're going to talk about we're going to talk about a very serious subject. And we're going to talk about court injunctions, but not about letters of credit. We're going to talk about court injunctions in the context of guarantees, and I guess in particular demand guarantees. So again, like with KP, we'll kind of start at the basics, but build on it. So Pavel, first question just for, you're very welcome, Pavel, actually, sorry.
Yeah, my great pleasure to be here. My first physical event after 2 years for being room locked, so I very much enjoy meeting you physically. I know it's not physical for everybody, but hopefully next time we will all meet.
So you've been let out now for the first time. I hope it's not a mistake, but anyway, let's see. Okay, let's ask you, in terms of a guarantee, could you give us a clear picture for our audience on what is a guarantee, but in particular a demand guarantee?
Demand guarantee, another word for it would be abstract. It is independent, autonomous, separate from underlying transaction, payable only on complying documentary demand. So no other arguments possible, only discrepancies in the presentation.
Okay, it's issued, it calls for a demand or some documentary evidence that's presented, it should be paid on demand. You've explained that. But generally speaking, without too much detail, the purpose in terms of trade, purpose of the demand guarantee.
I think that's really a fundamental question. Many of us would think that demand guarantee, as any guarantee, would be primarily kind of compensation if there is really default in the underlying transaction. So beneficiary can evidence, prove, kind of substantiate, issue, the demand, knowing exactly how much is due. So kind of understanding it is compensation. But I think the primary objective of the demand guarantees, it is security instrument.
Okay.
So basically mitigation, risk mitigator. So without having the guarantee, of course, you would be in trouble and you would have to argue first, maybe in a litigation, getting money. Having demand guarantee, the risk will shift the other way. Now as a beneficiary, if there is dispute, if there is problem in the underlying transaction, you are not happy with the performance, delays, losses looming. At that time, when it's not really yet certain, and you might be finally wrong, and you might not know exactly how much would be due, you have the advantage to get the money, get the funds.
Okay, you use some words. You use primary, you use beneficiary, and then you use advantage. So primary and putting beneficiary together, it sounds like it's leaning towards being very beneficial for the beneficiary. I'm not saying it's not good for the applicant, but leaning towards the beneficiary. What's your take on this?
I do agree. I would certainly see demand guarantee to be kind of one-sided, more favorable advantages to the beneficiary. And we should keep this in mind for demand guarantee to be successful.
Okay, so we should keep it in mind. And if that's what you want, that's what you should get. Like if you're going to give me a demand guarantee, but as a result I'm going to ship goods for you and you don't need to pay me till later, if I'm going to give you a credit line because I have a demand guarantee, well, even though it's in my favor, you're getting a lot of good out of it as well. So Pavel, then in terms of injunctions, we've seen a spike in injunctions over the last 2 or 3 years. But in recent times, I guess an injunction isn't your favorite animal when it comes to demand guarantees.
Certainly not. I don't think we like injunctions unless we are applicants or advocates working for applicants. But certainly we understand and kind of appreciate there is established exception to that independence in principle. So in case of fraud, I would assume everybody would agree that this is kind of cause for that limited intervention into independent demand guarantee scheme.
Yeah, I think you're right. And in our previous session, Robert, our lawyer, like he brought in certain words: dishonesty, honesty of the beneficiary, active kind of dishonesty, planning, manipulation, manifest fraud. So this word manifest fraud, like, what do you think it means, or what does it mean? I think you know better than I do. You know.
I think even ISDGP is using that word manifest.
What is using it?
Manifest and clear
Okay.
fraud. So, of course, I'm not experienced lawyer in that field, so my kind of view would be a bit simplistic from practitioner point of view. But certainly it must be blatant, it must be evident, it must be proven without any doubt, so more or less fraud has happened, or it's almost certain, then I understand that injunction would make sense.
Okay, so making sense. So I'm beginning to pick up that you don't like injunctions, you're not in favor of injunctions. If it's a demand guarantee, it should be paid on demand. But there may be instances where a temporary stay on payment or injunction makes sense. Would you feel that way in certain instances?
Yes, with manifest fraud, maybe we can try to define a bit more.
Yeah.
So certainly, a kind of example I would take would be, of course, falsification, fraudulent document as such, or fraud in kind of material fraud. So beneficiary knows there is no conceivable basis for him to claim. So.
Okay.
This would be these kind of manifest fraud situations.
Okay, that's okay. I think that's clear enough and substantial enough. So in terms of demand guarantees, we are actually seeing an increase in injunctions in recent times. And maybe I can ask you to just share with us what are the nature of these injunctions? Like most international transactions, we'll have a counter guarantee and we'll have a local guarantee. The counter guarantor will have requested the local guarantor to issue their local guarantee. So there's a pattern evolving, okay, in these injunction cases. Maybe you can share, because I read your article in DC Insight, it was wonderful, but can you share some of this with the audience?
Yeah. So far we don't see big number of injunctions coming in my country, in my region, but certainly because of COVID, there was a lot of subsidies from governments and so on. So I think these problems are kind of escalating and looming. So most likely there will be more, disputes, and also we have more troubles than just COVID in many parts of the world. So it's very likely that these cases will come up. Of course, we are worried about injunctions which are in our view, improper, so it's not manifest fraud, but just disputes in transaction. And what you kind of aiming at, I think what is a real very troublesome trend, we can even say, from ICC point of view, because in the last 2 or 3 years, there were only 2 or 3 ICC opinions on demand guarantees, and both were actually dealing with counter guarantees, guarantees and counter guarantees subject to URDG, and both were related to injunctions. So I think this is extremely problematic and troublesome. If you have independent guarantee and counter guarantee, there is complying demand under guarantee. Of course, bank in good faith pays or must pay, and then in good faith they claim under the counter guarantee, and then there is actually injunction against counter guarantor to pay under counter guarantee, claiming there was fraud. I think the only workable situation for me to kind of see that intervention would be if there is fraud actually in that counter guarantee. So basically the guarantor, beneficiary of the counter guarantee, would have paid in bad faith, knowing that the beneficiary committed fraud. Knowing. Otherwise, I don't think there should be room for.
You're very articulate. Like knowing, aware, being aware is really the key. And you're kind of identifying the most common problems at the moment are where A contractor wins a contract. He's required to provide guarantees in a foreign jurisdiction, whether they're advance payment, but performance is the easiest one to understand. So there's a counter-guarantor, a big contractor, big country, asking local banks, small country, and I know someone in this audience has this problem, local bank, local country issuing a local guarantee. Everyone is happy at the beginnings of these transactions. It's like a romantic story, okay? Romance doesn't last long. Story of my life, actually, you know. But anyway, what happens then later is that there's a dispute, maybe a little dispute, or maybe no dispute. And what happens is the local beneficiary makes a claim under the local guarantee, as he is entitled to. The local guarantor examines the demand and he pays as he's entitled and was authorized to. But the moment he makes the claim under the counter guarantee, within 3 days, there is a local court injunction. And quite honestly, I'm no lawyer, I'm no expert, but most of these cases I've seen in recent times, no evidence of fraud whatsoever. Now, I can understand a court issuing a temporary injunction, temporary stopping, if something looks suspicious. Now, I'm not saying it's right or wrong. I can understand it. But I'm looking at temporary injunctions that are in place 2 and 3 years. Okay? So these are not temporary injunctions. These are temporary injunctions. Okay? Yeah. So getting back on track, we have the ICC publication ISDGP, International Standard Demand Guarantee Practice, which is very useful, some very, very useful paragraphs. Can you tell us what it says, first of all, about if a guarantor has an injunction stopping them for payment and it does not appear to be valid? Just, yeah.
Actually, ISDGP, during the process of formulating, came with this idea. So it was not at the beginning. Yeah. I think it was requested by ICC Belgium and other practitioners. I think it was a really good idea to look at it from kind of practitioner's point of view, what the bank should do. There are 2 or 3 paragraphs kind of highlighting what the fraud, manifest fraud kind of situation could be, or kind of.
Yeah. But what does it does give some guidance on what a bank should do. What is it?
I mean, with this fraud, there is guidance, not trying to say what the fraud is, but kind of making a reference to UN Convention on independent guarantees and standbys, where there is good stuff, you know, kind of codifying what is the standard of that manifest fraud. And also ISDGP covers injunctions as such, which actually ISDGP says that, of course, you must follow what the court says. If there is injunction, you must follow it. But basically, firstly, you should inform the beneficiary. You should give them the application or the order. You don't need to translate whatever, explain whatever, but we should keep the beneficiary informed. And also, which is quite a demanding task, but I certainly agree that the bank should look at the merits, and if they feel it's not fraud, we should kind of challenge it or seek to resist, which is good call on banks to really keep the reputation of themselves, of their jurisdiction, of the independent demand guarantee as such. So kind of explaining courts, you should be extremely careful to intervene into that independent instrument.
I think you're right, and but we all have the benefit of this event is we have different views, different positions. That's why we discuss. But my experience is that if the bank's main customer is this construction guy or whatever, and there is a court injunction stopping the payment, well, the bank can't pay as you've articulated, but the ISDGP kind of says we should take some action, but my experience is banks don't take any action, and this is something we must look at. But I'm going to ask your final question is, what if a bank is suffering as a result of one of these injunctions, is there any further steps you could recommend?
Certainly as a counter-guarantor, you can suffer a big way because of your corresponding relationship with the other bank. Of course, you can suffer because your customer suffers. So I think, first of all, banks, we should really explain our customers what independent guarantee is. They should do the due diligence on the counterparty to see the likelihood of default, to see the likelihood of abuse of the guarantee, to advise them how to draft the guarantee well, to minimize the likelihood something will be challenged as a lie, as a fraud. So I think it also very much depends what the guarantee requires, what the statement of default should be, how detailed should be, or how general. So if you are beneficiary, you have simple demand guarantee, without any statement of default. Of course, most likely there should be no fraud exception even being considered. But if you are supposed to say exactly that you are entitled because of this clause in the contract and even substantiation of that amount, then of course you kind of open the room for challenge and argument. So it also depends how guarantee as such is formulated.
So you're very passionate about it, and I know you feel we need to do something about it, and I agree we need to do something about it. And someone has their hand up for a question, but we're actually going to take questions just at the very end because they're connected subjects, the next three subjects. So if you don't mind. So we've talked about challenges with business-leading LOIs in our first session, and then we talked about court cases regarding letters of credit and fraud, or allegations of fraud. And here we've heard about the injunctions, and very often it's due to an allegation of fraud. But so we need to find out how we can spot these frauds and how maybe get some intelligence that we can use better in our day-to-day business. So I'm going to actually say thank you to Pavel. It was a wonderful session. Can we give him a round of applause?
Thank you.
Wonderful. And we're going to hear now about a really interesting initiative here in the UAE, and that's UAE Trade Connect. So maybe you will join us on the podium, and we'll let you move forward with this very interesting session presentation. Pavel, we can.
Thank you. Thanks, Vince. That was indeed an excellent session. Can we just get our slides up? So while they're loading up the slides, my name is Zul Javed. I'm resident here in the UAE. As I work for the company called UAE Trade Connect. It's a new initiative, and the reason we're presenting it here today is we thought, since there are so many bankers in the room coming from different countries, we'd like to give you a sort of a case study, a successful example of how collaboration can help to solve some trade finance problems. What you see on the screen are the logos of the 8 banks which are already part of the consortium operating this platform to help de-risk invoices that are presented to them for financing. I'm going to be presenting a short video as well which shows how the system works, and to answer one of the early questions in the room, it does use a blockchain. Blockchain is at the heart of this solution. And I actually have a good page that explains all the different technologies that are coming together to make this system work. I'm using the clicker. I'm not sure why it's not working. Is that working? No? Okay, too many. Okay, so very short agenda. I won't be up here for more than a few minutes. It depends on how many questions you ask. I've allowed 5 minutes for questions. So the first question is, what problem are we going to tackle first by bringing banks together? Which is the problem that we'd like to tackle first? And the answer is always the easiest one. The second thing we're going to talk about is how co-creation has worked. Co-creation means collaboration, not just of the end participants, but also of the technologists and the other participants in the ecosystem. So we're going to be talking about co-creation. As I mentioned, we'll be talking about the technology enablers that have allowed us to build this system and make it a success. And then as we finish, after telling you the results we've found in the 10 months that we've been live, we'll also be talking a little bit about how we believe the platform will evolve in terms of use cases and creating more linkages to sources of information. Time allowing, I do have one example of how the system worked to identify a duplicate invoice which was presented to 2 different banks. And if time allows, I'll show you the flow of how that's worked. So as I said, which problem to address first? The easiest problem is probably the one that plagues banks the most, and that is of duplicate financing. Somebody takes an invoice to one bank and says, can I please get factoring on this, or discounting, or an LC, or some other kind of product? Please finance my invoice. And then a couple of weeks later takes the same asset down the road to another bank and says, can I please have some financing on this? And of course, these banks are in competition with each other, so they're not likely to check with each other. And certainly, even if they understand that they have a party risk, that the same party banks with both of them, they certainly don't know whether the transaction has been presented to two banks. So this form of fraud over financing has been going on for decades, maybe centuries. How can banks solve this problem? So luckily, because of two things, one is the combination of technologies, blockchain, AI, but secondly, it's the willingness of the participants to work together to solve this problem. And today's case study is really much about that. Just a point about the third element. Yes, we're checking for duplicates, but at the same time, since invoices are being presented to our blockchain-based solution, we're also testing them under the instructions of the banks for whether there are indications of fraudulent documents involved. So there's been a lot of talk today about fraud and how they could have been prevented. We inspect invoices for duplication. We compare it against the blockchain to see if other banks have done this, have financed it, but we also inspect to see whether there's some indications of fraud within the invoice data. We'll explain how that works in a little bit. So what I'm going to do, I'm going to ask our colleagues on the AV to present this video. It runs for about 2 minutes. It shows you how the system operates, and it explains how the blockchain comes to play to protect bankers' information.
UAE Trade Connect is an award-winning, consortium-led, first-of-its-kind digital national trade finance platform featuring cutting-edge technology based on blockchain, artificial intelligence, and machine learning technologies. The first use case offered on the platform is the fraud detection and identification of duplicate invoices financed by banks as part of their trade finance offering. Here is how UTC adds value through 5 simple steps. 1. A bank submits invoice information into our private permissioned blockchain platform through their node. 2. The selected information required for fraud detection is replicated to the UTC node using smart contracts. 3. This information is then pushed into the fraud investigation engine, which performs duplicate checks and risk assessment. 4. Based on the fraud checks, the bank will be notified as follows. A. Pass, clean invoice which may be financed, or B. Fail, major issues identified or a duplicate invoice. Do not proceed. Or C. Inspect. Bank's further investigation is required since a high-risk score has been determined. 5. Final action taken by the bank with respect to financing the invoice is securely saved onto the blockchain. The selected invoice data, risk assessment outcome, and the final action taken by the bank is chronologically stamped onto the blockchain network, and that, combined with the immutability of data, ensures tamper-proof and distributed storage of sensitive information. Etisalat Cloud Services hosts the solution within the United Arab Emirates, ensuring compliance with central bank's regulations. The central bank has also endorsed UTC's unique proposition as well as data sharing architecture among banks. UAE Trade Connect benefits both banks and their clients by reducing fraud, enabling the banks to share knowledge of duplicate invoices without sharing any sensitive information, enhancing finance for corporates and SMEs. UAE Trade Connect, built by the banks, for the banks.
So I hope everybody got a good idea of how the system works and how easy it is for banks to interface with the system. Today we won't be talking about how banks are actually integrating the system. Some have gone all the way to API so that it's linked seamlessly with their own systems. Some are using some kind of electronic interface. Some, the smallest banks, are actually using a user interface, but we're not going to be talking about that. I'm not here to sell you any solution, I promise. We are here to explain how co-creation works and the idea that banks working together to solve an industry-level problem is a good thing. So just again to repeat what it is that we are featuring in the UAE Trade Connect platform. So we have the power of blockchain. Blockchain is a very, very important element here because what blockchain does is it allows transparency and trust without exposing any data. Everything is hashed, which means your data as bank A is never seen by bank B, is never seen by bank C. At the same time, the blockchain knows whether data of a certain invoice has been seen before and can flag up whether it's a duplicate. You remember the last step in that video, which said the bank has to stamp the status of the invoice onto the blockchain. This is really important because what it says is, I have financed this invoice. Nobody else should do that. On the other hand, there is also a status called purged, which says, I have looked at this invoice. I've decided not to finance it, which means the customer is allowed to take it to some other bank to get financed. So we're not restricting banks in any way. We're not killing off the potential to win business. Customers have the right to take their transactions to different banks. So this is very pro-competition. It's not anti-competitive. And that's why, and I'm going to come to it in a minute, that's why co-creation has worked so well, because banks came into this discussion before we had a solution. Banks came in to solve the problem, to explain to us as technologists what they wanted to see in the system. The second feature is that, again, we've addressed the most compelling use case, a very common problem, which no bank can solve on their own. The third feature is this growing network of banks. So we started our program with 7 banks in the consortium. A couple of them are here today. I'd like to call out Madhavan from National Bank of Fujairah. NBF has been instrumental in this program. 7 banks came together. Today we are 8 banks. Next week we're going to sign our 9th bank. And by the end of this year, we believe about 15 of the UAE's banks are going to be on the system, which includes some of the very, very big brand names. The central bank has been involved with us from before we went live. They wanted to ensure that we were compliant. They wanted to ensure that customers' data was protected. They wanted to ensure that the problem that we're solving is in the favor of the industry. It's important to note that we're solving a problem today, but that's not the end. The most important part is linking up the banks in a secure blockchain-based way. We plan to have more use cases. So for example, KYC. If one bank has done a KYC on a customer, do you really think it's a competitive advantage to have some other bank do the whole KYC again? Or can we link up the banks in a way that supports each other and supports the customers? We do have an ambitious roadmap. At the end of this presentation, I'm just going to explain it in about 30 seconds. I'm not going to give away all our trade secrets. And very importantly for us, now that we've had success in the last 10 months, the central bank and the Ministry of Finance in the UAE believes that there is a place for us in the national financial infrastructure. So just like you have credit agencies, credit rating agencies, just like you have payment switches, there is an idea that this trade finance network could be part of the national financial infrastructure to serve the industry better. And of course, it's a very scalable solution because now that we're all working on cloud, there's never a problem of, is there enough computing power? Talking about co-creation, and I want to go back, my next slide has a timeline, but I just want to go back to where we started this program 2 years ago, 2.5 years ago. The first place was to say, what is the problem we want to solve? We didn't come with a solution and say, hey guys, we're a fintech, we can solve your problem. We didn't pretend that we have domain knowledge. We didn't pretend that we were experts. What we said is, let's work together on problems that are important to you. We then start ideating those opportunities. We, as a technology company, we facilitate the discussion. We help the banks to put their requirements out, to explain what kind of frauds they've seen in the past. Alhamdulillah, the contribution of the banks, each person in the room might have had 20, 25 years experience. There were probably 2 or 3 experts from each bank, multiplied by 7 banks. So you've got hundreds of years of banking experience, not just from one market, but from multiple markets, all contributing ideas and explaining what kind of frauds they've seen before and how we can help to solve them. We then move to a proof of concept, and this is a really important stage because especially when you're working with new technologies, you don't know if it's going to work. You don't know if you can solve the problem. And once we have the proof of concept, it takes 2 or 3 or 4 months to really understand whether it's going to deal with all the different test cases, all the different scenarios. And that's when we start talking about scalability, because it's all well and good doing this in a lab, but how do you get it so that it's integrated in real time with all the banks and their super fast requirements? If you're doing a trade finance deal, if you're trying to finance a customer, you're not going to tell the customer, well, present me your invoices and I'll give you an answer in 2 days. The customer wants speed. You have a business process. We have to respect that business process. So scalability becomes a big challenge. But because it's cloud-based with very modern architecture, we're then able to industrialize the solution and launch and operate. So the way we're working in the UAE, we've set up a separate company, and each of the banks are consortium members along with us. And so they have a continuous say in the way that the platform operates. Yes, they are customers, but they're also members of our steering committee. They're also they're driving the next development and the next phase. And just to re-explain the roles of that co-creation phase, the banks bring all of the domain knowledge. We don't pretend that we know any of this stuff. And what we do is we put it together. We find solutions from the market. We find what piece of AI can be used here. What should be image processing? What should be logic? What kind of rules should be deployed? We work with the banks, and then we do 6 months of testing. So I'm just going to show you the timeline. And once again, I want to give credit to the 7 banks that were involved in the co-creation phase. 8th bank joined last month. 9th bank is joining this month. So this started in 2018. The concept came about 2.5, almost 3.5 years ago. Then it took us a little while to pull together the consortium. And it wasn't until 2020 that we were able to get the central bank interested that this solution might have legs. But once they joined, it really helped us, because when the central bank joined the steering committee, it legitimized this as a industry level solution. By the time we reached the end of 2020, and I want to talk a little bit about the pandemic. I want to talk a little bit about the pandemic here. We were ready to go testing. 2020 was a make or break year. It could have been the end of this project, because instead of having physical workshops where people had to come, all of a sudden this became a digitization effort. Number one, we were able to convene our workshops and meetings over Zoom or Teams, which meant participation was even better than it had been before. And the second reason is because a big element of our platform is about taking physical documents, invoices, and digitizing them if they aren't already digital. So many of the banks were able to prioritize this as a digitization program. Another benefit that's happened for banks is that in the year 2020 and 2021, I'm sure you've all had the same experience, frauds increased. And because frauds increased, a risk mitigation platform went up the agenda. So the fact that we reached the end of 2020 with a platform that was testable and ready for stress testing, it took us about 6 months, and then we were ready for launch. So when we launched, we went public in a big way, because this is not just about finding frauds, it's about preventing fraud. So we actually, with the help of all the banks, we made a nationwide campaign to say, if you're in the business of defrauding banks, now is the time to stop. As I mentioned on the last page, we have been proposed to be part of the national financial infrastructure. And for those of you which are coming from different countries, if you're going to look at solutions like this, I would encourage you to work with your regulators or with your banking federations to ensure that you get the same kind of cover. UTC, UAE Trade Connect, could not be successful without the help of the government authorities. It's a big element in our success. Looking at the results so far, and I have to stress that we had a slow ramp up, because not every bank was ready in the first place to really put their volumes through the system. We've now reached a point where we've crossed 6 billion worth of value presented to our system. The average invoice size has surprised me. I thought that invoices were generally quite small, 10,000 dirhams, 20,000 dirhams. It seems that the range of invoices going through the system, and a lot of this is open account, I should stress, a lot of it is open account. Some of them are $1 million, $2 million, $10 million invoices. The average is $54,000, which means that even if you catch 2 or 3 frauds, you're doing very well. And what have we found? We found that the number of banks presenting duplicates to the system, this number is more than $100 million out of 22 billion. Out of $6 billion. What happens is 2 or 3 different scenarios within a bank. Either the bank has been presented the same invoice by their customer more than once. So the customer only has one banking relationship but is taking advantage of that bank. Or, alternatively, the bank may have done a partial financing and they are now being presented this for the second time. So what the system does is it flags up and says, hey, I've seen this invoice before within your bank. Please take a look and understand why. And sometimes they proceed to finance it. They finance it because they only did a partial financing the first time around. Sometimes they say, actually, we won't finance it again. We financed it before. Interbank duplicates. This is the bee's knees. This is what could not be found without this system being live. During the history of UTC, we've had 10 months, out of which, if I'm honest, we've only had about 5 or 6 months of real good, solid usage, and we've already found 5 interbank duplicates. The biggest one is 2.4 million dirhams, which is about $600,000 or $700,000. That's a pretty big value for somebody to present to one bank and 3 weeks later to present to another bank. On the other end of the spectrum, we've had a 17,000 dirham invoice, which is only $5,000. But the fact of the matter is that we have bad actors, and those bad actors are going around presenting invoices to multiple parties. I want to spend a minute on this one. This is about counterparty invoices, where there is one invoice, it's not a fraud. A buyer has taken this invoice to their bank as part of their supply chain financing. A seller has taken this invoice to their bank as part of their invoice discounting. Now, we've had 2 kinds of situations. The first is where the supplier goes immediately to the bank and says, as part of my routine operations, I've sold X amount of goods. Can I get some financing against my receivable? Great, this is good business. A couple of months later, the buyer goes to the bank and says, I need to now settle my supplier. And he goes and provides his invoice, the same invoice. It's a legitimate, problem-free transaction. In fact, it's the best kind of transaction because you've got 2 financings, which means 2 banks are winning. But what's happening is we, as an industry, have never really understood the size of this. We've never been able to say, these particular transactions, single transaction is being financed from both legs. Now we have that ability. There's a converse to this, which is a little bit less kosher. And we've had this scenario just last week. So we had the buyer, let me get this right, let me get this in the right order. Yes, the buyer took financing on the basis that he's going to pay his supplier. 5 weeks later, the supplier came for financing. Again, it's a legitimate transaction, there's no fraud, but you got to ask yourself, if that buyer took the financing and didn't pay his supplier on time, why? Is there a stress in the buyer's financials? Is he cycling that money somewhere else? So, this kind of visibility, which was not available before, is, for the first time, it's become available. Just to finish off this slide, we also do, as I mentioned before, we inspect the invoices for markers of fraud or some different kinds of rules which the bankers have helped us to define. 2/3 of the invoices come out as completely risk-free, go right ahead and finance them. About 30% have low risk, which means they're triggering 1 or 2 different rules. Nothing to be worried about. But there are 2% with what we call critical risk. We have multiple rules being hit, and we would encourage banks to take a look at those invoices and study them before providing financing to their banks. As I mentioned here, we have about less than 1% of invoices, so a good number of invoices that have been seen by the system before. We have two kinds of match. We have an exact match and we have a fuzzy match. Fuzzy match uses AI to determine whether it's more than likely that this invoice has been presented elsewhere. I will be taking questions at the end. In fact, I only have 2 more slides, I think. I only have 2 more slides. So here, I want to talk about the enablers that have allowed this system to become a reality. Blockchain is the key. Blockchain allows participants to share information without sharing data. It creates trust, it creates transparency, it timestamps everything. So if Bank A has presented an invoice and financed it, and then Bank B has presented the same invoice and financed it, our blockchain will say, you can't do that because Bank A got there first. On the other hand, with blockchain, nobody can see what's in the data. Even we can't decrypt it. Once it's on the blockchain, it's stamped. And it's just an ever-growing hash of information. What does happen is that the blockchain validates that nobody's tampered with the earlier information. So this is one of the keys, and we have what's called a private permission blockchain. It ensures that only legitimate participants are in the chain. Because of the way that we've constructed our system, every bank gets its own node. It becomes a peer on the blockchain, which means everybody has equal power to call out whether the blockchain has been tampered. So it doesn't matter if you're the biggest bank in the country or the smallest bank in the country. If you're a participant on the blockchain, everything is equal. The other big one is, of course, AI. With the amount of data we're handling, AI is very, very important. No human being can sniff out whether an invoice seen 7 months ago is a duplicate of one that's been seen today, especially cutting across multiple banks. So AI is a big part of that. Machine learning is important because at the moment we haven't yet crossed into the millions of invoices, but once you do, you need the system to learn from itself. Cloud is really important. Our company is sponsored by Etisalat, which is the local telecom company. Etisalat owns its own cloud, which is UAE resident. The reason cloud is important is because when we want to add a bank next week and we want to add another bank the month after next, we don't need to have a big 6-month procurement cycle. It means we flick a switch and the cloud infrastructure is available. And it's really elastic. Elastic is important because what happens towards a month end when lots and lots of your customers are coming to you and saying, can I please get financing against these tens of thousands of invoices? All of a sudden the processing demands have gone through the roof. So it can't be done unless you've got cloud as part of the infrastructure. And of course, cybersecurity. 2 good things about the way that our system is constructed. The first is that no bank's data is shared with any other bank. So that means whatever risks you have in your own network are common. Those are the same risks you have as a user of UTC. The second element, and this is really, it's kind of a cross between blockchain and cybersecurity, because it's completely hashed, that data, even God forbid, if somebody could tap into the blockchain, they can't decipher it. So you've got protection built in from the ground up. So we've got this, all of these are part of our DNA. This solution is built by banks with the help of the InfoSec teams of the banks. And this is what I was saying to Vince as we were running into this, coming into this program. The whole point of what we've built is that it's not a solution that we designed as a fintech and came and said, guys, let's help you solve your problem. Every bank would look at us skeptically. They would say, are you sure? I'm not sure if you understand. By being part of the collaboration, it starts from the word go. I think this is my last slide. So this is my last slide. So where do we go from here? What we want to do, having solved this use case of deduplication, we want to enhance this. Now, there's 2 kinds of enhancements. One is more banks, because the more banks you have, the less of a blind spot you have in the industry. The second is, what can we do as more and more invoice data is loaded into the platform. An example, if the banks are able to give us the line item detail, we can solve that problem that was being talked about earlier. Price checks. You want us to go away and check the price of steel billets on the 15th of April last year? We can do that. But the data has to be in our system. It has to come in through an interface. Another example would be, let us link to the supplier's, let's link to the supplier's bill of lading. If we can ingest the bill of lading and tie it up with the invoice number, we can then confirm to the bank that the invoice that you've financed has some goods associated with it which have moved. And then you start to track and mature the system that says, actually, we'll track the bill of lading all the way till discharge. It's a far cry from where we are today, but it is the plan. Down here, what we want to do is link up with authorities. So we've got port authorities, customs authorities. All of these will provide corroborating information to confirm that the invoices and the shipments are legitimate. One of the big problems you guys have as bankers is, I'm financing something, do the goods exist? Well, actually, if you have customs clearance, there's a better chance that they exist. If they were discharged from a port, there's a better chance that they exist. So all of this information coming from port authorities, customs, and indirect taxation authorities will be helpful. Moving along, we have some international networks, you're all familiar with these names, which we'd like to link to. And there's a symbiotic relationship. As much as we get access to their participants, they, in one shot, can get access to 8 or 10 or 15 banks which are using our platform. And ultimately, we want to get to where we are, where we've got more and more use cases, as I mentioned before. We don't want to be just in the invoice protection business. We want to use the network we've created to support banks with lots and lots of different use cases around that. And then there's some ideas around, well, actually, should we just open it to the end customers? Should we let end customers input their information directly? I'm gonna stop there. Vince, how are we doing for time? One or two questions? Okay. Khalil.
Thank you so much for this wonderful presentation. I like very much that you found blockchain applications for... You can start, please.
Yeah, thank you so much for this wonderful presentation. And I like so much that you found blockchain applications for trade finance, blockchain was predominantly confined in the banking operations to payments. So this is an advancement. I also admire your philosophy of collaboration. And I wonder if you have collaborated with customers as well, not only banks. And the second question is, have you considered phantom invoices, fake invoices? Because this relates only to invoices, at least one invoice that has an underlying asset.
Yep, it's a very relevant question, absolutely. So to answer your first question, we have not collaborated with customers, and some future evolutions of UAE Trade Connect, we might be doing that. But this is a club of banks to help us solve a banking problem. Yes, there's a big problem, or potentially a big problem, with phantom invoices. And the way that we intend to solve that is, first of all, we rely on our bank's knowledge. It is you, as specialists in the banking industry, who will tell us how to solve this problem. Technologically, we know how to do it. We believe that if you can link up logistics companies and shipping companies, that gives you corroborative evidence that there is genuinely, but you and I both know that there can be containers full of dirty cardboard, but that's not going to, but what we are doing is about mitigation. It's about mitigation.
Okay, so good morning, everyone. My name is Ini from Union Bank of Nigeria. So I want to find out what you're trying to put in the UAE Trade Connect. Does it expand to African banks, or is it just for banks in the Middle East or in Asia? Because right now, from where I sit, I don't see us, play so much in that space with banks in the Middle East. So one of the strategy, I think, is for us to diversify from relationships with Europe and UK and have other banks in our books from UAE and Asia. So that's,
Okay.
that's my question.
It's a good question. So at the moment, and once again, it comes from where we were born from, our solution is specific to UAE. Having said that, the technology is replicable. Now that we know the technology works, we can take the same technology. If Nigeria can organize 3 or 4 or 6 banks to work together, the technology works. We can transplant the technology and set up a Nigeria Trade Connect. As far as cross-border is concerned, some of these networks already trying to address that issue. So Marco Polo, Contour, these are international players trying to link up the normal trade routes like Hong Kong, China with Western Europe. And more power to them. Inshallah, they'll do well. But we see too many gaps. You can't potentially link up all the participants across all those borders. So we take a view that having a national play is more secure, particularly, especially as we're finding in the UAE, a lot more trade is domestic than it is international. So we would recommend that for any country that wants to have their own Nigeria Trade Connect, Qatar Trade Connect, Saudi Trade Connect, technology is available. We can work with you, and I'm sure we can create some kind of a solution there. In fact, what I've done, we'll just put our contact information on the screen. Yeah.
Yeah, thank you. Hi. Thanks, Ben. This is a wonderful initiative. We want to congratulate you on what you put together.
Thank you.
This is incredible at helping banks with compliance checks. And I'm here with my colleagues actually as a vendor that provides a compliance checking solution. We're in the fintech space. TradeSun, yeah. So the question we have is, what's your appetite and openness to working with fintech vendors to deliver these solutions across Africa? We have customers live in Africa, United States as well. Interested to hear your thoughts.
Yeah.
Thank you.
Since it's almost close to lunchtime, appetite is good.
Nice.
But yes, we are. So look, the way we're working is we're not bloodthirsty fintech coming out to, aggressively go to every country. However, we're very happy to partner. We are here to serve banks. In fact, our tagline, which we didn't play today, is built by the banks for the banks. We're going to partner with lots of different players. The idea is to improve and raise the standard of protection for banks. The difference between this and most other fintechs is this is entirely collaborative. It's for profit, I should stress, it's for profit, but it's collaborative. And that's why it's been successful. Because otherwise you end up with really cagey participants, people who say, well, I'm contributing more than the next guy, that guy's contributing less than me. Vince, I think I've eaten into your time.
No, you're okay. You're okay. We're on time. But just a final summary, and away we go.
Yeah. Okay. So on that note, I'd like to thank everybody for your attention, your questions. I'd like to thank Vince and the ICC UAE for inviting us, because we weren't initially on the agenda, but once they got to know that we have this thing to offer, we're not here to sell. I'm not here to sell you a solution. We're here to inform you that this kind of thing has been successful. But the way to do it is to have a collaborative approach. Today it's banks. It could be, there are different initiatives led by shipping companies that try and mitigate fraud and enhance financing. Okay, good. That's my time.
That was a really, really wonderful. And as we heard from Zula, the lunch is coming up, But you're not going, sit down, okay? We're not going for lunch yet, because I am your appetizer, okay? And I know that's pretty tasty, but I'm your appetizer. So what we're going to do now is we're going to give you a presentation on the UAE Guarantee Facilitation Project. So I'm going to ask Divish from HSBC and Tom from China Systems to join me on stage. And I think we have a presentation that we can open up there. Habib, if that's okay, we get going. Great. And please join Divish. Yeah, and Tom, just take a seat. Yeah. Get comfortable. So, as you know, I'm the Director ICC UAE, And as we heard from our chairman this morning, one of the things he's proud of, because he played a large role in it, is working on the UAE Guarantee Facilitation Project. Now, I'm going to tell you about the project, and my colleagues here are also going to give you some insights on the project. So let me tell you about the Guarantee Facilitation Project. It's like this. As we heard from Pavel, guarantees should be payable on demand, and they should have an expiry date or an expiry event. And the commercial law in the UAE is very effective, and it provides for guarantees with expiry dates, and the commercial code also provides for guarantees with expiry events. So that's wonderful, okay? But also guarantees can be issued and are issued in significant amounts without an expiry date. And these are called open-ended guarantees. Please, could we stop the conversation? Please? Excuse me? Excuse me? Thank you. Okay, so we have guarantees that are open-ended, which means that there's no expiry date. So it means the liability goes on until the guarantee is returned by the beneficiary. And years ago, this was not so much a big problem, because when a bank issues a guarantee, it has to allocate capital to cover the guarantee. So if the guarantee is going on forever, okay, well, capital is being wasted that could be used for better purpose in the local economy, okay? So is there something we can fix about it? And we felt there was. But, you know, everyone has been talking about it, but we had no data, okay? Lots of people talking about data. So we did a survey, and the survey of the banks. And thank you to bankers who are here, and especially the UAE Banks Federation, because without your help, I don't think we'd ever been successful. But I'm going to first of all give you some key findings of our survey. If the lights come back on, of course, okay, okay. And, sorry. Oh, we're back. Okay, great, great. That's wonderful. Okay. I thought I was going to have to say we have a force majeure, you know, and then we'd have another debate, okay? But let's move on. Okay. We decided to do a survey, and that survey would focus on a number of key questions. And these questions are appearing on your screen, okay? We would look in the UAE at the guarantee wording, terms and conditions. We'd look at the application of international demand guarantee rules, such as URDG 758, as mentioned by Pavel. We would look at the volume and value of open-ended guarantees, open-ended without expiry dates or expiry events. Then the really tricky one, which Divish is going to actually illustrate later on, bank guarantee exposures and risk-weighted assets. We looked at bank guarantee practice in the UAE. We looked at technology to a limited degree, and that was digital or paper-based processing of guarantees. And of course, we followed on with looking at the automation and the use of advanced technology, requirements for manual wet signatures, guarantee warehousing practice, the use of distributed ledger technology, okay, which has been mentioned by a few people already, and blockchain. So I'm going to give you the feedback on all the points except for one. Number 4. And it turned out in our survey that number 4, bank guarantee exposures and risk-rated assets, while everything was of interest to the bankers, the banking community, this one was the one that everyone was really interested in. So I'm going to give you the not-so-exciting figures, and then Divish will take you through the real substance in our presentation. So we kind of asked some questions. We asked the banks, please select the statement best reflects your views on the guarantee wording used in the UAE favouring various beneficiaries. And Pavel already highlighted the importance of terms and conditions. So we got an interesting answer, an interesting takeaway. 91% think it would bring material efficiency benefit if standard simplified formats were implemented with express conditions and stated expiry dates. Now, standard wording doesn't mean you can't change anything, but you start with good models for advanced payment guarantee, performance guarantee, but you can modify them, of course. But if you start with a good foundation, it's easy to build on it. Takeaway number 2, basically, was that takeaway number 2 here was that 75% of respondents, I know you're disappointed, Pavel, state URDG 758 applied to less than 10% of guarantees issued. So these international rules we're all talking about, he's talking about, they're not really being used. And if they were being used, they would automatically bring in some benefits, okay? They would define what is a demand guarantee. They would define what is a demand. Each guarantee would have by default an expiry date or an expiry event. Even if there is no expiry date, it will expire after a period of 3 calendar years. Now, 3 years is still too long, but it's better than forever, okay? But we would be recommending expiry dates. Next takeaway we have here in number 3, actually, is 74% expressed that more than 40% of the guarantees issued are open-ended. Now it's getting interesting, and we were getting interesting. So the phenomenon of open-ended guarantees without expiry is very significant. And of course, this means there's a lot of capital tied up in supporting these guarantees. And of course, if I'm a banker issuing a guarantee and there's an exposure outside, limited, I will be charging you fees for the guarantee, or I'll be trying to. And next takeaway number 5, okay? I skipped 4. You're paying attention. 96% responded that the cancellation is cumbersome and complex, especially when there's a requirement to turn the original instrument. Everybody, okay? 96%. This is not good, but it's the way the situation can be. Then we have 1 or 2 more figures, more than 1 or 2. 80% responded that less than 10% of guarantees are issued electronically from applicant to issuance. Now, this is really interesting because this technology is there for 25 years. It's working well for 25 years, so we need to shift the mentality here in getting guarantees issued electronically because this can be done. This can be done right now. Moving on then a little bit, we're nearly there. 67% responded that less than 10% of LCs, guarantees and standbys are issued by way of a platform. Again, surprising. It's a very, very high, well, it's a high figure. I won't say very, very high figure. And then we're nearly there, number 8, 87% said that more than 50% of guarantee applications require an original wet signature. Now, this one shocked me. And actually, one of the banks that replied, informally told me that 100% of their guarantees require an original wet signature. Now, I couldn't believe it, but these are the feedback we're getting back from the market. And I'm pretty much nearly finished, okay? And then there was a question, 62% responded, do your guarantee customers have easy access? This one came about as a result of a court case, a very interesting court case. Do your guarantee customers have easy access to the status of all guarantees outstanding in their portfolio? And they called it warehouse guarantees with your bank. Why was this one important? Because in a particular case, the figure the bank thought was outstanding in liabilities was completely different than what the customer thought, okay? And of course, the customer's one was that the figures were higher. So obviously this could be challenging, and it was challenging, but now we're going to try and implement some solutions. The final one I want to talk about here is about blockchain, okay, blockchain, because we're all talking about blockchain. So we asked, does your bank use blockchain or distributed ledger technology at the current time in processing guarantees on behalf of customers? And we got the answer was everybody, 100%, okay? So 100% said that they are exploring the merits and benefits of using blockchain technology for guarantees, but nobody has actually implemented it yet. But from what we're hearing today, it sounds like it could be just around the corner. But as I said in my presentation, the most important thing was actually question number 4, bank guarantees, exposures, and risk-weighted assets. And our initial findings on this were presented at the ICC UAE Annual Trade Conference on the 6th of April last year. We were the first ICC National Committee to have a major international physical event. So these were the actors that have presented. Some of them are here today. But regarding the bank exposures and risk-rated assets, maybe, Divish, I can ask you to pop up here and I'll take a seat over here.
That's for me. Thank you. Thank you so much, Vince, and really insightful. I'll just build on what Vince was recommending and what were the results of the survey and so on and so forth. But just before I dwell into the nuances, I just want to call out, if the recommendation that Vince was talking about were to be implemented, if those efficiencies were to crystallize, we could have a potential saving up to $14 billion that could be realized if you were to go by the numbers that the survey seemed to suggest. To put it in context, for the amount of capital that's allocated to guarantees as reported by the banks, that could be a saving of up to 42%, purely by way of efficiencies without any need for any additional capital injections. And it is absolutely a direct result of bringing an efficient process within the systems. So if I have to build on, I think that just dwelling and how do we arrive at these numbers? How do we sort of achieve, come up to these statistics? The two questions that were asked of the survey, one of which was pertaining to what are the bank exposures in absolute amounts specific to open-end guarantees, and corresponding to that, as you would see in the section B, is what is the RW is allocated to it. So if you sort of split them into open-ended financial versus non-financial guarantees, we got a combined exposure of about $65 billion, split by 60 billion in non-financial and 4 billion in financial guarantees. The corresponding RWAs equated to about $33 billion, split by 30 and 3 approximately in the space of non-financial and financial. Remembering and remember the context that I called out, about $14 billion. 14 billion of 33 is roughly about 42%. So that's the direct saving that could be realized of this process change or efficiency to be called out. In the next slide, which is intending to explain how these numbers break down, and I'm going to try to keep it very simple and absolutely tied down to the logic of how these guarantees work. So we all know tender bond, and I'll use that as a classic example, are meant to be outstanding for a period of 3 months, for a maximum period of 6 months. So that's what's called out in the sort of dialog box you would see over here. But due to the practice followed by open-end guarantees, which needs the guarantees to be returned back in original paperwork and requiring additional documentation to be followed, these tender bonds extend up to 2 years. Breaking it down or putting it in context, that is 75% times more the period than ideally it should be. If we apply the same phenomenon or logic to other products which pertain to performance bond and financial bonds, the numbers tend to be performance bond, whose life is expected to be for 3 years, tend to be outstanding for 5 years. And financial similarly is double the period, which is expected to be outstanding for 5 years, remains outstanding for about 10 years. So think of it in very simplistic terms. If we could use a certain amount of capital to support a particular tender bond project for about 6 months, that capital is in today's date been deployed for 2 years and actually supporting one underlying project instead of what it could support for up to 4 projects. If we sort of extrapolate these numbers or put it in context of the survey results that we applied, and that's what's called out in this dialog box over here. We have value of open-end guarantees, which if you'd recollect in the previous slide was about $65 billion split by 61 and 4, and we apply the corresponding RWAs. And in very prudent terminology or prudent sense, we apply the percentages of 50 and 40, which equate to performance and financial. I'm not even considering the exaggerated 75% saved from tender bonds. In absolute prudent numbers, if these numbers was to be applied, we could very clearly see that 40% of the savings which could be allocated to non-financial guarantees could equate up to $12.4 billion. And similar logic, if applied to financial guarantees, would equate up to $1.5. Combine them together, we have saving of up to 13.9, circa $14 billion that can be achieved purely by these initiatives. So all that's being done over here is defining the scope of the guarantees absolutely to what the underlying purpose of the guarantee is, and we're trying to carve out whatever is the associated excess work in terms of documentation or safeguarding all the physical documentation, so on and so forth, that is associated, the administrative burden that goes alongside these guarantees per se. So that's the piece around capital. I'll hand back over to Vince. Thank you.
Thank you, David. Thank you. Great. So I always like when Divish presents the numbers because I get totally confused, as he knows, when I try and present the numbers. But when Divish was doing the actual numbers and I was analyzing them, but I'm not great at analyzing numbers, I told him that his numbers were wrong, okay? In the beginning, I told him his numbers were wrong because he was telling me about these open-ended tender bonds and guarantees, and I said, there are no open-ended tender bonds and guarantees. But within 5 minutes, he'd sent me back 3 different versions of tender guarantees with open-ended expiry dates. Now, if there's anything crazy, it's a tender guarantee or a bid bond. But he showed me examples he'd actually picked up in the marketplace. So 14 billion could be saved. We have specific objectives that have to be achieved, and there was 3 recommendations that came out of the study, and I kind of addressed the first one. Divish addressed the first one, me kind of a lot in the second one, but there was then a number 3, kind of another important one, but maybe not as important as the first two, although maybe Tom will disagree with me here. The third one was to establish a technology team comprising of experts, technical and legal, to look at how we evaluate how we could use technology, how technology could enhance the efficiency of UAE guarantee process. Maybe elaborate a little bit on the third point.
Sure. Well, I think you and Devesh have done a wonderful job of explaining the main objectives of the project, being the implementation of the rules such as URDG, fixed expiry dates and events, simplified guarantee texts. There is a secondary focus, like you've mentioned, and what we really want to do is to evaluate if and how technology can really bring tangible benefit to guarantee processing here in the UAE.
Okay, and because the project is specifically about guarantees and also standby LCs, when you're looking at trade and you're involved in so much areas of trade processing, do you think that guarantees, standbys are a product that lend themselves to digitalization or using technology to facilitate?
Yes, I do. I think they're very well suited because in the way they are processed, they're actually quite simple. So when we're talking digitalization, we generally hear about things like commercial letters of credit. So you have numerous documents, numerous parties, and even on the subject of bills of lading earlier, we understand they're quite complex. Whereas guarantees tend to be much simpler. So it tends to be one document, one message, one record that is issued in favor of the beneficiary, one party. And in fact, most guarantees and standbys expire without a claim ever happening under them.
Okay.
And even when a claim is to be submitted, it's generally just one message, one document that is submitted. So from that perspective, they're simple and suited towards digitalization and digital strategy.
Okay, so maybe the low-hanging fruit. So we're going to be moving on to digitalization after lunch. But before we do, maybe what's your take on what's happening in digitalization of trade and the approach that's been adopted by various actors?
Well, as you know, it's quite a broad topic, and it's quite a hot topic at the minute across multiple different industries, but particularly the banking sector because it's heavily paper-based. There's a number of different approaches, but the two prominent ones that stand out to me are, firstly, the use of OCR, so optical character recognition, for essentially extracting the data from paper and converting it into a digital format. This obviously brings a lot of benefit, a lot of efficiency, but has challenges because the scan quality has to be very clear, and this again has a dependency on the quality of the document, so that the data being extracted is accurate. But this is getting better all of the time. You know, algorithms are getting better. We're seeing it being used more and more. And then the second approach, which again I think is very prominent, is the strategy to basically eliminate the need for the data to be put onto paper in the first place. So trying to keep the data digital from source to target for the full ecosystem, basically. But again, as this will obviously bring a lot of efficiency, a lot of benefits, there are challenges. And one of the main ones that I'll touch on when we talk about the likes of guarantees is that you need to be able to validate and prove that the document or the record is original, is authentic, etc. And this is where traditionally we leaned a lot on paper because of, and even in the survey we see there's a lot of use of wet signatures, stamps, etc. So we need that trust.
Okay.
But the good news is there is technologies out there that are going after that particular use case. And even our company, China Systems, has done a lot of work in that area, a lot of proof of concepts, and even particularly in relation to issuance of digital guarantees. But I don't think I have time to go into that detail today. But if people wanted to learn more on that, I'd recommend on Thursday morning in the plenary session there is a FinTech competition. And our Solutions Director, Joel, will be presenting some of the stuff we've done there on that subject.
Okay, and not only Joel, but we have wonderful competitors in that competition. So it's going to be hot, it's going to be exciting. Let's get digital, show me what you've got. But Tom, thank you, that's really good. Well, again, I like to get ahead of schedule, so we're going to be about 5 minutes ahead of schedule. I want you to go to lunch in a moment. He keeps jumping up every time I say coffee break or lunch. Sit, okay? Okay, I want you in a minute to go to lunch and have a good discussion with your friends, good discussion, good dialogue, even maybe argue a little bit, but in a friendly way about all the things we've talked about. Because when we come back, we're really getting exciting. We'll be looking at 2 o'clock, be back, be ready, digitalization and the fight against financial crime. And I'm really looking forward to this because we will also be looking at artificial intelligence. And you know, I'm really excited about artificial intelligence because all my life I wasn't very good with natural intelligence. So I'm going to try out this artificial stuff and maybe it'll make a change. So everyone, go enjoy your lunch and we'll see you back sharp at 2 o'clock for another exciting session. Thank you very much. Thank you guys. Wonderful job. We'll do it later. You. Yeah. Oh, wow. Yeah, yeah. I know. Yeah, yeah. Different world. Thank you.
Say, hello. Hello. পুরো ডায়াসটা তুলবেন, পুরো কথা বলার সময় তুলবেন, পুরো ডায়াসটা তুলেন, জুম করে ওই যে দুবাই চেম্বারটা যেন লেখা থাকে, হ্যাঁ, ঠিক আছে? হ্যাঁ, তুলেন, ঠিক আছে?
have like evening one.
সেই এই হয়ে গেছে হুম 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 ধরেন এদিকে দেন এদিকে দেন এদিকে দেন এদিকে দেন
Okay. Well, everyone, we'll take our seats because we're going to kick off with the second round, round 2. And Chris, could we take a seat? Ready? Yeah, everyone? Get comfortable. Get and the fight against financial crime. Oh, okay. Yes. John, your handwriting, you need to improve it, okay? Okay, we're going to kick off, and in a moment I'm going to call the next panel on stage. But before I do, to our participants that are on screen, thank you for the positive comments. We really, really appreciate them. And just so you all know, this evening, the logistics, here we are in the beautiful Dubai Chamber, here is Emerson BD, and then here is the Sheraton. And at 7:30 this evening, compliments of our friends from China Systems, we are having a cocktail reception around the pool, okay? Okay? Now, Alex, no jumping in the pool like last time, okay? Okay? So we're having a cocktail reception around the pool. But just before I call Graham up to get his panel underway, they're over here. We have a few questions on the chat. Our comments. I'll go through them very quickly. There's many, but just the ones that John felt were important or that I guess he could probably get together. We are a bank in Asia and we paid under local guarantee, but injunction stop payment under counter guarantee temporary injunction stop payment under counter guarantee for 2 years without any evidence whatsoever of fraud. Thank you to Pavel for raising this issue. What about me? What about me? I was sitting there as well. Okay. Okay, number 2. Actually, this is really interesting regarding our UAE guarantee project presentation. Actually, we keep thinking that the beneficiaries are the troublesome guys. Okay, so sorry, we didn't mean that. But we are a beneficiary of a demand guarantee, which is open-ended, and we cannot find the original guarantee. We would like to redeem this transaction. What can we do? Well, if it was a URDG guarantee, and I'm sure it's not, but if it was a URDG guarantee, Article 25A3 would have provided that you can just issue a release, partial or full release from the guarantee, and that fixes everything. The thing is, there's a vacuum in how this actually operates when there is no rule. So move to URDG for your next transaction. This is a good one. If under UCP 600 a bill of lading is a document of title, this should be supported by the courts. Well, interesting statement, but UCP doesn't talk about document of title at all. So it's not covered under UCP, so it's not an issue for UCP, so it's not something that can be covered by the courts. I agree that the bill of lading is useful to control release of the goods at port of discharge as stated by Mr. KP. However, the proof of shipment and rights of holder to sue carrier is most important point. And most important point. There's something else, but I just can't read it. But I think you're right. It is probably the most important point, control and able to sue the carrier. So moving forward with our next panel. So we're looking at digitalization and the fight against financial crime. And our moderator is Graham Baldock. Please, you can come up and your panelists can follow. And Graham is chair of the ICC UAE Compliance Task Force, so he's the perfect guy. So over to you, Graham. Thanks, Vincent. And Graham is a great man at talking about the issues and the technology, kind of bringing it in. And I like that approach very, very much. Okay.
Thanks, Vincent. Friends and colleagues, it has been a while. It really has. It's funny what you hear at compliance conferences, because last April, there was the ICC first in person, Vincent's mentioned it, and I asked the audience how many compliance people were at that conference. And there was myself and James, a colleague of mine. Is there any compliance people here today? Ah, there's one. Now that is why Vincent was so comfortable earlier telling you that he'd been involved in illegal acts. He sat there talking about bills of lading. He turned around and said, I've been involved in a lot of legal acts, and under his breath he went, and illegal ones. He was looking for a laugh. I've taken note of it. I will tell the chair and we'll look into it later. Okay. My stories won't be as good as Vincent's for the rest of the session, I tell you. So we were looking at financial crime digitalisation and the fight against financial crime. That is a massive topic. And originally I had a number of vendors on the stage, and then I was told there's only one. Now I've been told there's two. So I've got Susanna, who's come from Waystone, which is a consultancy firm here. We've got Manoj, then next to her, Trade's son, James Tebbs, and Jess from Monitor. Before I start, I've always had a thing of working with the business, and I've tried to understand the business side of their progress, their life, and also for me to be able to work with them, to be able to be their trusted advisor. And with that in mind, I met Susanna last year, who's, it's one of those subjects after lunch that sort of, I'll keep you awake, I promise you, I really will. It's about data privacy, and unfortunately for those of you who come outside the UAE, it won't really benefit you. But if you're in the UAE, you've got the three regulators, the ADGM, DIFC, and then the central bank regulation. And the data privacy regulations have evolved over time at different speeds. And a lot has been done in the last couple of years, actually. There was a lot of enhancements over the fact that the UAE was 50 years in its sort of unity. And a lot of regulation has been changing, employment law has been changing, consumer protection has been changing, and data privacy has been changing. And I was talking to Susanna over a drink about it. We drank a lot of coffee talking about data privacy. And she was explaining the nuances across the regulators. And she's put together a document that talks about the UAE central bank regulation, ADGM, and DIFC. She's also then put in a matrix at the very end of it, which is always the most handy thing for a compliance officer, because I can go to the matrix, I can find out which bits relate to which regulation around the three regulators, and she's put some recommendations in it as well. That's then going to be sponsored by the UAE ICC and published through the UAE ICC and Waystone as well in partnership, which is, to me, a really good thing. Actually, you've got compliance in partnership with a trade body that's local, and that actually adds value to the industry locally. A lot of regulators write, sort of FATF and everything, it's really, really high level sometimes, and then we have to start disseminating it locally, and thanks to Susanna's hard work, and you will get a chance to read it, because in the next conference, I'm going to have a quiz on it, so I want to make sure you'll read it. So I'll just give Susanna a bit of time to give an overview of the the recommendations before we go into the panel with the techie guys.
Yeah, of course. Thank you. Thank you, Graham. So just to start off with the data protection laws, this is a global change. So you'll start to see a lot with digitalization that people are concerned about the personal data that they hold, they transfer. And there is a move towards the company no longer owning any personal data it holds. And this will affect all businesses globally at some stage, whether it's interacting with the UAE data protection law, the GDPR, the European data protection law, Singaporean data protection laws. There is a change and a move to protecting personal data, and personal data now belongs to the individual, which gives individuals rights, it gives them control of their personal data, it means they can take that data off you. And for all businesses, whether you're dealing with employees, whether you're dealing with clients, prospects, mailing lists, for example, you will have to manage personal data in a more effective and controlled manner, and you'll have to be conscious of how you are using personal data in a day-to-day way. So it's no longer okay to buy a mailing list for marketing purposes, for example. That's becoming an international standard now, that you'll have to give people the option to unsubscribe, and you can't contact them just because you've bought it because they attended a certain event, for example. So the UAE is no different. The UAE has slightly changed its approach, and now not only do individuals have control of it, but it depends where an individual lives. So if you're managing or you're speaking with individuals living and residing in the UAE, or have businesses established in the UAE, you'll need to be familiar with the data protection law. And that even comes down to if you're dealing with individuals in terms of, customers, if you're dealing with your other employees that are based in a branch or a subsidiary, that data does not belong to you anymore, it belongs to the individual, and you need to be able to control it. So that's kind of a summary of the kind of trend that data protection is going in the direction of. And the reason why it's particularly relevant for you, it means you will start to see throughout globally, but certainly the UE and the GDPR, are following a trend of controlling international transfers. So if you're transferring to, like I say, your branch, your subsidiary, your head office, if you're transferring data to your clients, even if it's basic information like a name, job title, an address, for example, this data is now protected under data protection laws globally. So, I mean, my contribution, I suppose, today is just to give you a flavour of how that could affect your business and how, what considerations you need to have.
Thanks, Susanna.
Yeah,
And-
sorry.
But there were recommendations, wasn't there? So
Yes,
that's
recommendations.
that's high level. It is important, and it's one of those things that I wanted to give to the sort of trade, which I could have clearly never articulated like that. But your recommendations focused on a couple of points, didn't they?
Yes, the recommendations. There is this trend with all data protection laws. One of the things, like I say, is conscious transfer of personal data. That means recording where your personal data, what personal data you hold, in which systems, whether it's your systems that you own or third-party systems or outsourced providers. You need to know where your data is now. And that will be an exception on a global level. You also need to put in place safeguards when you're transferring to jurisdictions that don't have a suitable data protection law. So each jurisdiction will have control over what it considers as suitable and what it considers as not suitable. And if you're transferring personal data to that jurisdiction, you may need to put additional contracts in place, or your regulator could ban you transferring data, which obviously for international trade could have a huge effect on how you actually do business and the efficiency of business. And the other thing is, like I say, individuals have control of their data. So your obligation is to notify people how you're going to use their personal data before you use it in that way. And generally speaking, data protection laws, I think, seen by most people as an inconvenience. I would argue it's making it more efficient, certainly, but it's asking you to be considerate, it's asking you to notify people, it's asking you to give people the control to know what they're doing with their data. So these are the main things to look out for when you're looking at your data protection laws and how, when you're transferring items, data, mailing lists, for example, or working with colleagues in different jurisdictions, you may need to consider these things.
Thank you. And one for obviously promoting business, one of the other recommendations was to assign a data privacy officer in-house as well. So I'm always working now that I can get another job somewhere. So data privacy officers in-house, they will liaise with the regulator on your behalf. And that document, it's going through, as you can imagine, a final iteration, and it will be stamped with both the stamps of the UAE ICC and Waystone, and will be published hopefully in the next couple of weeks coming. Thank you very much. So we had a sort of gathering to discuss what we were going to talk about here. As I said, it's a massive subject, and Manoj has got a system. He's going to give a little bit of overview what TradeSun it actually will offer. Then I'll go to Jess and he'll give an overview of what his solution offers. And I'll bring James and Susanna and myself again to start to challenge the techie guys. I've got this real issue, and there's a number of them, whether it's ship tracking, whether it's price checking, whether it's dual use goods checking. So I don't think we've got time to go through all of it, but hopefully we can give you a little bit of flavour and how technology can assist. But also, let's hope it doesn't stifle some of the smaller banks and kill trade products for the little banks that can't actually maybe afford some of the solutions we're going to hear about in a minute. Manoj, please.
Thank you, Graham. So good afternoon all. I think before we talk about what TradeSun offers, I just want to make a few comments around this whole expectation around the accountability of banks as far as trade finance is concerned. I think historically, trade finance was, or the expectation of monitoring and doing due diligence within trade finance was limited to going by documents. But increasingly, you can see the regulators are moving towards holding banks accountable for monitoring the physical supply chain as well as the financial supply chain. Now that's a tricky one. And we were having a debate earlier with Graham where he was kind of pointing to the fact that the vendors are probably selling the wrong solution from the point of view of the smaller banks. He just made that comment. But I think it's driven by the regulators, and we need to find a way to address the problem because the bad guys are increasingly finding different novel ways to beat the system. But that said, human beings are creatures of habit. And that's where I think the opportunity for technology lies. Because they're creatures of habit, they're going to do certain things in a predetermined way that they've thought of. And they're going to repeat that. While once they're challenged, they will change their tactics, but they will still stick to some fundamental behaviors which can be tracked through technology. So the role of technology now is to provide that facilitation, to raise alerts and say, look, here's something that could be going wrong. I don't think technology is going to be the savior and help eliminate the human cognitive decision making. That's not going to happen. So if someone is claiming that technology can do everything and take away the human intervention, I personally don't agree with that. But I think what technology can do is remove the hard work that humans would have to do to pour through tons of data to figure out what is wrong or what is going right, and can ease this process through automation. And that's where I think companies like TradeSun come into the play. So we've been working with one of the largest banks, and I'll name JP Morgan, who have been partnering with us, going back to Zul's comment early in the morning. I don't think FinTech has the capability or the expertise to build a solution from sitting outside of the bank, right? But working closely with them, they drove us and understood, told us what they think is needed and what the regulators are asking them for. Whether this can be applied as is to banks of various sizes and across all jurisdictions, I don't think we are the experts to say that. But from a point of view of providing a solution, definitely we can play a role. So we've come up with a solution which is based on the principle that the system will offer you all the transparency and alerts related to what's going on in a transaction. But ultimately, it's the human's decision that will override any system recommendation or alert. That's the principle on which our solution is based. And that means we do not say that the solution will just make everything STP. I've been in this line for 30 years working in technology and trade finance. I can say for sure trade finance is very different from many of the other business domains where events can happen in any sequence at any time, right, in a very different ways. So it's extremely complicated, and I don't think any technology solution so far has figured out a way to make the whole trade business process 100% automated in all scenarios. So given that, what we've done is, we have three components to our solution. Of course, the first one is the digitization, which is critical and key input to anything further that you can do on tracking financial crime activities, right? We extract the data from documents. We use natural language processing and AI to make sense of these documents. The challenge in trade, as many of you know, is there's no standardization of documentation, right? Documents can be in any forms. Yes, airway bills and bills of lading may have certain, standard formats. Yes, we know 80% of the world's shipping lines are controlled by a few players, and if you can, align around their formats, you probably got a lot covered. But the fact of the matter is, still there is no consistency in how humans put data in documents. And it's not as simple as just running to OCR. OCR as technology has been around for years and decades, but now applying intelligence to figure out what the data says, applying the context, figuring out the context of what the data says. So goods descriptions or just English text, figuring out where exactly the goods or the merchandise is described versus where the terms and conditions relating to the shipment are concerned is something that technology can help with, and that's what our solution does. So we extract all this data, we digitize it, of course, and then we apply it for various compliance checks. The other problem that we've tried to solve in the compliance domain is today many of the banks are going to multiple players to implement the various types of checks they're doing. So they sign in and partner with one marine tracking agency, another one for dual-use goods, a third one for anti-boycott, or maybe they use their internal list, a fourth one for sanction screening. Doing this obviously makes the whole process broken, fragmented. So our pitch is to automate and orchestrate this process, make it much simpler for the banks. We are taking on the ownership of getting that public data source, combining it with the client data, and applying intelligent technology to figure out if there's something going wrong underlying in this particular transaction. So it's about intervening in flight during the transaction process and not coming in after the fact and trying to figure out that something's gone wrong, right? That'll be too late. So the proposition we are offering is automation of the whole process, streamlining, and secondly, of making this in flight, preventing it before it happens rather than post facto.
Thanks, Manoj. I agree. I think it should be in flight, and I think it should be event driven. I didn't ask you the question because I thought I'd ask you here.
Yeah, sure.
So are you just focusing on trade finance transactions and the data available in trade finance transactions, or are you mapping that against the SWIFT payments as well?
We're currently focusing on the trade transaction and the associated SWIFT messages for trade, not the payment messages.
Not the payment message. But sorry, SWIFT messaging for trade, but are you looking at the other, just literally the 103s?
Not yet.
No.
Because, again, the 103, if it's associated with a trade transaction, the assumption or presumption is that the due diligence on the transaction is done by the trade guys. And the cash guys are simply going to execute and move the money based on all the due diligence that has been done. Of course, there is a duplication of effort, I think, because the sanction screening is done again by the cash and payment guys, and so is the fraud control prevention. But I think the onus is being shifted right now, as far as trade is concerned, on the trade business to do the due diligence.
Right, so my sort of thing is, we know that trade is being looked at, but we also know that the counterparties will still be sending money potentially to each other.
Sure.
And it's that activity outside of the trade sphere that we need to try and encompass all. So we're looking at the activity holistically, not just from a trade perspective, which, you know, obviously it's small steps we need to move forward.
Yeah, it's a great point you bring up, and we were just discussing this before, earlier in the day. If the regulators are holding banks, so much accountable for trade, why aren't they applying the same level of accountability or expecting the same for cash business, right, when payments are being executed? Is there even anyone looking at the context of the underlying business transaction sitting behind the money movement? In the trade world, yes, we're doing that, but in a pure cash payment, nobody is really looking at that. What is the basis on which this payment is being made, on what's the underlying business transaction? And maybe that needs a lot of different type of data to come together, which today I think the ecosystem doesn't support, but it's something that we can do definitely in future. We're currently, as a company, TradeSun is focused on the trade domain because this has enough problems that have not been addressed. And while I just talked about compliance checking, I just want to mention we are also automating the document checking process, which may sound a little weird at times because that's a highly human cognitive skill-based process, and document checkers are not built overnight. We all know that. But that's exactly the reason why maybe this is going to be a need for the future, because the systems and the technology are there which can be applied to learn what the humans knew or were able to learn, and then automate this whole process and simplify it somewhat.
Thanks, Vineet. Hopefully not in my lifetime, or I'll be out of work. Jess, please.
Thanks everyone for coming. Thanks for hosting us, Vince. Pleasure as always. I often say that the ICC must hire half comedians because it's always an entertaining show. So I'm Jesse Chenard. I'm the CEO of Monetigo. We started Monetigo about 7 years, really sort of focusing on how digitalization will impact the financial services sector. As many fintechs do, we threw a lot of spaghetti against the wall to try and see what would stick. And through the course of our journey, we came up with our secure financing product, which basically launched in 2018, focuses on very much the similar problem that UTC Trade Connect started to focus on, which is deduplication in financing, specifically around invoices initially. As we started to look at the problem, our network got a little bit of publication. We actually just started with 3 receivables exchanges in India, the TREDS exchanges. They were sanctioned by the RBI, where MSMEs are able to take their invoices to all 3 of these platforms. The problem that they discovered when they launched was that those MSMEs might then hit finance on all 3 platforms. So similar to what UTC Trade Connect does, we created a fingerprint system. It was actually the first in the world. And as we launched that product and got publicity around it, we just started to have inbound interest from NBFIs, banks, what have you. And that culminated in actually SWIFT India coming to us saying, this is an important product. We should be able to offer this to all the banking services out there. As a fintech, it's very difficult to onboard with the bank. In one Latin American country where we onboarded with one of the major banks, they fast-tracked us. It took 9 months. You can imagine trying as a fintech to go and do that fast-track process with every bank. I would have to hire 100 employees just to do that. So the advantage of what we saw working with SWIFT in India was that we bypassed that. So once a bank comes to us and says, who are you, Monetigo? Then it gets sticky, but when it's offered by a global organization like SWIFT that does 2 years of due diligence and a lot of compliance checks and things like that, it becomes more natural to be able to sell that through. As we started to sort of publicize that product, there were other people out there trying to start different registries. Thailand has set one up. Obviously, you guys have one here. There's one that was launched in Brazil, but I don't think anyone uses it. And then the question sort of came around of, okay, well, this is all well and good, but how do we interconnect these things, right? You can imagine if UTC Trade Connect is doing an import-export financing, and there's local registries all around the world, it's just technically inefficient and probably technically impossible for them to query 130 registries or whatever that number would be. So when we started talking with SWIFT about sort of our ambitions globally, they said this is something that we should be able to offer on a global level. And so we started to look at the advantages of local hash registries, or local registries, sorry. Local registries, you can do all sorts of stuff, just as Manoj just talked about, really analyzing that data. And then going to the data privacy aspect that Suzanne was talking about, you can't export that data. So it's kind of the challenge. So what we worked with SWIFT to create is standardization. So it's all ISO 222 compliant, it's all published, it's all open, it's all free for anyone else to use. But also the concept of a global hash registry. So when someone registers an invoice with UTC Trade Connect, if it's import-export finance and say it's going to India, they can't query both systems, they can't register with both systems. Banks here don't have the access to those systems. So we created a concept whereby the local hash or local registry creates a hash and publishes that to the global hash registry. So it kind of encompasses the entire world. We're right now piloting with, I think, 12 of the largest trade finance banks in the world to access the service through the SWIFT API using their SWIFT credentials. And again, that gives us scale. So, you know, to Manoj's point, you know, I think technology is interesting, but it's not the problem. The problem is legal. The problem is regulatory. I can apply you a solution right away to solve some of your problems, but again, unless it's understood by the central bank, unless it's understood by the regulators, and importantly, the compliance departments within the bank, it will go nowhere. So that's kind of the challenge we have as fintechs is what aspects can we digitize, what's legal, what will fly globally, what will fly in each different jurisdiction, especially in terms of data privacy and things like that. India is very strong on localization. So yeah, in a nutshell, that's one of our main products. We also do work on sort of helping, whether it be financial services firms or regulatory or government bodies, with pockets of digitization, right? So if you look at a process that maybe right now is someone inspecting a ship and they're running around with a piece of paper, that paper becomes a legally binding document, which then gets faxed somewhere and then gets inputted into the computer. Why don't they have an iPhone app for that? So there's all these little pockets of the process that happen right now, which we feel like you can kind of cherry pick. You've got companies out there that are trying to boil the ocean in essence, and trying to get everybody to come onto their platform, and when everybody gets there, it'll be utopia. But that's probably not reality.
Not yet.
Yeah.
Sorry, just to point on Jess, you talked about Susanna's piece of the data privacy sharing restrictions. Have you got around that, or you haven't?
So hashes of data are legally, globally recognized as not PII. So when we take the invoice or the bill of lading, we've actually expanded it to any asset you might use or as collateral in trade finance. You take 6 elements from the invoice, you run it through a hashing algorithm, which we kind of dumb it down and say create a fingerprint. So if I take an invoice and I run it through the hashing algorithm, I come out with a long string of numbers and letters. No one can identify that. It's completely unidentifiable. But if you're presented with the exact same invoice, you run it through the same hashing algorithm, you're going to come up with that exact same string of numbers. So it's a one-way hash. You can't take it back. So that's been pretty much recognized around the world as non-PII and exportable.
Great, perfect. I remember data privacy restrictions with certain countries. You couldn't even share anything. So
and that's why the local registries are important, because the local registries actually get the data and they can do all sorts of advanced AI analytics and things like that, predictive stuff. But then when you try to solve the global problem, you really need to be able to strip all that out and just come up with an identifier for that asset.
Thanks, Jess. James, we talked at lunchtime. I know you come from the forensics background, so a lot of data, a lot of sort of forensic analysis and things like that over the years. I'm trying to slightly move away from fraud. We spoke about and touched upon fraud earlier, but from a sort of an industry perspective of sort of money laundering, terrorist finance, sanction screening, how do you see sort of, and KYC I think in particular, how do you see sort of the digitalisation of the fight against financial crime?
Thanks, Graham, and thanks for having me. I should start with trying to work out what my identity is, because I think I was a techie at the beginning, then I wasn't a techie, and I prefer comedian. I'm a forensic accountant, and we're known for our sense of humour.
I come from a long line. I come from a long line of accountants. Don't worry, they're a hoot at Christmas parties.
I'll do my best. I think probably the starting point to answering that question is, we're sitting in a kind of an interesting place at an interesting point in time, having this discussion, and there's been a lot mentioned about data and data quality and so on. Right? I missed this morning, so I apologise if the grey listing was covered in some detail this morning, but it's highly relevant to this particular topic. Right? I'm sure most people are familiar with it. The reality of sitting in the UAE, perhaps I'll then come on to regulation and the banks. As I see it as a consultant speaking to the financial services industry, there are problems with gathering sufficient information and data. We don't have a transparent corporate registry in the same way as many parts of the world do. It's not easy to get hold of information publicly. And so due diligence from a sort of standardized perspective has quite different or a slight difficulty to it potentially here by comparison to other places. And the reality of the grey listing is just sort of bearing that out. And there's a lot of change happening. I think when it comes to financial crime prevention, there's an interesting point here around technology in general and digitalization, right? Ultimately, this has to be the answer. There is so much duplication of financial crime compliance and the combating of financial crime, even in the UAE, with every institution trying to do their own due diligence, with every system trying to sort of recreate the same process, and very limited access to common data, as I talked about. And if we're honest, a reasonable population of people who are trying to hide their identity and so on. And we sit, right next to the creek. There are dhows leaving here and going sort of all over the world. There's, a lot of trade that comes through this part of the world, which is this type of technology. I think is very badly needed. The paradox that I can see, and I think it's one that would be really interesting to hear from a system solution, is how you deal with the technology and the potential data overload that comes with all of those things. Right? So if you're a large bank, then you have potentially the capital and the access to be able to make use of emerging technology, to be able to invest more in fintech or to bring that in-house, to access paid information and data, and then to get involved with suppliers. And we talked about ship tracking and things earlier, right? Fantastic. If you're a smaller institution, that is much more costly, and that could be a significant threat to the idea of trade finance in general in an institution like that. So there is a paradox in this information. Conversely, if you look at it from a regulator's perspective, there is almost an expectation, and if you're a supervisor or a regulator, and I don't know whether there are any in the room, I hope I haven't offended anybody if there are, but it's quite easy to say after the event, well, the information was potentially there. Why didn't you make use of it? So the technology must be the answer to the financial crime problem, but we're in a sort of conflicting period where technology is rapidly developing, data isn't quite right to feed it. There's a lot that needs to happen for it to come together and genuinely create a reduction, as Manoj talked about, in the manual processes, because that technology is probably, I would suggest, creating quite a lot of work around it. I mean that with no disrespect to the systems at all. This is a transitional process where banks are adopting it. So, regulation is still emerging, I think, in the UAE, particularly on this topic. There's a huge focus with the DFSA and FSRA and ADGM that you talked about, Graham, before, on fintech and technology development and sandboxing and so on. But all of this really, particularly in this region, is very, very new.
I think with tech, what you'll see is what we've seen with the internet. When I started my first internet company in '99 or something like that, you had to buy $10 million worth of Sun servers. You had to buy a Solaris operating system. Open source completely changed all that. And so when I've gone into numerous banks and their IT departments and they're working on something super cool and they're spending millions of dollars on it individually, each bank, I look at it and go, you're building the same thing that person's building, that person's building. It's a duplication of effort. So with standardization, well, ultimately, I think you'll start to see technologies become more broadly available, more on an open source standard and/or with economies of scale there. So it will take time, but same as the delivery mechanisms that we use for the consumer side of things, the internet, the financial services space will catch up to that. So I think the days of middleware software programs going in and saying it's going to cost you $10 million to get the system will be more available as a service.
In fact, with the advent of cloud technologies, I think we're all moving towards software as a service. And for the TradeSun kind of solution, it's about converting the CapEx model into an OpEx model for banks. So to the point about how difficult it's going to be for smaller banks to avail of some of these solutions, I think it's going to get easier. The barriers to entry are definitely falling because you don't have to invest, like Jesse said, millions of dollars just to put in a place of some kind of a due diligence process.
Yeah, and we found that too when we figured out our model for India. It wasn't we're going to license you this package of software and you've got a minimum commitment. Now you charge literally pennies on the invoice or the document that you're checking, and there's no minimum commitments. And so what that's done is we've got all the fintechs on our platform. We've got all the NBFIs. The guy who's doing 50 invoices a month is the same as is basically on the same level playing field as the bank that may be doing 20,000 a day. You'll start to see more of these metered pay-as-you-go type scenarios for this advanced software.
Oh, good, because I'm always trying to support the little banks, and I thought they were going to be pushed down. No. So that's a good way forward. The challenge I see at the moment, though, is that we've got lots of fintechs, and if we're talking about the UAE today, clearly people know it's gone on the grey list. That's a big impact. There was a lot of enhancements undertaken, clearly not enough, according to FATF. The regulator's under pressure now. The central banks are under pressure, and they're going to start pushing down, obviously, and to try and enhance even more. I wonder how long it's going to take before the small banks can actually keep up. We talk about, we talk about ship tracking. Some products don't even require the tracking. They don't actually call for the documents to enable ship tracking. But if there's an expectation to track a ship on a financed transaction that's on the seas, then do they have to actually then track that ship? Now, historically, if I remember rightly from April, everyone was talking about the certificates of origin. And compliance are asking for the certificate of origin before the transaction has been executed when the product doesn't. So we need to educate compliance. The business needs to educate compliance. And as an industry, we need to work with the regulators on their expectation of what's achievable and without killing the products. If you're going to call for everything at every single stage, well then, as Manu said, and I always touch upon, what about open account, Swift payments? We're going to be calling that as well. But you'll bring the world to a halt. Do you have a view on it, Manoj?
Yeah, I mean, interesting that you say that. I think maybe we have slightly different perspectives on that one, right? Because as a technologist, I have the view that technology is definitely going to aid the process. Yes, it is a journey, I think, to the point that James made earlier. We're not quite there, but we're transitioning from an area where everything was done manually to the future where the machines can potentially do everything for the humans. But right now we're in a state where I think we can aid the process of providing all the input. To the specific example that you gave, ship tracking, yes, it may not be important, but because the regulator has this expectation that somebody is monitoring and watching the physical supply chain as well, with IoT and with AI applied, it'll be very simple for the technology to raise a red flag and say, look, something fishy has happened with this particular ship. So it doesn't necessarily need somebody in the bank to go in and look up the journey of the ship and figure out what happened and whether there was a transshipment or it went dark. Technology will do all that work for them and just tell them the end result and say, look, there's something fishy here, take a closer look. And hopefully if the whole thing runs by exception and not everyone's into illicit transactions, then yes, the manual work and the effort required will not keep going linearly up to your point, because otherwise, yes, I agree that it will become totally unviable, right? And we do hear these complaints, by the way.
You will do if you come to my bank.
The folks in the banks are saying, yeah, the compliance is killing us. I mean, and they're not blaming their colleagues. They're just saying that the expectation of the regulators is increasing day by day, and how do we meet that expectation? I think there is no way out other than leveraging technology for that, because it can be simplified.
It's funny. Sorry, it's funny that compliance is killing the business. We're just here to help and assist. Thanks.
Yeah. Well, yeah, I was going to ask a question about the technology actually, because in very simple, generalized terms, right? Client banks might buy your technology because they see a commercial advantage in doing so. you know, an efficiency saving, increase in margin, better product, or because they see it as defensive against a regulatory imperative. And I'd be kind of interested to know where you see the balance of those.
So we had experience in one of the Latin American countries where they had experienced massive scandals and frauds around duplicate financing, and the regulator basically said, shut it down.
Yeah.
And so the banks, yes, obviously look at it from a perspective when we go in there and say, okay, this could be the answer for your regulators. They look at it and go, okay, we can open up a good book of business. But it's more holistic than that. Ultimately, what does that do for the market, right? It reduces fraud, reduces the cost of credit. It allows them to open their book up. One of the banks down there, I think they finance around 50 invoices a day. They see 20,000. They just don't finance them because they don't have the level of checks that Manoj was describing there, where they could feel comfortable with it. And the manual process doesn't work. And so how do you automate that? How do you de-risk it? And again, at the end of the day, there's a person sitting there that ultimately has to make the decision. But the technology not just enables them to sort of backstop against the regulatory pushback, but long term, it has long benefits, trade finance gap, all sorts of things like that that are most commonly discussed in these scenarios.
I think too that it's more about the risk prevention, I think, than the efficiency play as far as compliance goes, because the cost of non-compliance is significant, right? One fine will erase every single investment that one had planned for or could have planned for. Yeah. So I think that's the defensive posture that technology can.
Yeah, if you look at what happened in Singapore with Hing Leong, that definitely got the regulators up in arms and trying to figure out what is the best way forward.
And not to mention the reputational damage.
Exactly.
Yeah. I get the cost of non-compliance. Sorry, does someone have a question?
That was Suzanne.
I'm sorry.
Let me talking.
Come to you then.
No, of course. I was just wondering, because obviously you've mentioned about the regulator, and the regulator, particularly here, is really focused on cybersecurity. And by digitalization, you're obviously creating a higher risk for cybersecurity and manipulation of, CDD documents, for example, for an attack, and the commercial risk of, losing data or, having some type of attack on your data. How do you overcome that with the regulator then? Has that been discussed, or is that something that you're seeing as a challenge?
I think from a technology perspective, again, in the data space, there are lots of new technologies now that can provide increased security. So yes, the bad guys are getting smarter, and the risks and the amount of phishing attacks and all the kind of security violations are increasing day by day. But so is the technology. The example that Jesse gave on just hashing, that's one form of anonymizing, but it's also one security play, because nobody can really tamper with that data once.
Yeah.
Blockchain offering the immutability, right? Nobody can tamper. Once it's in, it can't be tampered. So I think that technology is there, but I think the point that was made earlier, it's not that the technology is the gap or the problem. It's the willingness to collaborate and for applying it in the right place.
Well, and also the sharing of the data.
The sharing of the data is a big problem.
So there's a number of people working on this. R3 has Conclave, Google has Secure Computing, and Intel has Secure Enclaves, where you can actually all agree that the process that your data is going to go through is submitted to a black box, in essence. There's no administrator, there's no sysadmin who can go in there and pull the data off. And so you've got this assurance that you're supplying your data, yes, it's raw, but what's output of that is something analyzed, processed that is acceptable to the regulators and acceptable to the risk and compliance people within the business unit, that they're not giving away the data that might get them in trouble long term. So yeah, as Manoj says, there are technologies. Blockchain's a big piece of that, and again, there's secure computing pieces that I think will satisfy regulatory concerns.
But it's going to be a play. Technology will provide a solution. The guys will come up with the next problem.
Exactly, yeah.
Technology will offer the next solution. So I don't think it's an ending story.
Yeah.
Well, my little banks still haven't got an alarm on their front door. So it's funny you say that the unwillingness to cooperate. So I worked on a large-scale sort of technology solution in a previous organisation, but off the side of my desk. That wasn't my job. So it's not just bringing the vendor in, paying for X amount. I need in-house expertise as well. And I need people to be able to work on that on an ongoing basis. And when you've got your day job, and the thing is, the techie guys really know their stuff. And so I had to learn that stuff and then obviously then manage a project, and we need the governance around it, and then we need to, whether it's engagement with the regulators to prove that we're moving to control and we're going to go in sort of in-flight to post. That all needs to be managed in-house. That in itself has a cost. And I know that when the different vendors have said they can do this, this and this, I knew in my heart that the amount of work I was having to do on the side. And the central bank here issued a paper last year on their sanction screening about the industry having a lot of reliance on the parameters set by vendors. Now, if the vendors have said it wrong, but I put my, it's obviously, faith in you that you're going to do it right for me, and then we end up with this bit of a conflict later on in life when sort of maybe James's world comes in and does an audit, and I've missed it completely.
And we can be satisfied in the fact that the regulator will always hold the bank accountable.
Funny that.
They can't point, unfortunately for the banks, they can't say that it was the vendor solution problem or it was the vendor's problem. You can have internal agreements and indemnity clauses and all that in the contractual thing, but I think accountability rests. So I agree with you fully that there's a certain cost, but it's the cost of doing business, I think. And what the vendors can do is help minimize that cost.
Yeah, that I tell you, we do agree on something. I promise you.
Yes,
we do. And I think that's all. It's not a wake-up call, but I think what the central bank's been issuing is not only guidance to banks, but the thematic reviews are highlighting areas where enhancements are needed, and one of them is about understanding where the vendor's coming from, understanding the parameters, and tuning any system to the risk appetite of that organisation. Yeah. Clearly, one vendor can't.
As vendors, one of the first things we need to do is go and speak with the regulators. So in India, when we did the first digital commercial paper issuance, fully end-to-end, no paper, got ferried around on a bicycle or whatever. We went to the RBI first, said, this is what we're going to do. They said, oh yeah, neat, interesting, cool. And then we did it, and then it got publicized, and then they called us, the bank, and the corporation that did the issuance, and said, what did you guys just do? We explained it to them, went through it. They said, well, is it legally binding? Yes, we applied government-approved digital signatures, and they looked at it and they said, wow, could you do this for bonds and CDs too? So it's education, really. From we get security audited, we're ISO compliant, all sorts of stuff like that. So we have very strong faith in the integrity of our applications, but really getting the regulators to understand it, getting the compliance departments to be comfortable with it. That's the challenge. Again, the tech isn't the challenge; it's the education aspect.
And getting compliance to understand it. That's a challenge, I'm sure.
Exactly.
I know from my own experience. You talk in techie terms, so that confuses me. So, do you want to add anything, Susanna?
No, I'm good.
James?
Yeah, I will. I mean, I think you picked up on the thematic review, right? And if you talk to the regulators, they will say, well, the quality of consulting work, for example, and I mean that in the broadest possible sense, is has not been up to par. And whenever we go and see an institution and say you've got a deficiency over here, they'll waive a report from somebody that says we've reviewed it and it's fine, right? So, but that is not a question of necessarily of capability and competence on either side. Is a question of how the regulatory market here has worked in the past, right? What we've seen in the UAE in the last 18 months is hugely beyond the type of regulatory intervention and supervision that we've seen here before. And as a result of that, you will have had difficulties talking to banks about a product that could probably, give them huge efficiency savings, but there's no regulatory pressure on them, or there wasn't, to do anything about it. And as a result of that, it created this situation where there's a little bit of sticking plaster going on. And if you read that thematic review, it reads that way. Yeah. You installed a system without doing any proper due diligence. You didn't tailor it or tune it to your own requirements. You relied on the vendor to do that for you. There's no senior management buy-in or understanding of it. That says, somebody told me I ought to have a system, so I bought one and I stuck it in, and I hope it's doing the right job. With all due respect, that's what it reads like. Yeah. That world has changed, but it is changing from the top down. So the larger banks are getting pulled to pieces by the regulators at the moment, and the larger banks are logically where there is the greater experience, the greater sophistication, and the greater budget to be able to do something about this. The smaller banks that you talk about don't have that, but they are also going to suffer from the same kind of intervention that the central bank is providing, as are insurance companies, asset managers, and everybody else that falls within scope, DNFBPs. but they don't know it yet. It still hasn't filtered through to that level in the market, in my opinion. And it's still very difficult. I can have the same conversation with two different institutions, and they will react to that conversation in polar opposite ways. One of them will say, yeah, we really understand the regulation, we've had a visit, you know, we've got to deal with this, and technology of any type, but trade finance is a good example. And we need to do something, but, you know, we're looking for value for money. Others will say, I'm not interested, you know, or I'll do it, but I won't pay more than 10,000 dirham, you know, or something like that. And there's an educational, experiential gap between the market. And what is happening, if you look at financial crime, is exactly what you were describing earlier on. That risk, which unquestionably exists in any market. We can talk about, you know, the future buyer of Chelsea Football Club, Graham, if you like, right? A property developer in the centre of London, right? Not known for being whiter than white, but, you know, those risks exist in any market, but they are being pushed down into smaller institutions because the larger institutions are under greater scrutiny and they're going through this process first. And the market here, and I don't mean this in a disrespectful way at all, but it is changing so rapidly around the topic of financial crime compliance, the acceptance of it, and an understanding of how the international community views what's going on here, which FATF ultimately is, that there is this huge discrepancy now between the larger organisations and the smaller ones. And whereas, you know, they were all pretty average, now you've got some of them are really good and really big, and some of them are really bad. So, you know, there's this huge discrepancy, and that's pushing the risk down. So to your point around smaller institutions, greater risk, more attractive to people that want to abuse that system for their own financial crime ends, less capital to be able to deal with it, less opportunity to be able to purchase the software and technology they need, or less manpower to be able to deal with it, and possibly less understanding of the risks they're facing as a result. So, you know, that creates a bit of a perfect storm.
Now, thanks, James. We sort of lead on to a later panel discussion and another later panel discussion. But yeah, it's the first time my world has actually ended up in sort of sport and things like that, because I'm a Chelsea fan. Sorry about that. But and I'm now losing an owner because he's Russian.
No,
apparently.
that's perfect.
Well, I've got a new owner today, have I? So, Manoj, we've got 10 minutes left. I can open the floor to questions, or do you want to talk a little bit more about TradeSun?
Well, yeah, I can pass a few comments, but then yeah, I'd love to answer questions. I think the whole panel would be happy to do that. But just to know, TradeSun, a little background, we are a fintech company founded in 2018, based out of San Diego, California, with geographical diverse placement of people across the world. For our size, we have a hugely culturally diverse population, and we support and work in all the regions. To your point, James, thank you for saying that, because from our perspective, we could see a lot of more interest from banks in the Middle East, asking for the compliance solutions and what it can do for them, which we thought is driven by the pressure trickling down from the top to the bottom, and you've kind of helped us justify that view. So hopefully we're doing something right in that space. I'm based out of India, where we have our development centers, including in the US, and we've got you know, technology folks around the world as well as salespeople. We'll be happy to give you more information in a separate day. I don't think this is the forum for selling my company, but I just wanted you to be aware of the possibilities.
You can try, because the point James making, and I wanted to give you a bit of airtime for out of respect. The point James making, you know, the pressure that's coming on the not just the regulator, but that permeates down then from the bigger banks to the smaller banks, and then you've got this mass of vendors out there offering me a solution. And I'm not saying it's an end-to-end solution, I'm not saying it's an Oman estate, but a solution. So I need to prioritise which piece I'm looking at first. And at times, you know, from an in-house perspective, it's quite unwieldy, you know, and takes a lot of time up to do not only the assessment of what a vendor can offer me, but the due diligence on that. And no disrespect if anyone's in procurement, I've got to then try and get you on board as well. And that can take months, as you far know better than myself.
And I think the credentials that a vendor comes with, to the point like Jesse made it from the experience you had in India with tying up with SWIFT. Likewise, TradeSun, we partnered with IBM. We've got a huge customer in the name of JP Morgan. So if they found our solution to be good to use, hopefully it provides some credibility to others to believe that there's probably something worth a look. So yeah, there'll be a lot of players out there, but I think there'll be few with the right credentials who will make it.
If we're going to name drop, just to give credibility, I've known Vincent O'Brien for quite a few years now, so I think I don't think he's in here now. Does anyone want to ask any pertinent questions? We've got a panel of mics coming your way.
Hi, Chris from Emirates NBD. Very interesting questions and session, thank you. Much broader though, a lot of the focus is on the transactional life cycle. A lot of the questions are around the transaction life cycle. Why are we not going back to ground zero? When we onboard the client, prescribed set of questions, trade questions, how we then reconcile those questions to red flags, and through that transaction life cycle, having those alerts, because that is becoming really onerous. And regulators are saying 5%, 10%, 100% during the transaction, after the transaction. So it seems technology is focused very much on the transaction. But maybe if you step back to ground zero, where we onboard the client, it would help us in that journey.
I'll take that for starters, and please do add. I used to work in a bank for 3 decades. I'm in Citi and JP. So, based on my experience of the KYC space and the CDD, process, technology had already been applied to those states or original states earlier, and there was also technology being applied after the process. So, typical anti-money laundering solutions and analytics were being done after the deed, and likewise, before you signed up, you did a thorough client due diligence, but you didn't follow it up with regular revisits, and probably that became more and more frequent as the regulators demanded it. Now what's happening is we're marrying that knowledge gained at the time of onboarding a client during the KYC with the intervention we're doing during transaction process. And I'll give an example. If during the onboarding state, we've already identified the specific industries and the jurisdictions this particular client operates in, do we use that knowledge during the validation of that transaction to see, is this particular transaction in that space or not? And should we raise a red flag? If they're in the business of textiles, and today we're seeing almonds being transported, then system can definitely flag that off, and we've got that capability now during the transaction monitoring stage. So I think we're bringing it together, but yeah, there's always more that can be done. And specifically, I think, the other thing that we used to happen is all these due diligence red flag alerts were being done manually. I think, again, can be automated because the information is available. Many of the banks have KYC series systems. The knowledge base that is sitting on those systems can easily be pulled out and used during the transaction processing due diligence process. So it's not going to be very difficult to do that, and that in fact is indeed what solutions like TradeSun are doing. But yeah.
I think it's also a problem of most large multinationals and corporates have multiple banking relationships.
Yeah.
And going back to the privacy aspect of the data, the banks don't share the information with each other.
Yeah.
I talked to a fintech out of London, and they had done analysis with a number of banks on companies that had been distressed and looked at their invoices and cash flows and stuff like that. They discovered that based on that analysis, if the banks had been sharing the information, typically they'd find out 6 months before something actually happened. But because there's no capabilities for that, because there's restrictions around the legal aspects of it, it's just not possible. So, looking at one client and saying, okay, are they a risk or not, is hard for one individual bank to do when they might have multiple banking relationships.
No, thanks. Good question, Chris, and something I try. We talked about KYC and onboarding and as well, and I think there's a number of vendors out there. They think they've got the onboarding piece. The problem was it goes back to my original thing of the holistic assessment of the customer activity. From onboarding, and James and I and Manoj were talking earlier. The scrapping of the 1, 3, 5 reviews. It should be trigger based, and you can only do that with technology and vendors. So great question. Yes, sir.
Hi, this is for Manoj. Again.
I think I've opened my mouth too much.
I promise you, I didn't put him in the audience. I really didn't.
I work for Emirates NBD. I'm part of the trade-based money laundering team. So my day in and work is about doing these checks. So 2 questions for me. So when we talk about money TBML, there are a couple of checks that we do. Obviously KYC, customer, and then the counterparty check. So The two areas which we got always stuck is the price, because because when you talk about money laundering as such, we are talking about underpricing, overpricing, so many other things. So price, how do we check the price? The second piece is again the shipment. So we talked all the day, we have been talking about bill of lading. Okay, to an extent I can validate the airway bill. But being in Dubai, there's a lot of trade which is happening in-house, between the warehouse to warehouse or by road. So we are not able to verify the shipment has actually happened. So in these two areas, how is your system going to help us?
So we rely on partners like IHS Markit, who have aggregated data from customs and government agencies worldwide. And there are other aggregators too. We've just partnered with IHS Markit, who are able to provide the export-import data as reported by various country and government agencies. So what we do is we source that data for a particular type of merchandise. We look for the price points across a tenure. And based on that tenure, then we apply certain logic and algorithms to figure out whether the price is within limits of tolerance. And that again, tolerance is based on the risk appetite of the bank, right, or the client, so to speak.
That's right.
So the system can then flag off to say, look, this price movement is looking something out of the ordinary. And again, it's all driven by the historical price behaviors for a given goods between a pair of countries. Because again, the same good manufactured in one jurisdiction as compared to another, and the price that will be, and this is all, pre-taxes and all the local customs duties and everything like that. But that's
Exactly.
what we do.
That's where I find it very challenging. Some of the
It
commodities
is.
which is manufactured in China and one which is made in Germany.
But that's why the public data source has the data across the world, and it works on pairs of countries. So if we're able to know the source of the originating country as well as the destination, then for that particular flow, one can look at price points. The other challenge that's there in fair price, which we are solving for, is the seasonal variability. Right? So commodity trading, specifically with oil, the way the price has moved, any check that anyone's going to do using the price points of the last 7 months is going to be confused about what is the real price of oil, right?
That's right.
So again, you have to look at a historical average, determine a seasonal trend, and then be able to say, if you're in a particular time of the year, whether this matches a seasonal trend or not, and a historical repeatable trend. So again, this is technology, the so-called artificial intelligence being applied to determine whether something is out of the ordinary. It's all about looking for patterns, repeatable patterns, and finding the anomalies in those patterns. So it can be done, and this is exactly where technology can aid humans.
I wish we could talk about price checking for another half an hour. We are coming to an end. I don't know, can we have another question, Vincent? Yeah, of course. Is that all right? Yeah, sorry, you've got another one. No? Anyone else got a question?
Yeah.
One more?
I'm sorry to interrupt. The second part, I know if you can someone answer. For the inline trade, that I was talking to KP today morning, also the same thing. I can verify the BL, I can verify the airway bill. What about the road transport? How do we do that? And how do we control that, from an AML perspective?
I'm not sure about the UAE. I can't comment on that, but I can use my knowledge of what's happening in India. Right? There's the electronic. Yeah.
In India, we are able to do that, but here.
Right. So I think the local jurisdiction has to implement some form of electronic monitoring of movement of goods and services provision across the territory. And once that is there, then that becomes the source of actual proof that a particular activity has happened. So that would be the solution. And like TradeSun solution, it would just be another input to us. Like we're monitoring goods moving over the seas, we can monitor goods moving over land as well.
Good question. I like that one.
Can I make one, maybe two questions right back? Number one, do you track and monitor your own data so that you can get an idea of what your own history is of those types of transactions? And secondly, would you share that with the industry through a kind of conclave, confidential computing system that Jesse talked about?
We are tracking the data which is there in-house, to the point that will we be able to share it with then I know it has to be discussed then.
Yeah, I mean, it wasn't.
That was a bit on the spot there. Susanna
Frankly, because I need to,
That is one of the
the
problems.
reason is I don't know their system, to be
Yeah,
frank.
that's
So
fair.
before that, I cannot say I will do that. But
But
yeah.
the concept of sharing it and having access to that must make sense.
Okay, it's on the hour. Thanks very much. If you'd like to thank the panel, I think it's good. Thank you. And please take your seats. Do you want to carry on with the vessel checking? Yeah.
Oh, you go ahead, yeah.
Well, I've got the menu here. I did actually see this before I started our panel. So we've got vessel risk management. So, Ravi. Sorry?
Sam Chapin.
Was it Sam?
Yeah.
It was Ravi.
Yeah.
I'm doing my best.
That's because Ravi knew I was up here.
Okay, let's see.
You got.
Yeah, so relevant topic.
Please.
Right? And I'll be. Yeah, I bet everyone does, and I'll be sure to pick up on that. The comments of Graham and Manoj during the session. So, nice to meet you all. For those of you that don't know me, my name's Sam Chamberlain. I work for IHS Markit, and I'm responsible for our trade finance compliance business across EMEA, which centres around vessel, dual use good, and price screening. So, Graham, again, half an hour chat on price screening. More than happy to do that. But today I'm going to talk around the topic of vessel compliance risk. Unfortunately, I'm not my colleague, Ravi Armin. He contracted COVID on Saturday, couldn't fly out. So I'm doing my best impression of Ravi to cover this topic, and we'll be happy to take your questions after. Okay, so the purpose of this session is to share the key findings of a white paper we produced in partnership with the IRBLP and the ACSS, focused on the key challenges facing trade finance banks in their efforts to mitigate sanction and compliance risk as it relates to vessels. So we did this against a fairly obvious backdrop, right, that's kind of been touched on today, around there's ever-increasing demands from the regulators on trade finance banks in this arena. These demands are increasing in number and in complexity. So in order to, well, knowing this, the white paper sent out to answer a couple of questions. The first one being, is there a best practice out there for banks to institute a vessel compliance process? And the second one being, do they exist? Is there a set of practical recommendations we can make for banks of any size or geography to implement to enhance their processes in this area? And in order to do that, we convened a working group of trade finance experts from banks, shipping companies, regulatory bodies, and conducted a series of interviews in order to figure out if there was some sort of consensus around these topics. Okay, so I'm going to cover what the current regulatory environment is at a high level. I'm going to briefly detail the different types of compliance risk that vessels pose to financial institutions. And then probably most interestingly, I'm going to talk about what the things we learned as part of the white paper and what some of these recommendations are that we've included. Okay, so it's clear that, particularly in the last 3 or 4 years, the demands and expectations of regulators on banks in this space have dramatically increased in number and complexity. And the OFAC advisory in May 2020 really set the tone for this in recent years. It kind of made it clearer than ever, right, that it's not really enough just to track if a vessel's on a sanction list or not. And actually, banks need to be aware of some of the common but more advanced deceptive shipping practices that are out there. And the advisory introduced this concept of AAS data, of tracking ships, introduced this concept of outages, vessels going dark, and so yeah, this was kind of the big one, if you like to say. Ofsted in the UK about 6 months later kind of echoed similar guidance in the UK, and in September 2021, the Central Bank of the UAE, obviously looking at this from a slightly different perspective, more focused on money laundering and making it relevant to the region, but it indeed covered a lot of the same deceptive shipping practices that OFAC had already highlighted. So it's clear that
regulatory bodies and others are singing from the same hymn sheet, if you like, in terms of what are the common but more advanced deceptive shipping practices that banks need to be on the lookout for, and also kind of acknowledging that there seems to be, to some extent, a gap between current bank vessel compliance processes and what the risks out there are. So what are the different types of compliance risk that vessels pose to banks? Well, the first one is all about understanding the entity of the vessel. So at its most simple level, this concludes, is the vessel on a sanction list or not, right? But it's actually much, much more than that, particularly around the importance of understanding the ownership structure of a vessel, understanding all the associated parties tied to a vessel, which can be incredibly complex. Shipping is not an easy world to understand. And also it's about understanding what are some of the behaviors that vessels are potentially engaging in to hide their true identity. Is the vessel engaging in frequent flag and or name changes? And what can this tell us about the real identity of a ship? And the second risk, and really the focus of the white paper, was around what are some of the illicit behaviors that vessels can conduct on the water. And in line with this is all around the question of AAS data, right? So using, well, the paper covers what AAS data actually is. So it's the tracking of, it's technology used to track vessels, track their historical movements. But importantly, it covers how AAS data can be used at a certain level to understand, yes, if a vessel has in the past called it a sanctioned country, but in real time, is it in a sanctioned or high-risk jurisdiction? But more important, well, importantly in the context of this presentation, it can be used as a really effective tool to understand and identify and monitor for these advanced common deceptive shipping practices like dark ship activity, ship-to-ship transfers, etc. So the paper examines the strengths and weaknesses of this technology. I think it kind of leans firmly on the side that the strengths outweigh the weaknesses, but it has its limitations. And it centers on how it can be used to identify these common deceptive shipping practices, like dark activity. So dark activity is when a vessel turns off its transponder for an extended period of time and then reappears, indicating a sanctioned port call or some sort of sanctioned illicit activity. And you know, I think important and probably the most interesting part of the paper in a lot of ways is what are the different nuances or factors to consider when looking at this type of activity, right? So if you just look at every time a vessel goes dark for an extended period of time, you're going to have a host of false positives. It's not going to be a very efficient trade operations process, right? And that's what matters. So the paper talks about how what's important to consider in something like dark activity is where did the vessel go dark? How long did it go dark for? What type of vessel is it? Where did it reappear after it went dark? And all those little fragments of information can be used to understand what's the risk of this AAS outage. I think a good example of that, and something that's been in the press a lot lately, is the Dan Bunkering case. So they were fined $7.5 million for facilitating the shipment of jet fuel via Russian tankers to Syria. And actually, if you look at these voyages that took place that make up the case, I think it's about 33 transactions, you'll see that there's a really quite a similar pattern across a lot of the voyages. So vessels going through the Aegean Sea, they switch off their transponder off the coast of Turkey, go dark for 6 days, then reappears in the same spot. So that kind of pattern clearly indicates potential illicit shipping activity, right? It's not really rocket science, so that's a risk. And AAS data, again, can be used for the identification and monitoring of ship-to-ship transfers, so clearly a well-established and the overwhelming majority of cases a completely innocent event, but it is something that sanctions evaders like to do in order to hide the origin of a cargo, for obvious reasons. And again, the paper outlines what are some of the nuances or factors banks need to consider when looking at these types of events in order to take a risk-based approach with events of this nature, including where did the STS event happen, what were the parties involved in the STS event, how long did it take? You know, and that was an interesting one for me because research shows that a legitimate STS event tends to take 20 plus hours. But actually, off the coast of North Korea, they employ specific smaller types of vessels that are nimble and able to do these types of transactions in 10 to 15 hours. So that was something that I learned from it, is the length of time actually matters with these types of events, and something to consider for banks. Oh, apologies. So, okay, what are the things we learned from our interviews with banks in this space? I think going into the white paper, we were curious if there would be some sort of consensus on this, and I think reassuringly there was. And the majority of banks obviously recognise the importance that a vessel compliance policy does need to include, in some ways, the ability to track and identify these common but advanced illicit shipping practices like dark activity, ship-to-ship transfers, etc. There's kind of a recognition that just knowing if a vessel is on a sanction list or not isn't enough. And I think, there's also this understanding among banks, or a focus among banks, that actually live vessel tracking and monitoring, as Graham kind of understandably alluded to earlier, is complex and resource heavy. And sometimes you don't even have the information in front of you. It's not even possible to track the vessel at the time at which you're being asked to make a decision, right? So there's a perception that this is a difficult thing to do and complicated. And so some banks tend to focus a lot more on the historical activity of vessel. So looking at past port calls, past name ownership changes, and building up a risk profile of a vessel that way, which is certainly a valid approach. A common voice was that the industry needs to do more by way of standardization in the industry around documentation and, importantly, the data contained therein. I'm sure it won't be much of a surprise, but the thing that came up again and again was the importance of using and prioritizing vessel IMOs rather than vessel names, right? I mean, there are a lot of vessels out there called Neptune and Emma. And if you're only using the vessel name, then actually it's pretty hard to know what vessel to track and anything around the risks associated with it. So I think that was the main focus. I mean, even thinking about the OFAC SDN list, right? That list has X vessel names on there. So if you're just using the vessel name, you might not know if the vessel that you're looking at is literally on the OFAC SDN list, right? So this was a common piece of feedback from the industry around the importance of working together to standardize documents and information contained therein as much as possible. I think hopefully somewhat reassuringly for some of you in the audience, banks did agree that a risk-based approach was possible and obviously vitally important in order not to cripple kind of trade operations compliance policies and keep getting business done. Clearly, you don't need to put the same amount of due diligence and effort into tracking a container ship going between two low-risk, non-sanctioned countries again and again and again than you do with certain commodity vessels, particularly oil tankers, transiting or interacting with high-risk lanes, such as Syria, Iran, Venezuela, right? That requires a different type of due diligence and check than other cases do. Okay, so what are some of the recommendations that we made in the white paper? The first one was, banks have for a long period of time been running extensive KYC due diligence checks on their counterparties. But actually, it's really important to replicate this kind of due diligence and process to vessels. So this concept of know your vessel is actually a really important one. And that extends beyond, is the vessel on a sanction list, but understanding all the associated parties tied to a vessel, being able to map those out, and being able to verify the true identity of a vessel. I think we certainly recommend that banks do employ some sort of real-time vessel tracking application during the course of a trade, because ultimately without that, it's actually impossible to know
if a vessel is engaging in some of these illicit, more advanced, deceptive shipping practices, right, that the regulators have called for. And, you know, Manoj did my job for me a little bit earlier when he said that technology, right, can help you to do that. It doesn't, you know, the days of, you know, operators going through third-party platforms and trying to draw a ship on a map and track it and logging in 20 times a day to check it are gone, or we certainly want them to be gone. And actually letting technology do the work for you in terms of tracking a vessel during the course of a trade and receiving automated alerts around if there's anything suspicious and you know, identifying those outliers in the most efficient way possible. And that's kind of my last point, which is that we also certainly recommend that banks do, if they haven't already, look to expand their compliance policy frameworks around incorporating some of these more advanced but very common, or maybe very common is the wrong word, but common deceptive shipping practices like dark ship activity, STS transfers. And I'd like to finish on hopefully a reassuring note, which is actually most of these types of illicit shipping practices, once you have the right knowledge and you've got in place the right combination of public sources and you're engaging with data vendors where required, actually, a lot of these examples of deceptive shipping practices are not particularly sophisticated or hard to spot, right? You know, that Dan bunkering case that I mentioned earlier is kind of a good example of that. It's something, once you've got the right knowledge and the right tools, you can spot, and there are certain patterns into it. So yeah, I think that's what I wanted to cover. Happy to take any questions. I'm looking at Graham, but I don't know if anyone else has got any.
Graham, do you want to make a comment or a question? Oh, we've one or two questions. We will move on quickly, though. But Graham, just a quickie.
I do actually, because I saw this paper and Mike Byrne talked to me about it. I'd actually like to know from an industry perspective how many of the trade finance products call for the bills of lading, which is really the only way of tracking a ship, because that will show you the scale of the issue. And the scale of the problem. And I appreciate you're a vendor selling it, and I've used it before, a straight automated. But we had to do it automated on every single trade that required it, because we didn't have the ability to risk rate a single transaction. So if you're talking about only do it on high-risk transactions, we didn't have the ability to risk rate a transaction in isolation. So we just did it on every single one.
Right.
But it would be good to know from the sort of trade finance sphere that how many products, how in that survey, what was the portion of the product did that actually affect, or how many trades did it affect?
Yeah, I mean...
You'll know the industry problem then.
Yeah, no, that's true. I'm not sure if I don't believe the white paper unfortunately got to that level of detail in the survey results, but certainly something that I can feed back and come back to you on, because as you said, that would help us really strongly define the extent of the problem.
Great. Another question here.
Yeah, sure, as well. Just as you're written about ownership and one regarding the TBML. So ownership, do you go until the ultimate or beneficiary owner of that ship? Because I see it is only the operators on that is there. So do you flag based on the ultimate owner? Because that is where some of the vessels are not flagged off. Second, regarding the TBML space, a lot of things you told about the sanctions element, touching sports and all. But when you look at the TBML, what happens is we are not sure whether the goods are actually loaded or not. Do you confirm that? And whether the bill of lading is authentic or not. That's one which is very difficult to determine.
Sure, yeah. So don't want to turn this into a total pitch, but yeah, we cover all levels of ownership associated with the vessel, right up to the group beneficial owner, and understand the networks of those companies. And on your second point, yeah, so we don't, some of our partners do, but we don't verify look at documents, right, and verify their validity. But what we can tell you is, by looking at the ship and its behavior, has it loaded cargo or not? And things like that come down to analyzing the draft of a vessel before and after a port call, so you can see where it is in the water and have a strong indication if it's picked up cargo or not.
Okay, one final question for the lady.
Thank you. Good evening, everybody. I'm very happy to be here within this beautiful moment. Just add something. The IMO number, that is International Maritime Organization number. It was improved for addressing the fraud of the shipping vessel line. So do you think that it's a very good item to facing the vessel tracking or reducing the fraud of vessel?
I'm not sure if I followed the question.
IMO number.
Yeah.
And another question is, do you think that it should be incorporated in LCL, letter of credit, in all of the country?
If possible, yeah. I mean, it's the only way of uniquely being able to identify a ship. It's the only unique key out there, right? So, yes.
It could be reduced fraud?
Yes, it should be, the IMO number should be used.
Thank you.
Definitely.
Thank you.
Yeah.
Thank you, that's wonderful. So Sam Kimberley, thank you very, very much. Could we give him a good big round of applause? Really wonderful. Wonderful session. Well, and we were asked a question on the technology, on YouTube or whatever. Will we be sharing the documentation that were presented today, Robert's cases, the other documentation, and of course the white paper? We will be sharing everything with everybody because it's all digital. So let's go digital. Let's go digital. So now we're going to move on to, actually, I found that really good about the vessels going dark, because I've really learned a lot, and I'm going to read that white paper, because I always thought when a vessel went dark, it just meant someone turned off the lights, but obviously it had to be more complicated than that. So now we're moving on to something that's really close to my heart. And when I say it's close to my heart, it's because I think it's really, really important, and I think it's gone off the agenda in recent years, but it's really, really, really important. And we're looking at de-risking, and we've a lot on in a short session, de-risking of banks in emerging markets, and we're also looking at de-risking of customers. So Srinat, please come up here and bring your panel, and we're really looking forward to this one because it's just so important right now.
Oh, okay.
Thank you, Vin, for suggesting that there be some discussion on this topic. And saying that it's important is probably even understating the point. It's critical to the existence of businesses and the existence of banks. And it's actually a topic that, in my personal experience, I first encountered in the late 90s when Southeast Asia went through a financial crisis, a region-wide financial crisis. Now, I've been based in Singapore for the last 30 years, and I can recall times when a letter of credit from Southeast Asian countries were never questioned. But overnight, when the Southeast Asian crisis hit, first in Thailand, then South Korea, and then it rotated to Indonesia before it hit Malaysia. Overnight, there was a change in attitude in the international banking scene as to the acceptability of these payment instruments. And I do recall that one of the Southeast Asian central banks actually deposited, I heard, about $500 million in certain banks whom they wanted to use as confirming banks, since this was an emergency measure and otherwise their economy would come to a complete standstill. So we're clearly talking about something very critical. But I just spoke to you about something that happened in the 1990s, and here we are in 2022, still trying to figure out what are we going to do about this problem. And so the challenge to figure it out is left to my colleagues here. So I have the easy job of standing here and getting a point here and a point there, but they have the tough job of having to explain the situation that they choose to speak on. So I'm very pleased to be hosting this 45-minute discussion. I think the title was, yes, de-risking, a dilemma for banks and customers alike. I thought about that choice of words and I said, is it really a dilemma or is it a fait accompli? Is there any negotiation that occurs between two banks before the de-risking is implemented, or is it just you're told from tomorrow this is going to be the new reality you're going to deal with, and the banks who are at the receiving end of the de-risking decision just have to live with it? So as far as customers are concerned, there has been wholesale exclusion, and I think you will be talking about it, Sridhar, correct?
Yeah, de-risking from the SME
From the SME sector. You'll be talking about de-risking from the SME sector. But before we get into the SME sector, let's get through to the banks. And we have two bankers on our panel. We have Katerina here from Macedonia, and we have Anna from Georgia. So, Katerina, I'd like you to just expand on this impact of de-risking as you experience it from where you're operating. How does it work? How does it affect you? How does it affect the banks, and how does it affect your customers?
Well, the recent events that have been happening in Europe have a lot of impact in my community, that is in the Balkans. So one of the main things that happened was that a lot of major US dollars correspondents were never interested in the Balkan region, so they didn't want their presence over there. So that meant that a lot of Russian banks were presented with their affiliations in the countries. So Sberbank was one of the banks that had its affiliations in Bosnia, Slovenia, and Croatia. So once the topic of sanctions was up in the air, people were very afraid, and they started to queue in front of the banks and pulling their money out. So the easiest thing to import is crisis. So what the governments did was a very quick and swift reaction. So they transferred the possession of the banks from Russian entities to domestic ones. So in about a week, Sberbank was a domestic legal entity with no Russian affiliations. So it was a very tough week for everybody in that region.
So it's a situation where you're not in control.
Yes.
And you just have to react to the situation as it emerges.
Yes, it does.
That's unfortunately the situation that many banks find themselves with.
Well, unfortunately, it's a situation that we have been facing for over 30 years in the Balkans. So it's a region that every 5 or 10 years has a conflict that has financial implications as well. So the regulators have to be prudent and omnipotent in every way. So it's a good that we are cooperating. I have my colleague from the National Bank here as well.
Yes, I had the privilege of meeting her a little while ago. You were mentioning earlier about the pattern of trade that your country has with the rest of the world. And you also mentioned that the sort of disinterest on the part of US dollar liquidity providers. So are they two related factors, the pattern of trade that your customers are into and the type of currency access that's available to them?
Yes, I think it is, because we are in the center of Europe. So basically, my country, Macedonia, and the Balkans usually do business in euros in the neighboring countries. So that is probably why the trade is in about maybe 80% in euro currency, and implication on the financial system is mainly from the euro regulators and not so much from the US correspondents.
So would you say that you didn't really miss the US dollar providers?
No.
There you have it. Anna,
sorry.
It's okay. That's the situation as it is. It's perfectly in order. Anna, What's your perspective, sitting where you are? How has de-risking played out in your backyard?
So you asked us to figure it out. As long as you have not figured it out for 20 years, I doubt that we are able.
I haven't. I admit.
But I mean, it's very drastic difference what Kate is saying from her perspective, from the Balkans point of view, and it's very different from the Caucasus and Central Asia. The dependency on USD clearing is very high because these regions are more dependent on the USD payments. And throughout the last 2 decades, I would say the situation has been getting worse and worse and more challenging to onboard the USD clearing banks. Certain banks have found the ways, and we talked a lot today about trade finance, sanctions, AML, KYC, and all the topics were very well described and explained by the experts. But when we drill down to the trade finance, we end up with the remittance. And if this remittance cannot happen just because the banks are cut out from the USD clearing ecosystem, this is disaster. So we had some discussion with the colleagues over the coffee today, and the discussion was mainly about what happens. And the problem is very different from region to region. There are issues when colleagues will be discussing about the de-risking of the SMEs, but from my understanding, from the regional perspective, de-risking of SMEs and de-risking of the banks is quite different. First of all, is the inclusiveness of the banks, systemic banks in the countries and in the regions, but also the mid-sized banks who are servicing the SME customers within the USD clearing ecosystem, first of all, and then inclusiveness of the SMEs to be supported by their banks. Currently, this was a challenge, and as well as you described, we have been talking about this with the hope that there will be a solution for this. And of course, the solution cannot be found standalone by certain region or by the country, but it has to be a regulatory framework that has to somehow find the solution. And there has to be definitely a policy dialogue in this regard, otherwise it's just getting worse and worse. We've seen currently, if I would have been here 1 month ago, probably my thoughts and idea would have been completely different than 20 days ago when all the crisis and political, I would not go into details in the politics now, but what has started with Ukraine and sanctions with Russia and what's going to happen next. Because as a consultant, I'm doing some projects in the Central Asian countries, and I know particularly not only the banks, but the countries who have complete dependency on the Russian banks who provide the USD clearing for those countries. It's not only particular 1 or 2 banks, but it's a whole country dependency. Maybe these banks are not yet sanctioned, but very soon. I mean, this is going to be a very, very hot topic and disaster for the economy of these countries as well. As always, there will be found the ways out, but these ways out would be more, I would say, would be very, very bad for those countries and development, because they will be under the lens of the KYC, AML, sanctioned criminal lists, because they will be known as that they are finding the ways out. And probably the regulators have to somehow, I mean, probably it can be worse. We just cannot imagine yet. But of course it can be worse, but it should not get worse than this. It's a time that the senior level authorities who make the decisions have to sit down and decide either they can allow certain banks to operate and to allow them that the economic sense becomes economic sense to work with certain banks, or they have to open the doors to maybe again the nested transactions with a different approach, but the approach has to be very precise.
Yeah,
currently, yes, currently we know that FATF defines the zero failure is, we know everyone probably here sitting here knows what the zero failure means, but unfortunately the banks who were penalized have this approach. They decide just to divest from certain countries just because of the cost benefit, and they just prefer not to do a lot of evaluation, what they are required to do because of the cost benefit, economic sense of the being present in certain regions or in certain banks.
When we talk about de-risking, Anna, and as you correctly brought up, two reasons are attributed. One, the financial crime risk, and the second is the economics of having that relationship. And you alluded to that. As far as the economics are concerned, that's a discussion that really can't, there's not much space for debate in a public forum like this. It depends on a case-by-case basis. But is there a justification for banks to withdraw on account of financial crime reasons in the context in which you are working?
Of course, when it comes to the financial crime, there is a legitimate reason. But from the other point of view, and basically what my cases where I'm cautious about is that the bank may be reputable, its customers may be reputable, well-trained in terms of the KYC, AML, sanctions, very digital in terms of the screening systems, but still economic sense. And the banks, the large USD clearing banks, may be present in those countries, but because of the size and the capacity, these banks may not be interesting for the larger scale banks. And at the same time, unfortunately, due to, again, the zero failure effect, they're not allowing the nested transactions anymore, of course, and we know the reasons why. But then there has to be a solution on the table. Otherwise, we talk a lot about the economy, and why we're sitting here together again is how to expand and how to develop the economies, our own economies and global economy. And basically what we are doing, where we are right now is that we are locked down within the certain regions and certain countries, not allowing certain banks to develop. The banks cannot operate without main currency payments. It's impossible. Trade finance is impossible to be maintained. Products disappear from the market, and then monopoly happens, and this is creating a big mess and initiates the fraud cases as well.
So I mean, the dilemma is really with the banks who are, shall we say, the victims of the de-risking, as to what to do next.
Absolutely.
So if I could just shift that difficult question to you, James. In your capacity as a consultant, how would you respond to the situation that both Katerina and Anna have put forward, where the banks find themselves in an impossible situation? Is technology the obvious answer, or are there other measures, do you think, banks in countries of the type that are represented here should be adopting?
Well, first of all, I mean, I don't think I could comment so eloquently on the situation in Europe at all. I mean, I can give a perspective from here, and I would agree with what Anna has said. I mean, I don't think you can entirely blame banks for de-risking, for want of a more specific phrase. I mean, there are a number of different perspectives on this matter. You know, is it lazy compliance? Is it the easy answer? Maybe. There's lots written, you know, around European Banking Association, for example, on de-risking and whether that's you know, compatible with financial crime risk management. The answer is, of course, if enough effort is put into the due diligence, there's no reason why de-risking should be necessary. But that's the headline. You know, when you're a bank and you're faced with the reputational, regulatory, and financial risk.
Obviously, it's a business decision you'll take.
Question to answer, exactly. And this region has been heavily affected by it as well, by one of the main banks that's been mentioned a number of times today. About 10 years ago, there was a significant de-risking exercise. But I have had some experience of dealing with banks in this region who have had significant financial crime problems of their own, and the impact that they have had with their correspondents. So the sort of de-risking in a bilateral way, if you like. And my experience has been that larger banks will keep certain lines open, and that the way to deal with that and to try and make sure that you don't fall victim to de-risking, presuming that it isn't going to happen on just a sort of large-scale whitewash basis, is to take some kind of positive action and demonstrate that your own compliance is at a level that will keep the correspondent bank in some level of assurance. And I say that again from this region's perspective rather than from the same context as Kate and Anna. But I've seen this in practice. I've seen large-scale de-risking here, and I've seen banks keep some of their SWIFT lines open, and they did that by taking positive action, flying to New York, sitting in a room, showing them what we do, telling them about the remediation if that's necessary, showing them all our compliance, inviting them in, and saying we don't present a significant risk to you that you can't manage, and here's why. So affirmative action is the way to go, and I think, on the topic of SMEs, I think exactly the same logic applies.
So you've seen evidence of that working?
Yes.
All right, that's encouraging. So shifting gears, Sridhar, when it comes to de-risk SMEs, and Anna has also previously made some reference to that topic, the policy decisions made by banks to exclude certain segments of the market, and policymakers and government policymakers and economists always tell us that protecting the SME sector is vital for economic progress and all that. But yet, the banks choose to choose another road when it comes to determining where their business interest lies. So, in the context of SMEs presenting a level of financial crime risk that is unacceptable to the banks, how should SMEs respond, and what's the way out?
Yes, thank you. See, I feel so every bank should think on financial inclusion because they have to go in line with the economical requirement of each of the country, because every country has projected some economic growth, and SME is one of the segment which is contributing major factor. So by excluding SMEs from their portfolio, they are not giving financial inclusion, because regulator on one side they are saying that you need to give financial inclusion for these guys, right? I mean particularly about SMEs. But when banks are not taking that call, where they will go? So they have alternative mechanisms to go also. They are doing a lot of business. But banks with their infrastructure, because they have developed for other segments, other corporate segments. So if they include SMEs also and give them a financial inclusion, the economy will grow also, but they have a lot of controls to be built in place. So one is the dollar requirement. Dollar, because here dollar is pegged. So everybody wants to deal in dollars. So they should think of routing the transactions to some other avenues like European, like Europe, or if it is India, through some other currencies, they need to figure it out how it can be processed, all these types of transactions. Plus with the proper control, SMEs are willing to give all the sort of documents, whatever the banks wanted, because I'm in the audit field. I'm associated with Emirates Chartered Accountants, and we are doing a lot of audits. We have seen a lot of documents are available to demonstrate, but unfortunately, if banks are not including them, so they are left without options of winding up the business and going, which will affect the economical growth. So what banks have to do, they have to develop another stream, and then of course the cost of compliance, yes, that's a bigger factor, that is definitely going up. But on the other hand, they should have a proper pricing strategy also, and then compliance cannot be compromised. So they need to do, because in the earlier sessions they are talking about IT tool is available for the banks to do everything. Even Mr. Manoj was saying that manipulation of documents also could be found out through IT tool if it is properly configured. So like that, they should think on these solutions, how to prevent all those things and support the regulator also, because regulator on one side, they are giving license to all the SMEs. So they also expect you to financially include them and protect them. And there is another concept, suspicious transaction reporting, suspicious behavior. If you notice anything suspicious activity, obviously you can report to the regulator. So my sincere request to all the bank people, because I'm here for the last 20 years, I'm studying the UAE economy. So the IT industry has to evolve and then guide all the banks, all the financial institutions to give them a proper reporting mechanism, which will help compliance to take the decision. So once that is available, and now majority it is fixed, because if you see last 2-3 years, the regulatory changes is enormous. They bring in a lot of regulatory requirements and things like that. With that new things, I would recommend a financial inclusion is must for the SMEs, and banks should relook their strategy and then project a different business plan for them.
I couldn't agree with you more, but if I were to play the devil's advocate and counter you and say, well, banks have thought about all this, thought about many of the things like the need for financial inclusion. They've thought about the economics of maintaining a portfolio. They've looked at their risk-adjusted returns on asset and on capital, and arrived at what is a reasoned decision to say, okay, let's get out of this market. Let's not do it.
See, because they say
to
about the
appeal
cost
to
of
them
compliance.
would work up to a point, but at some point it's a business decision. And so where do you go from there? Are we pushing these sort of customers into shadow banking? Are we pushing them off the radar and forcing them to look for source of funding which is unregulated? You already see that happening in the trade finance space, and I'm not saying unregulated, but not as regulated as the banks. You see non-bank financial institutions offering commodity finance services, supply chain finance, and the like. You've got technology companies doing that. So given that situation where banks have decided they choose to exclude that segment of the market, it's a conscious decision. So how do you respond to that?
No, that's what I'm saying. See, they have to, they have to take the regulatory guidelines. A lot of regulatory guidelines have come in the recent past. So instead of financially exclude this SME segment, they have to include it with a proper strategy and things like that. They need to revisit the policy. But 2 years back, if you see, the regulatory guidelines were not much. So now the regulatory guidelines have come into the picture. They have to relook on the strategy, because all this de-risking has started 4 or 5 years back. Long back, but 4 or 5 years it was
That's again an old story.
Yeah, old story. That's old story. But they need to relook into that and start with a small scale. Okay, for example, one of the segment they can, even if it is SME also, they can go into the textile segment, electronic segments. So all those things, I don't think so. Trade-based money laundering will happen. But yes, all said and done, we need to have a proper due diligence compliance check, the vessel tracking, everything. Because neighboring countries, we don't know. They may shift the BOL, originally sent to UAE. Maybe they can shift the BOL also later. So all those things are happening in the market, but they need to have a proper mechanism, tool to do all those things so that they can give financial inclusion. On a case-to-case basis, they need to study and take a call instead of de-risking SMEs completely.
If I could just shift the topic to you, James, following what Sridhar has just mentioned in terms of encouraging financial inclusion and preparing the SMEs to be able to meet the requirements as such. So again, as an advisor to corporations, what would be the specific steps you think they should be taking in order to reverse or convince banking institutions that it's really worth their while investing in supporting SMEs?
Thanks. I think Sridhar makes some good points. I mean, financial inclusion is a community level ambition. It's very difficult to look at that at an institution level, for one bank, to take that, financial inclusion, because the point of financial inclusion, obviously I'm sure everybody's familiar with it, but it is that if you don't allow access to the legitimate financial system, you force those businesses down a darker path of financing, and therefore it is better to have those institutions within the purview of a regulator through a legitimate channel than it is to have them outside of it. So you need that at a state level or a community level, or national level, international level. I think if you look at it from the SME perspective here, I think currently there's quite a lot of confusion, and for me this started before the grey listing of 10 days ago. I realise I've mentioned this several times now, but I do think it's important. I've had calls from all sorts of businesses that could fall well within the SME definition, asking about setting up a financial crime framework, or what do they have to do for sanctions compliance, and what are the regulations, and are they regulated or are they not? I don't think that's a confusion from the regulators. I think that is a misunderstanding sometimes in the market. I'll give you an example. I had a car dealership that sells high-end cars, and they contacted us and said, we routinely sell high-value cars in cash to wealthy people based in the UAE, and we're getting phone calls from our banks, some local banks and some international banks, asking us for details about transactions that happened 18 months ago. And I don't have anything on source of funds and source of wealth. I might have you know, some identification information because that's what I need to sell a car.
Right.
But I don't have anything else, right? What do I do now? And that transaction's already gone. And so there's some confusion on both sides around regulatory requirements, what it means around risk. And I think, you know, that will even itself out in the UAE a little bit over time. But if we talk about de-risking, you know, de-risking by local banks versus de-risking by international banks, the local banks have a different perspective. Now, we are, as I've said several times now, theoretically viewed internationally as a high-risk jurisdiction as a result of the grey listing. In my view, it's perfectly reasonable for a local bank to have a different view of the risk of banking customers in this market than it is for an international bank who is sitting somewhere outside of the UAE and doesn't know the market so well. And therefore, it is perfectly reasonable for a bank here to say, actually, we have a slightly different, not a different quantification of risk, but a different appetite towards those businesses than an international bank might, because we understand them better, and therefore we're better able to judge what the risk is. Now, if you're an SME and you're based here, you've got to think about what your international access to, you know, to foreign currency is, as all my co-panelists have explained. If you rely on foreign currency of any type directly through a foreign bank, then there's one type of question that might come your way from that. If you rely on access to global financial markets through a local bank, so indirectly, there's potentially a different type of question that's going to come. In both cases, in my view, the answer is the same. And not every SME is going to get asked for all of this information, let's be clear. It's not the case that every business in the UAE is suddenly going to be asked for lots of documentation. But in theory, anybody could be,
right,
depending on what their arrangements are. So the best way to deal with that is to be straight up and transparent about how you manage the risks that those banks are going to be worried about. There are very good sources that you can look at to determine what banks think the risks are. Read the Mutual Evaluation Report of April 2020. It talks about risk in the UAE. There's a national risk assessment, which is somewhat accessible, which will tell you the same thing. But if you consider, you know, the obvious areas, transparency, beneficial ownership, we've talked about several times. The Ministry of Economy has already mandated that businesses need to have that information accessible. So make it accessible.
Right.
These are the people that own my business. These are the shareholders. It's as simple as that. Here's the evidence. Done. We don't have to worry then about whether there's some shady ownership structure that we don't understand. Right? Be transparent about that. If you think that there's a financial crime risk that needs to be managed, and again, presuming that you're in that SME sector which is not directly regulated by a financial services regulator, because there's a separate situation there, but outside of that, just consider the dialogue with the bank straight away. Get on the front foot. Talk to them. This is what's going on. What's your approach? What do we need to do? Do we need to provide more documentation? And do it. And actually, that sounds very simple, and maybe it is, but you know, I don't mean to make it sound overly simplistic, but I think now is the time to sort of take the initiative, right? There are going to be questions that come back the other way, and that doesn't necessarily equate to de-risking, but it might be going that way a little bit. Maybe if we can't get the documents, we'll terminate this relationship. If you're reliant on those relationships, get on the front foot, talk to people. Alternatively, try and open some other banking lines so that you're not solely reliant on one institution. But I think there's a number of things that could be done to try and get ahead of that.
From what you're saying, there appears to be a shift in mindset on the part of the business sector, where they're at least talking about what should we do in terms of financial crime compliance. And that's a huge move, probably in the right direction. I happen to be having a meeting this morning with a very senior banker who works for a significant local bank. And he was recounting his own experience. He said, you know, a simple thing like 20 years ago, if you'd ask any remitter, what is the purpose of the remittance? They'd recoil in horror and say, how can you even ask me that question? But today, it's just routinely filled in the form. And so the perspective has completely changed. So perhaps that's progress. And if we meet again and have the same discussion, let's hope we have something different to talk about. So before we wind up, Katerina, any final comments? I'd just like to take a round. Any final comments to what's already been said?
Yes, I'm referring to what James said about de-risking and in the terms of different type of goods. What is happening in developing countries, we are energy dependent. So we import the resources from all over the world. But basically, energy in the form of coal and gas. And something that maybe, I don't know, a few years ago I would say it was trendy to go green projects, sustainability, energy efficient and so on. But now I think it's a part of the de-risking of the larger banks. And whenever we have a transaction for the import of coal, which is a large one in millions of dollars or euros, it doesn't matter, we need financing or at least the confirmation of the LC. And now a lot of the larger banks are not interested in it. And not just the banks, but in recent times, the international financial institutions, which are here to support the developing countries, are also backing out.
So you're actually referring to selective de-risking that's happening at the next level.
Yes. Yes.
So it's not just at the institutional level, but it's now the business that you're doing, and that's being de-risked out.
Yes, and that's directly impacting the SMEs, but the country as well.
Yeah, the economy itself. Yeah. So it's choking.
Yes.
And it's progressive. It's not going to get better. Sridhar.
Yeah, see, I just want to tell the audience who are bankers, okay, just you need to have a meeting with your top management to discuss again and again. It won't happen overnight, okay? You need to tell them there are a lot of regulatory changes which have happened in the past. So with that, have a proper tool in place, have a proper compliance team in your place to monitor all these types of transactions, which they are doing for other major corporates. So they have to add on something to give a financial inclusion for this, SMEs. So thereby regulator also will get into the comfort zone, because otherwise they don't know these SMEs do transactions from where. Now banking have stopped. So now where they are going and doing, because something is hidden for the regulator also.
Right.
So instead, bank has got sophisticated systems and things like that. They can give an opportunity. Many players are really good because we are doing audits. Many players are really good SMEs, but they are struggling to have a banking arrangements and things like that. So my request to the audience is just really relook into the strategy, have a proper AML compliance framework, create an awareness, maybe call for one session, all the SMEs, and have awareness sessions with them. Tell these are the documents which are required as per the regulatory requirements. If you can give, we can look into subject to the compliance approval. So like that they can take it.
That's, I think, a very good call for action, and hopefully somebody then implements it. Good for that. I'll just skip James, since you just had your thoughts expressed. Anna, any final thoughts that you'd like to contribute?
I would just recall on what James said about basically educating the SMEs as well and educating the banks, that it's going to be, of course, extra cost, but this is a very critical point that has to be probably taken as a takeaway. And I see some of the representatives of the e-platforms, which mainly have this type of the education.
Right.
SMEs are very irritated when the bankers get to them with the questions. When they're in a hurry of the payment, let's assume that the payment will be made, but it's just delayed because there are lots of questions, a lot of document requests. So if we try to educate and just open to the SMEs, and so we have a common understanding of why the banks are asking for this type of documentation, and the SMEs would be more open to collaborate, I would say, and they will be ready whenever they're providing the payment. They will have the documentation ready when they know that there could be questions asked. And there are a lot of online training providers today, and I'm sure that it will be tomorrow more as well. And it's very important to educate in this manner SMEs. And someone today mentioned that the bad guys are also getting smarter, and this is no never-ending story. They will always get smarter, and it's going to be a step ahead and step behind. And the fraudsters are going to get smarter, and probably that's why it's less discussion between the banks and SMEs and regulators, because everybody's afraid that within these talks the fraudsters may get smarter and smarter. But I mean, solution is still an education, and so solution is more training, more people, and we see that AML and KYC departments are just sometimes more than ITs in certain banks and institutions. So we have to understand that there is a limit to.
To create a buzz and get some momentum. That's
Of course. Of course.
Well, final words, James, anything that you'd like to add?
I think it's all been very eloquently put.
All right, thank you very much. Should we have time for questions now?
Yeah, I think if we've one or two questions, we'll take one or two questions by all means. Yes, sir. Here you go.
I worked in an international bank for 25 years and then went to a third world country where a local bank was very active in trade. I learned. What I learned was that international bankers do not understand transaction banking and the SMEs. So, you know, while we are saying all of this, I think a lot of bankers are really divorced from the reality of a business of what SME is about. And we have forgotten the art of exception management. We have a tool, you make it or you break it, you know. So I think banks have a challenge of learning as well.
That's quite a damning indictment. Would anybody from the
But something in it,
international
though.
banks?
Something in it.
But we'll ask if there's any representative of the international. Yes, just a moment, sir. In response to what Mr. Nanji, right? Mr. Nanji's comment. Is there anybody on the international banking side who would like to respond to him? No takers? Oh, you gave up. You gave up without a fight.
I would comment that not even international banks, but the large banks representing the countries have absolutely different approach than the medium-sized banks in terms of the SMEs. They are more tailored and agile to SMEs rather than the large corporate banks who don't take many things into consideration and don't follow the supply chain of the transaction.
So a wider problem.
That's
Sir.
I am not talking about de-risking from the point of view of a segment of the industry, whether SMEs or a particular sector of the industry. I am looking at an individual customer and his relationship with the bank. And I can see that a lot of traders are moving out of formal banking for their trade financing. Like you said, you mentioned, and in my own customers are doing it. So when I asked them, why are they doing it? You know the answer came? What was the answer? They said like, okay, somebody enjoys, let's say $10 million credit line with his bank. He is talking to, I'm a buyer, I'm talking to my seller on a trade transaction, which would probably take a month or two. By the time I finish that and go to the bank says, sorry, now our policies have changed. You don't have a credit line at all. Whereas with the non-formal financing arrangements, they have much more stability in their business. And I am talking this on the belief that as much as the trader needs a bank, the banks also needs the trader, right? If you need your trade finance business to go on, I'm talking on that belief. Probably this is maybe a food for thought for the bankers. Thank you.
Actually, in responding to what you just said, sir, observing what's happening in some of the larger banks in Singapore, banks have made wholesale decisions that they're just going to stick to the top tier borrowers and they will discharge everybody else. And it's not because there's a financial crime reason. It simply doesn't make any financial sense to them as a business case. And they've decided if we have 5 big clients instead of 50, we're fine with that. And it's a conscious decision that's being made.
Sir, I feel financial, they're not making any financial impact. See, the issue here is the fear of fines. So that's why banks are just taking that call. Because otherwise they can make money on SMEs also. Because earlier they were doing all these things. Because fear of fines have created something, policy decisions.
So clearly thinking has changed. Yes, gentlemen. Is there a time for a question, Vin?
There's one here, and then we'll have a break. And later, yeah, go ahead, please.
So my question is for the panel. So rightly said, Sridhar, where you said that the de-risking earlier was 5 years back, it was a reactive measure, and now it's more of a proactive initiative by the banks. And then you have calls for financial inclusions across the developing countries, and then you have an ADB report coming saying that the global financial gap is, TF gap is close to 1.7 trillion. So do you actually see for the scope for a public-private partnership to draft regulations? And if so, can you throw some light if you have seen such initiatives around that?
See, I have not seen anything coming out recently, but I want banks to look into all these things and then come out with proper solutions so that you can give financial inclusion. Otherwise, what will happen is a lot of mergers, acquisitions will happen. All small traders will join with big traders. Okay, definitely they are going to be with the banks, but small traders will get merged with big traders. So that's what is happening, or they are looking into alternative source of things, as he rightly said. So they're, looking into, MSBs who can do this, or bringing cash and doing all these things. So which will create a lot of thing for the regulators, because regulators wanted a controlled economy, right? Whereas the control, if it is getting shifted to other places, then they cannot monitor. It's going to be very difficult. So that way, my suggestion is the banks have to re-look into the strategy and go with that.
Yeah, what I see is there's a big gap between the understanding from the bank's perspective and the customer, what he could supply, the documents or whatever it is. What I see the solution is like, fintechs can play a major role. Fintechs can come in and then, they can fulfill all the required documentation or whatever it is the banks are required. But unfortunately, no one is coming into this particular space and fulfilling that particular requirement. So as you know, one of my bank subsidiary, we have introduced a platform in one of the GCC countries that will fulfill all these requirements. They will come into, they will bring in all these stakeholders into a particular platform, and they will fulfill whatever the banks require. We have studied it, and then, the banks will, we will supply what are the banks, for an example, the accounting process or the transparency, what the SME, the bank is looking from an SME. So those type of things we have identified, and then we will fulfill these requirements. Hopefully, it will be a blockchain-based platform that will come out. So we are on the verge of completing it. Very soon it will be up and running. So, and I've seen in Malaysia also, there are many fintech companies which have this type of solutions, which the banks, and they work as an intermediary between the banks and the SMEs, and it works very well.
Absolutely right, sir. I just second what you said. Because the banks, especially the compliance department, have to demonstrate to the board of directors. We need to look into a solution which can give us all these answers so that we can perform. So that's IT, like last session, Manoj has beautifully explained that so many things are available there. So the compliance department has to take it forward. For that, the business has to direct them. Business has to put pressure on compliance so that compliance will take it up with the board for additional resources. That way it will solve the problem.
So in short, from what we've heard so far, what you're saying is that, well, the borrower constituency and the lender constituency have to decide that they're going to work together to solve the problem. Absolutely. And unless there's intent on both sides, nothing is going to change.
Nothing is going to change.
Sorry, Srinath, I have one gentleman here, and if I don't let him ask his question, I think he'll suffer from depression. So here you go.
Thank you, thank you. So I just want to ask this one question. Like, you're talking about clients and things. So how do you think this KYCC, knowing your clients, customers, and creating a group, how much do you think that can help, reducing the risk both for the bank and the clients?
Well, my personal experience has been, because I've been involved in some projects where banks have taken a big step forward in really getting to grips with collecting all the information that they believe they should know about their client. And I'm of the view that I'm convinced that in the absence of a detailed profile and understanding of the client's capabilities and intentions and future directions, the bank is being more reactive. And so it's absolutely important that they make sure that all the gaps in information are actually filled in a timely fashion. It's only in the interest of the bank and also the bank's ability to respond to the financing and support requests that the customer will ultimately make on them. So it works both ways.
So to add what you said is, so KYCC and all, it's gone. Now it is KYB. The earlier session they're talking about, know your vessel. So it has gone up to that stage, right? So KYCC, bankers should have a, agreement. You should have an, agreement between you that, Wolfsburg principle is there, right? You need to demonstrate the bank what is that you have. They need to demonstrate what is that they do. So because it is their customers, KYCC is nothing but it is that bank's customer, right? Have a proper understanding and you can do it. And if they identify any lapses, anything like that, they need to communicate to you. If you notice anything, communicate. So it's absolutely the transparency, right? We all sign in papers, but nothing practically it's happening. That's what I have seen earlier.
So KYC, know your customer, KYC, know your customer's customer, KYV, know your vessel, KYC, I'm beginning to think it means kill your customer. Okay, it's really tough. But Srinath, I just want to say to you, yeah, this was a wonderful panel. Your panelists
Thanks to them.
dealt with very sensitive subjects, and you stewarded it in a wonderful way. But you dealt with so many sensitive things, and it's not easy to talk about them, but you did a wonderful job. So could we give them a round of applause,
Thank you very
please?
much.
Wonderful, really wonderful. So now we're going to go for a coffee break, and we will be back in about 20-25 minutes. We have moving into even hotter water, because now we're moving into economic sanctions update, and this is a sensitive subject right now, but we will do our best. And then, of course, there's going to be defaults as a result of challenges. We'll be hearing about some defaults, but then we are going to relax, okay? So enjoy your coffee break.
Okay, forward and back. That's all. Thank you.
Hello, hello, hello. Hello, hello.
Okay, everyone, we're going to start in 1 minute for our last kind of session. We have two components in this session, but I think you'll find it very, very interesting. The first component is going to be looking at sanctions, update on sanctions, and the de-risking was a very sensitive subject to talk about, and our panelists did a wonderful job, but I think the next session on sanctions is also a challenging one. So we'll get started in 2 minutes. Yeah, it's the carrot cake, is it? Okay, okay. Okay, well, better make sure that we have all our speakers here for a start. Yeah, okay. Habib, you're looking good, Habib, doing a good job. Yeah, oh yeah, Robert is here, and Graham is here, and Khalil is all with you. Okay, let's go. Okay, everyone, we're moving on to sanctions, which is a particularly challenging subject at the moment. And just to set the scene, one of our speakers at the IIBLP, who is here regularly, but he's not right here right now, that's Herman Anik, and he's always very popular talking on sanctions with the IIBLP events. But he's not here right now, but I was with him last night, okay? And we did an interview last night, late in the evening, where I managed to catch him. So we have a 6-minute video. It's only six minutes, but I think it's going to actually help us set the scene. And we'll play the video, and then we'll be joined on stage by Robert, Graham, and Khalil. Okay, so this will take 6 minutes. So you can roll it now. Thank you very, very much. Let's go. Yeah. So here we are at the IIB-LP Trade Law and Compliance Conference 2022. Moving on to sanctions. So kicking off, I am very pleased to be able to interview Herman Anik, who is an expert in sanctions and related compliance, and he's been a speaker with IIB-LP for many times. So very welcome, Herman. Nice to have you.
Thank you, Vincent. Happy to be here.
Great. And so if I can just kick off, in all fairness, sanctions have been around for a long time. And but actually in recent times, we've seen an escalation like we have never really seen before. So can you briefly give us your take on the current sanctions, the world of sanctions right now?
Yes, thank you. Yeah, actually, of course, the invasion by Russia to Ukraine resulted in a fierce escalation of sanctions of both the US and EU towards Russia, right? And I think that these sanctions reflect let's say, the current way in which US and EU try to manage these kind of situations. US often uses hit them where it hurts, meaning that they are really aiming at isolating countries, in this case Russia, not only to aim at the oligarchs or Putin himself, which you can ask whether that would be very effectively, but to really isolate a country from all financial infrastructure, but also, let's say, all international trade and what have you. And I must say that this impact on Russia may not be, let's say, only exclusively for Russia. And as we know, there are increasing tensions between US and China, particularly on technology issues and issues with respect to offshore and maritime sector in the South Chinese Sea. Yeah, and I think that, let's say, this current Russian situation and, let's say, the viewpoint of China on all of this may even further escalate situation. And in Europe, in the Netherlands, there has been mentioning a food emergency situation in the world due to these sanctions on Russia, who cannot export, let's say, any agricultural wheats or grains. And now with the war, Ukraine may not be able to do so. So the question is, what kind of impact would this have already alone on the food situation in Middle East, Africa?
Okay,
right, so,
given the complexity of this, okay, and the scale of it, are we kind of heading into the perfect storm? Are these uncharted waters where we have not been before in terms of sanctions?
Yeah, I think so. I think that particular distances and differences between countries are being magnified at the moment. Of course, we had the sanctions on Iran for quite some time. But if you look at the current situation, we might look at a splitting in two of the world. Let's say getting back decades where we had the same situation between East and West, Russia and China. And the question is, of course, how will Iran move into this as well? We have had hopes that parties would join the table again on the JCPOA in order to further move ahead, also from a humanitarian point of view. And all of this, I mean, current situation with China, current situation with Russia, Iran, how is Syria going to look at this? In my opinion, that doesn't look very positive. And the effect on international trade alone, and also having regard to the humanitarian situation, may be fierce. Sober towards the future, if I may say so.
Yeah, I can understand that, Herman, and the amount of clarity on what you have actually outlined is actually quite scary. But when I look at the audience and the people we have here today, operations people in trade finance, in all aspects of trade actually, and we're part of the ecosystem. Can the ecosystem handle all this in some kind of a standardized or structured manner?
Yeah, that's a very good question, Vincent. And what I observe, for example, is that the issue of sanctions is no longer, let's say, a technical compliance aspect of doing business. We have seen many companies in the EU and others, and also US companies, that retreated from Russia actually voluntarily from a reputation point of view as well. If I may say so, these kind of developments are not, let's say, restricted to the pure technical sanctions aspects alone. And this is not just a matter of checking. This goes far beyond that. And we are looking at quite complex trade restrictions. We are looking at restrictions on technical infrastructures and means to be provided to countries. Think about semiconductors, for example, or food issues. Right, but also, let's say, security and cybersecurity issues, which also comes into play when talking about, let's say, the specific aspects on Russia and China.
Yeah. Yeah.
So all I'm saying is that for the audience, to keep in mind, this is not purely a technical aspect of sanctions. This goes beyond that, and it may impact companies that are internationally active in all aspects: reputation, their trade strategy for the coming years, particularly on the goods traders, banks in the trade finance, and let's say their financing of, let's say, the transactions as such. So all aspects will be impacted severely, in my opinion.
Well, Herman, you've really given us a fantastic picture of the current status and where it may actually be going. So you've set the scene for our panel, which comprises legal experts, operational experts, technical experts. So we're going to pick up. But Herman Anik from IIBLP Trade Law and Compliance Conference, thank you very much for your valuable time and attention. Thank you.
My pleasure. Thank you, Vincent. Bye-bye.
Khalil, please come to the stage, and I'll leave it in your safe hands to move forward.
Vin, thanks very much indeed. And thank you, Herman, for that, the long-distance summary of where we are. And I think, as he was saying there, this is pretty much uncharted territory globally for the nations that are involved in these sanctions. And I think it's worth just to give an idea of the complexity of this, to have a quick rundown of what's in place sanctions-wise at the moment. And this is a very quick overview. Starting from embargoes on whole regions, like the so-called Donetsk People's Republic and the Luhansk People's Republic, which are the puppet regimes that Putin's installed in parts of Ukraine, through to blocking sanctions on entire Russian banks like VEB, PSB, VTB, Novincombank, blocking sanctions, of course, famously on Vladimir Putin himself, the first time I think a head of state has ever been directly sanctioned by name, the Ministry of Foreign Affairs, his close allies, importantly their family members, because most of these Russian elite oligarchs have already dissipated most of their assets through their family members, so that the luxury yacht that's been found, I won't mention which jurisdictions, I don't want to embarrass anyone, are probably in the name of the grandson or something by now, rather than the oligarch himself. Sanctions which effectively ended Nord Stream 2, importantly, right through to the prohibition in the US of the importation of any crude oil, petroleum or petroleum fuels. That's an interesting one because, of course, in case anyone thought that there was any particular emotional reason behind the sanctions being put on Russian oil in different percentages by different people, you need to understand, of course, that the US imports virtually no Russian oil and gas. The Germans, on the other hand, 70% of their gas requirements come from Russia. Italy, 50%. No surprise then that they're dragging their heels on promoting those particular sanctions. But bit by bit, these are ratcheted up. Some of the sanctions do smell a bit of tokenism. The UK's latest today is to slap 35% on duty on various Russian goods. I can't remember when I last, I'm not a vodka drinker, by the way, I can't remember when I last bought any Russian goods in an English shop, but if I did, they would now cost 35% more. So, if you're a caviar fiend, for example, you'll find that your weekly hit is now costing you substantially more, and so it should. Let's face it. So that's the background to the sanctions, and I think the great thing is to have guys here who are having to deal with this operationally. I'll say a little bit in a minute about what we're telling clients in terms of dealing with this on a practical level, because there's the potential, I know, with with what's going on at the moment to sit watching the BBC News and CNN with your head in your hands and thinking, well, there's nothing much I can do about this. I'll let it all hit me and roll over me. The answer is there's plenty you could be doing to make sure that you either mitigate the effect of this for your organization and or prevent yourself getting into those problems. And that's, of course, Graham, is very much your neck of the woods. So I'll let you give your reaction.
Thank you very much. I actually agree with Herman. Some may say that makes a change. It's more than just technical compliance now. It is unprecedented. It's huge. I sort of tongue-in-cheek mentioned, Chelsea Abramovich in London. I am a Chelsea fan, but
Later.
Well,
no one's perfect, Graham.
That's why he's got a blue suit on. But the speed they had to move, and then allegedly the yacht is somewhere in Israel. And as you say, that they will move a lot quicker. But
he's been Instagrammed in an Israeli airport this morning.
Is he? Oh, he's in Israel. So, from a compliance banking perspective, we have to assess the information that's been put out there by the different regulators, by the different authorities, and there are a lot of associations out there helping as well. So I'm not going to name any of them because I'm not a salesperson, but there is some associations out there putting together these PowerPoints of the different banks with the time frames. So that's the other. This is what makes it technical: is the time frames of winding down certain things. Clearly, from a banking perspective, you've got to look at your client base. Herman said it wasn't just about technical compliance; it's about the business profile of your customers and how they're going to change their business strategy, their trading strategy. Does that impact on credit? Does it, on a broader field? And then there's the humanitarian side of it, which I'm not going to sort of delve into because it gets worse and worse. So, it's in one sense it's interesting. In another sense, we've got to see how things unfold and keep ourselves abreast. But it's impacting all parts of society, as I say, from football, to the business, and then from a compliance perspective.
Please allow me to give a little short background regarding what is a sanction and what is a sanction clause in relation to ICC instruments. A sanction, of course, is a restrictive measure prohibiting dealing with or facilitating transactions with governments, government agencies, countries, individuals, vessels, aircrafts, or prohibiting transaction in the form of importing or exporting certain goods. So this is the meaning of the sanction. In layman's language, it is like a law prohibiting certain actions. And these are issued by international organizations like the United Nations, issued by economic unions like the European Union, or by countries, the OFAC in the US, HKMA in Hong Kong, Monetary Authority. These are examples of authorities that issue sanctions that apply to all of us, mostly. So what's the relation of that to the letter of credit or all other instruments? In fact, the sanctions have been around for a very, very long time. Even they used to call them boycott clauses. But recently, in the 2000s and going forward, banks started including in their instruments, particularly and more so in the letters of credit, clauses that refer to sanctions. And the wording would go like something like, we disclaim liability in case any name appearing in the documents falls in the so-and-so sanction, and thereby we will not be liable for payment, return of documents, action, inaction, and so on. So after the proliferation of those sanction clauses in the ICC instruments, the ICC Banking Commission issued a guidance paper in 2014 to guide what is appropriate and to try to discourage inappropriate wording of sanctions. And later on in 2020, it issued an addendum to that guidance paper. And the guidance paper has a sample sanction clause. It does not recommend that the banks use this clause, but if it has to insert a sanction clause, then this could be better than what we see in the market. Because what is problematic about the sanctions, some of the banks are not specific in their sanction clauses. They try to cover everything. They would say the sanction would read like, we disclaim liability in case of an application of any international sanction. And this is not specific. It is difficult for the other parties, whether the beneficiary, the confirming bank, to know what are you referring to. And to the extent that some of the banks include their internal policies and procedures as part of their sanction clause, which should not be the case. And this is the principle. The sanction clause should be clear, should be concise, should be only in reference to what is mandatory, externally mandatory on the bank and applicable to that bank. So what's the value of inserting a sanction clause in a letter of credit or other trade finance instrument? At least it puts all the parties on notice. So you as beneficiary, confirming bank, or any other party involved in the transaction, you know this transaction is subject to the so and so specific sanction. And it also provides protection to the bank. I feel sorry for the beneficiaries, confirming banks that have reimbursed beneficiaries in good faith when they fall victim to the sanctions, where the sanction applies after the shipment has occurred. Suppose that you ship on a certain vessel, and at the time the vessel was not on any sanction clause, but it is added later on, after the shipment. Or a new sanction has been issued after the shipment. So this is problematic for those beneficiaries. Also, the issuing bank has a problem because the issuing bank would need to screen all the documents, all the names in the documents to verify whether or not those names are part of any sanction regime that is applicable to that bank. But these names are on hard copies. These are not soft copies to run through a system. And some of the banks, of course, they run OCR, optical character recognition, but most of the banks don't. And this is heavily manual.
Okay, that's a very, very interesting point. I think one of the big differences this time around with the way that sanctions are operating, I've seen this on a very practical level. 2 weeks ago, I was sitting down negotiating a revolving credit facility for a major commodity trader with a bank. We were having a real nuts and bolts examination of the sanctions clause, what could be allowed, whether certain licensed activities would be allowed. And already I was noticing amongst the syndicate of banks a veering towards a much more hardline approach to this. And what we're seeing already, I think, and I think Herman was alluding to it in his interview, is that really people have got to sit down and discuss what their business strategy is going forward. These sanctions in and around Russia in relation to Ukraine are simply not going to go away, even if there was a solution on the near horizon, and sadly there isn't. These are here for a generation. This is a game-changing position in relation to the way that the business is done there. And I think, Graham, I'm interested to know from your perspective, you mentioned already that there are wind-down periods, there are specific licenses, there are certain transactions, energy transactions, where the time runs out very quickly. There are letter of credit timelines which run out a bit later in some cases. But either way, we're looking at a relatively short term in which people will have to reassess completely how they're doing business going forward.
You're right, Robert. It's funny because I'm an optimist, and I always try to find how are we going to unwind the controls we're putting in place now, and how would the world open back up again? And you alluded to the fact it could be a generation where we're going to be stuck in this debate of, will the sanctions get lifted? I'd like to think eventually something will happen. But then are the businesses going to have the appetite to even venture that far anymore? So
Germany and Italy are saying that they will wind down their dependence on Russian oil and gas by 2030.
Yeah.
So, you know, we're talking about a direction of travel which is not going to go into reverse before then, but that's because it's going to take them that long to get dependent on a different source of fuel.
And that's a massive challenge, you know,
Yeah.
for banks out there as well, if you talk about just the trade side of things. So, Herman said it's not just compliance technical, but there is a compliance technicality to it. You know, the different sanctions, the periods, we have to understand it as your trade department. You know, we need to sit around the table and it's evolving fast. You've just talked about today, what's happening, what's going to happen tomorrow, and how far out will they go? I think that's the thing. And as practical advice, if I could leave, any organisation needs to look at its client base, whether it's an FI or whether it's a business, its supplier base, and assess a close association to others that are already been sanctioned. So a bank would be looking internally now, you know, do I have any other exposure, not just from the elite today, but how broad is my sort of exposure if this gets worse? And you know, it can't get much worse than it is for people out there. So I'm not saying that it's not bad today, but you know, if this continues, how far out will this go?
Yeah, and I think one of the other things, apart from the fact that many lenders have already decided, even before the specific sector or specific names have come on, if you go and knock on the door of most banks in the West, they're not even entertaining a Russian name. They're not really interested what it's for, what the commodity is, what the sector is. They're just putting it to the bottom of the pile. That is the way that's how much anxiety has been generated. To give you an idea of how the politics of these sanctions works, many of the countries that you would think would be the most likely to not want to aggravate the Russians are the ones who are absolutely at the top. To give you an idea of the countries which are literally dependent on Russia down to the last drop of every fuel that's used, Lithuania, for oil requirements, Lithuania, 83% of its oil. Finland, 8%. Slovakia, 74%. Poland, 58%. Hungary, 43%. But some of those first three countries, as I mentioned there, are the ones who are absolutely standing and banging their fists and saying, sanction them, yet you've got still a mixed message going, but I think the general direction of travel clearly is going to be for that to be ratcheted up, and as I say, over a long period. Khalid, from your perspective, are you seeing any business with Russia at all now?
I don't have any information regarding Russia. It is still recent. But my experience with sanctions, I'll tell you my experience with sanctions. I come from Sudan, and the country has been under USA OFAC sanctions for 25 years. And the sanctions, the objective of the sanction is to modify the behavior of the government, the ruling party. And it did not change that a bit until the government was toppled by a popular movement. So I wonder if the sanctions would change the behavior of the Russian regime. I doubt it very much, as long as there are many alliances and there are many dependencies on the exports of Russia. So it's not an easy job. But getting back to the trade finance world, as we mentioned in the morning, it is always important for a bank that issues or confirms a letter of credit to examine the documents and issue a notice of refusal if that's the case, if the documents are discrepant. Do not only depend upon a sanction or any other injunction by a court. Why? Because the sanction might be lifted later on, or you could be wrong in your interpretation of the sanction. So always examine the documents. If they are discrepant, issue your notice of refusal.
One of the points that comes up very often this time, and I remember this from both the Libyan and Sudan sanctions regimes, is that people are often very confused by what the position is, particularly if you're a confirming bank, where you have already paid out to a beneficiary, which then becomes sanctioned. And I think Khalil was alluding to this before. First of all, of course, you have a grace period through which many of these transactions need to be unwound. However, what happens where, for example, there is a deferred payment letter of credit, so that actually some distance in time has gone between the moment that the confirming bank has committed, but then is entitled under UCP to its reimbursement from the issuing bank. And I can tell you that as unmeritorious an argument as it is, issuing banks have a habit of coming back, particularly if the underlying applicant, for example, turns out to be sanctioned and penniless, to say that they don't have to reimburse the confirming bank because one of the parties in the underlying transaction was sanctioned. Well, it's not correct. The position is that if you've already incurred your negotiation commitment, in other words, you've paid out to the beneficiary as a confirming or negotiating bank, your only involvement from that point in is to collect the debt that is owed to you by the issuing bank. The issuing bank owes the money to you as the confirming bank personally. It doesn't owe it to a sanctioned entity, assuming that the confirming bank itself is not sanctioned. So that's one of those things which you'll see issuing banks frequently try to run that very, very poor argument, but do resist it. Of course, part of the problem is that sometimes these issuing banks don't have a huge number of assets in a country where you'd want to chase after them, and it may not be particularly attractive to race after them in the jurisdiction where they're based. But nevertheless, they're bound to pay, and if you can pursue them in the location where you are, and there are assets there, then you can collect them. And I'd recommend that that's exactly what you do if anyone tries that particular angle.
Robert, to me, it is clear that an issuing bank has to reimburse a bank that paid in good faith.
Correct.
In the case of fraud.
Yeah.
But with respect to sanctions, it is doubtful, because it depends upon the sanction clauses themselves. Maybe they prevent even reimbursing a bank that paid in good faith. You are a lawyer.
Yeah, well, I'm ignoring the sanctions clauses for a moment, and we know that sanctions clauses have a particularly unfortunate history. The ICC has given its recommendations. At least one bank, I know, a major bank based in the UK, always took the view that sanctions clauses were completely unnecessary because to pay in contravention to sanctions is itself illegal, and no bank will do anything that is illegal. To have a clause which says more than that is simply superfluous, and it dilutes the value of the letter of credit. And it's always been my recommendation to people to resist anything that goes beyond what is effectively a recital of the law. Many US banks, by the way, insist that they have that recital of the law because optically it looks really good in compliance. And that's half the reason for it.
At least the sanction clause puts the parties on notice.
Yes.
This is the minimum.
Yeah, it puts them on notice. But
whether the sanction clause will provide you or your correspondent with more legal protection, that is debatable.
Yeah, no, agreed. How are we for time, Ben?
I think we can take a question or two.
Yep.
I think that would work very, very well. And wow, yes, here. Srinat, great. Here we come. Thank you.
Thank you very much for that very interesting discussion. Two questions, or rather one arising from an observation. I recently had occasion to view some letters of credit received by an edible oil exporter in Malaysia, and it included the standard sanctions clauses. And what I understood from my reading of that sanction clause, that banks tend to make those clauses very wide, way beyond the scope of the trade itself. So is that, in a sense, the right thing to do on the part of the banks? And the second, I don't mean to be cheeky, but depending on where the sanctions clause appear in a letter of credit, can we treat it as a non-documentary clause?
Well, the short answer to your question is, of course, banks which have got a particularly hard compliance-driven view on this, and obviously US banks are at the top of the list on those typically, will always try and get fairly extensive clauses. And this, by the way, this is not something that's restricted to letters of credit. Facility agreements are awash with a range of both, anti-money laundering, anti-terrorism, sanctions wordings, which very often are poorly drafted and do not sit well with each other. And it's very often one of the really difficult parts of a negotiation of a document is to untangle that mess. And that's because people literally throw the kitchen sink at these clauses. And then there is an expectation, because they've achieved it once, they want to achieve it every time they issue a letter of credit, every time they issue a facility. But that's where you've simply got to stand your ground and push back. And the fact that the Russian-Ukraine situation is as it is does not provide cover for banks to simply ratchet up the wording. There's no reason for that. There's no reason to change the way that these clauses look. If it's caught by sanctions, it's caught by sanctions. I think one of the things which people should be doing at the moment are getting those contracts out of the drawer, looking at those sanctions clauses, which they waved through because, it was the small print in clause 19 on the 7th page of the contract. And it wasn't really very interesting at the time they were trying to sign the contract, or they really wanted the money at the time, so they didn't really look very hard at the sanctions clause that the bank imposed. Now's the time to pick those open and have a look, because the fact of the matter is that every bank and every counterparty is doing exactly that. So don't get caught out, do have a look at them. That doesn't mean you've got to go out and spend money on lawyers tomorrow, though I'd be delighted, personally, if you did decide you had to do that. But seriously, do take precautions.
In fact, there are several ICC opinions regarding those kind of sanction clauses, and the recent is number 920. And the conclusion is that the banks should not use such a wide net or in any specific sanction clauses. But if you are the beneficiary or the confirming bank, you should take some action. Do not accept those kind of clauses if you deem them too risky for you.
And by the way, the ICC opinions are free to members. You don't have to pay anything for those.
Yeah, I would say about the argument, it's a non-documentary condition. We can argue that any sanction clause is a non-documentary condition. So fundamental question is whether it's enforceable or not. And I guess a lot of banks are kind of confused what is applicable, what would be that mandatory law, regulation, sanction based on where I issue this letter of credit, where is it payable, in which currency, when I operate as a global bank. So I guess because of this confusion, some banks might just formulate these sanction clauses kind of open-winded to kind of feel, I don't know right now what would be applicable or in that particular case or not. I'm just wondering why these clauses are in letters of credit. If we arguably say only, whatever you say, only, let's say this enforceable ones, this mandatory sanctions are applicable. So fundamental question is, if I add with the sanction clause some other which are not mandatory, can I, because they are involved, included in the letter of credit or guarantee, can I use them as a defense? It's not mandatory, but it's stated there. Is it enforceable? Because there is big confusion, and even this ICC paper actually kind of gives you guidance, but does not tell you what, if I issue LC, which jurisdictions, which mandatory laws, sanctions would be applicable to the transaction.
I suppose at the end of the day, that ICC guidance document, and I remember seeing it in the very beginning through Lorna Strong, was trying to give guidance at a high level. You answered your own question in a little way, didn't you? You know, which currency, which jurisdiction, which corridor, and I think that's the problem. I think that's why, and I think historically, sanctions over the years, well, I think historically, I think sanctions were quite black and white. And then it become more and more complex as the regimes have opened up, and then there's different targets. And now we're on uncharted waters. The sanction clause maybe originally would have been appropriate-ish. And then just documents version 1.2, 2.3, it just kept going up. It stayed in there and then became a complex thing that now the ICC is sort of saying, really, you should leave it alone, because if you can't do it because of sanctions regime, depend on the corridor, the currency, and the jurisdiction, then you're not going to be able to do it by law anyway. So as you said earlier, I suppose. But I think it's a historic thing that was put in to believe that it protected the organisation when it actually caused more problems. And I've only been in trade about 6 or 7 years. I know Finn's been around a couple of longer than that. But it's been a debate around a table ever since I've been here. So I don't know how long everybody else has been speaking about it.
I think in a way the more interesting point about these sanctions clauses is that letters of credit don't come into being, magically. They don't drop from the sky. They're there because two parties, a buyer and a seller, have a contract. They agree to be paid by letter of credit. How many times have you seen a contract where the seller says, I'm going to sell you 50,000 tons of wheat, and you must issue a letter of credit with a sanctions clause in it? Never happens. And what I say to sellers when they're faced with letters of credit that appear with what are clearly conditionality issues around them is to go back and say, no, I asked for an unconditional irrevocable letter of credit. That is not an unconditional letter of credit. It's a letter of credit which now has a precondition that we do whatever pleases the bank's internal policy at the time. That is a much more interesting negotiating point, because you go back to the buyer and say, you've got another 24 hours to come up with a letter of credit that actually matches our contract. Go away and do it now. Otherwise, potentially, you're in default. That's a more interesting pressure point. Yeah.
Okay.
Are we out of time?
I think we're
Okay.
That was a wonderful session. Could we give them a round of applause, please? And just to highlight that this evening at 7:30 at the Sheraton Creekside here, you can see the swimming pool. It's blue. Like I feel like jumping out the window and jumping into it. But it's 7:30 and it's sponsored by or supported by China Systems. So thank you, Stefan and Tom and Graham and Joel, everyone for this. So we'll see you all at 7:30, right? Just here, 7:30. So we're going to move on to our final show. And Christian, please take the stand. So something of great interest is the ICC Trade Register and the ICC Trade Register report. So Christian's going to give us some key messages from the report of 2021, and maybe you'd venture one or two comments on how you think it might go going forward. But that's up to you. Over to you, Christian.
Thank you. Thanks, Vince. I couldn't say no to Vince, and I'm actually passing through Dubai. And so it's a pleasure to be here in person, to be talking. I'm not so sure that you've spent, this whole day talking about, I can see it, compliance, AI/ML, so this is completely different. And you might just be wondering, does this matter? And so what? You might be asking the question, what is there in it for you people? I will make it relevant. There is a big presentation. I know Vince told me share the trade register's findings for 2020 because of the pandemic. I've chosen not to do. It is there. I'm happy to take you through it. But I thought I should give you the history and why it matters. And going forward, there's been a lot of talk of blockchain, technology. You might know trade as a service. And I'm going to tell you the only known source of data is the trade register. So if you want to do trade as a service, you better not ignore this. Not because I run it, because it is the only known source of information. So what I'm going to do, start off is, I'm a history buff, so I'd like to tell you, where are we coming from? Why did it happen? Well, to be honest, before the global financial crisis, I'm not sure how many of you are familiar with the internal ratings-based approach or Basel II. And frank admission here, the banks were sleeping at the wheel. The regulatory changes brought about by the internals ratings-based approach meant that trade finance was calibrated with a maturity floor waiver of 1 year, which obviously, given that trade transactions are short-term, less than 1 year in general. Yes, there are guarantees and some other portfolios which are greater than 1 year, but if you start to look at it from a residual maturity perspective, the flow matters. And the problem at that point in time was, how do you then address this because once you have the 1 year flow, the capital constraints start to hit. And there are untenable capital costs. And here I will, if you look at it internally from a portfolio-based approach, you might say, why do trade finance? You're better off giving an overdraft and credit and lending, which has a 1 year flow. You don't have to worry about all this AIML trade, no problems, customer controls, everything is okay. So everybody woke up because trade finance does make sense. Unfortunately, they had to talk to the regulators. So the regulators said, show me the data. And that's why I said was the arrival of Dr. No, because they said if there's no data, we're not going to accept anything. So that was the genesis of the trade register. And I don't know, but some of you may meet at least 2 people who were the founders of the register. They're not in the room. They are Stephen Beck of ADB and Mark Uban of WTO, who are both here today. So possibly this evening, you may meet them. So they're the ones who, along with Kachai, as Vincent O'Brien and some of you may know, who were the real movers to get the trade register going. And there's a reason why I'm telling you all this. So what did we do? So the fundamental issue was data. Data, provide the data. And I'm going to tell you and make this relevant for you because you're sitting there saying, this guy is talking, this doesn't matter to all the banks in this region because it's the standardized approach. And I'm going to show you why collecting data. When we started out, we did not know how useful this was going to be. But many of you may know something called IFRS, International Financial Reporting Standards, and the US Generally Accepted Accounting Principles. And how this data can be useful, and that is the only reason, the only takeaway why you should be interested. Because if you look at the pandemic, the expected credit loss charges and provision charges were enormous. We've seen write-backs. And to get those write-backs, this data is useful. Particularly when it comes, you had the discussion in the afternoon on guarantees, and particularly financial guarantees. If you think the 100% credit conversion factor makes sense, you've got something else coming. I have something else to share with you. So what did we do? A consortium of banks under the ICC sponsorship, the sponsorship of the Asian Development Bank, which is Stephen Beck, got together to start the trade register. We got Oliver Wyman in to do this and collect data on short-term trade finance. And I'll give you, for many of you who are practitioners, these are import LCs, export LCs, performance guarantees. We don't do financial guarantees. We've started to expand that. And it was the core suite of trade finance products. It also included export credit agency data on export credits because there was a specific issue. Of course, and I'll put up my hand and say all these were issues exclusively impacting US, UK, European, Australian, and Canadian banks. Okay, standardized approach, banks following the standardized approach as much of the region, it does not. But how this data is useful for IFRS, what makes it relevant for you is what I'm going to tell you. Okay. So we started to collect in 2008 and 2009, and we now have about 25 banks, 17 in the short term and 7 in the long. This is an area which we want to grow, and the reason I'm saying this, I'm open about it, the more data you have, the more robust it becomes, the more useful it is, and you can actually then start to use this, even if you're on the standardized approach, for your accounting, right? And that's why you need to be, pay attention to what the register provides. So what have we done, and I mean, this is the crux of the, so we've grown quite a bit in the sense we've brought in Global Credit Data Consortium, which is a non-profit organization which actually crunches the data. They have the pipeline, 55 to 70 global banks are members. So the methodology is aligned in terms of probability of default, loss given default, credit conversion factors, exposure at default. And one of the biggest things we've done is guarantees portfolio again. You have a CCF of 20 for performance in the EU, as all of you are familiar because you would have seen it. Oh, the European banks are very competitive. They don't apply a 50% CCF. All based on empirical data. That's the first thing I'll tell you. But it's a different matter, and this may be, another good piece of news, but not so good for the European banks. The EU's new Basel III rules they want to do away with the 20% and move it back to 50%. So I'm involved in some of the negotiations going on there. But what we've done is, importantly, we brought in also BCG to do the data analytics and the reports. We brought in, and what we've done is we've aligned the data from a regulatory modeling perspective. And this is important because I'll come back to the accounting, what we've done there also. And we've used the trade register for regulatory advocacy, and I'll come back to tell you exactly what we've done there. Because without this data, the Basel Committee will not talk to you. The European Banking Association, EBA, will not talk to you. You go to APRA, the Australian regulator, where's the data? So if you have the data, people, I know many of you may not be in the regulatory policy side, or even to your internal risk guys, using this data to get what you want, whether it is from a risk modeling or a pricing perspective, many banks have started to use this. Okay, and we've also expanded the scope of the products. We've got supply chain in now. The next is receivable finance. But, I can tell you, getting this done is like herding cats. Getting banks to agree to anything is a problem. So we have a very simple rule. So we say, okay, we've got 20 banks, but if at least 6 banks, because there is a principle underlying this data, which is the underlying principle of the Global Credit Data Consortium, you give data to get it back. You don't give data, you won't get it back, and this is very, very critical, because any regulatory advocacy which you do should be based on this principle. And it does make a difference, because there is questions when you do this data. Is it robust? Is the methodology fit for purpose? And most importantly, is it representative? Now, I can tell you some banks, because of the size and the global nature of these banks, they do make a big difference to the database. One person pulls out, makes a big difference to what you see in the numbers. As they say, an average, you can have your head in the fridge and your feet in the coal, and the average is anything between the, between the two. So you've got to be a bit careful with the numbers, okay? So, okay, so the question comes up, what have we done? And this is a question, I'll be very honest, many banks, when they joined, They wanted the maturity flow waiver. We got it. In fact, Mark Oban, who's here at WTO, very responsible for actually pushing the case. So we've also managed to get, as I told you, in the EU, 20% credit conversion factor for performance guarantee, all based on empirical data, which points to a lower credit conversion factor. We got the maturity flow waiver. More importantly, and this impacts you people also, the leverage ratio, the initial Basel document said all exposures at 100%, including contingent liabilities, guarantees, letters of credit. It was the data in the register which the Basel Committee used as a reference point to keep the 20, 50, and 100. So that was the other win. We've also used it within the European banking regulations, the EU, from a net stable funding ratio, a liquidity coverage ratio perspective. These are, I'm happy to go into details if need be after the conference, because this goes into minutiae and technical aspects. But the good thing in the EB, with the European Union, we've seen, and even the PRA now after Brexit, they do talk to us. We provide them the data, whether, so it's a dialogue. We provide the data. And on the credit conversion factor, as I told you, the European Union wants to go back to 50%. It is pure politics, and I will tell you, a lot of banking is all about politics. I was amused when I was here hearing the session on SMEs and what can be done on inclusion. Well, I always refer to the European Union. Take a leaf out of the EBA regulatory guidance. They give preferential treatment to the SMEs, right? The US does not do it. The US does not. But the US, you have to understand, the US can afford to do it because it's capital markets driven. The top 20 banks are subject to different set of rules, right? There are 5,000 small banks who can do what they want, so there's no issue there. But when you talk of SMEs, why do banks don't lend? Well, the default risk is high. Absolutely. So I will simply pose the question back to you. How many? Yes, banks do have a problem. If you say no to an SME, do you have the data? No, you don't. I know that because I helped Steve Beck to put the ADB survey together. So yes, you can have inclusion. Collect the data. Without the data, the fundamental step, you're not going to get anything done. And I'm not talking because I've been with the register, but I've seen it through experience. When you try to do something, I've been involved at the B20, at the trade policy negotiations, in crafting this. It's not easy. So there's get the data. That's why the principal message, data. And you need to, and we need to be, just like you're doing it for compliance. There's a lot of data. Can be sensible about it. Okay. That is all I have to say, but I'm happy to share with you what we did with the register was, we were about a year late. Because of the pandemic, we brought it up to shape. There's a whole set of slides, but you can see default rates, absolute levels have gone up, but as an asset class, if you see, they are well within the limits of lower than what it is for other asset classes, right? This is on the, as I said, loans for imports, performance guarantees, export LCs, and import LCs. I also show you this is a comparison across other asset classes, trade versus, and this is important for you again, because when capital is scarce, when you have a capital allocation decision between credit and lending and trade, this helps you. You can see this, right? And by the way, the other asset classes information comes from global credit data, 20 years of data, very large, robust data set. Trade finance, less than 20, but 10 years of data, okay? And getting increasingly robust because of our alignment of methodology. in that. So, and these are a couple of, for supply chain, it's a smaller data set. We started only 3 or 4 years ago. But the higher default rates are a reflection of what has happened in some of the Western world and in Singapore, right? So this shows up here. And you all may have known, of course, the default on green cell and the related issues with supply chain. So this is the medium term and the Export Credit Agency. And I'm really happy to show we were able to track the fact that, at the height of the pandemic, we saw that a lot of these cruise ships and other liners, right, they had run into difficulties. It was picked up by this data. 2020, it was timely. We published it in October. Absolutely timely, okay? So with that, I'm not going to take up any more time. I'm happy to answer questions, which I hope I've kept to time.
Yes, you have, Christian. You kept very well to time. Any 1 or 2 questions? Yes, Khalil, of course.
Thank you so much. Do you see a room for predictive analytics in this sphere?
Sorry, if you could.
Do you see a room for predictive analytics?
Yes.
Tell me how.
I'll tell you. So I refer to trade as a service, right? So at a product level, at a default level, I'll tell you what is robust, what is not. We are very good at, we calculate default at transaction, exposure, obligor level. You do get, and what the regulators and what we understand as traditional bankers are obligor-based default rates, right? But when you move towards predictive, and like your Alibabas and the Alipays, you need quick decision making. You need transaction default rates. You need exposure default. This does have it, right? At a product level, okay? So what we do see is credit decisioning systems moving from an obligor base to an exposure. Again, to build that, as anybody in the retail side will say, you need the goods and the bads, right? So like that, you need data here, right? Now, that data, when we look at obligor in the traditional credit risk world, you're looking at financials, you're looking at other things. By the way, financials are outdated. I'm not talking this region. By the time you make head or tail of a balance sheet these days, I confess, I don't. Right, despite being in lending for a long time, okay? And in fact, if you look at a bank's balance sheet, next to impossible. If anybody can put up their hands and say they understand a bank's balance sheet, I'm willing to bow down. It's too late, Stuing, and that's why you need data, to put it in short. You need data, otherwise you can't get any predictive. Yes?
Christian, here we go.
Mr. Ramadurai, you referred to banks who are giving data. That number was something in the region of about, 17 or 20 or something like that, right? So is that representative of the global picture or?
Global, okay. I gave you, if it's at the Global Credit Data Consortium level, it's for 20 years. For trade registered 17 banks. I'll be very honest. These are banks, European, UK, 2 of the biggest banks, America, Australia, Canada. Okay. Is it representative of the trade finance data set, if that's your question? And if I go by the WTO numbers on imports, it's about 30%. Okay. Not more than 20. And this is not my estimate, BCG estimates, right, who write the report. And BCG does have a lot of, because they run their own rate. So it's 30%. Because if you look at letters of credit, see, there's a lot going on in the open account, as Vince will tell you. Supply chain, and we've just started on supply chain. The big asset class, which is not here, is receivable finance. But once you get receivable finance, and it's very hard because there's a lot of factoring houses who are non-banks, right? So, but we do want to bring it in, and that's why my plea is please join. Till we did the accounting, I would have said if you're on the standardized approach, you you would have questioned me, what do I get from this? But today I can tell you, okay, by the way, I need to tell you this. We've used this data in banks to get accounting provision release. It's simple fact. IFRS modeling follows PD, LGD, EAD modeling based. So even if you're a standardized approach, I know there's one consulting outfit here which has sold a lot of data, and I'm told there are a lot of questions. You start with the regulatory parameters because you don't have any other data. The empirical data, by the way, on financial guarantees is not 100%. Absolutely robust methodology based on defaulted customers indicates 40 to 60%. And when I look at the performing book, it's much lower. Right? The problem we have, so we need more people. We need more data to make the case, because I can tell you, the Basel Committee, when we did have a conversation with some of the guys, they were surprised. And they said, what about losses? We do have the data on losses, because this is what we've gone back to the EU. And by the way, in my conversations with the EBA, not a problem. This is politics. This is the European Commission, because they want to keep the SME factor. I get it completely. The SMEs are more important. Something has to give. So we all think, the capital and bank regulation is all numbers and all rational. No, there's a bit of politics also at play. And as I told you, the US, they don't believe in giving any adjustment for SME. They can afford to do it, because the people who do it are not subject to the Basel rules. So understanding that is critical. That's it.
Well, Christian, thank you so much content and data in such a short period of time. Could we give him a round of applause, please?
Thank you.
Thank you. Wonderful job. Great to have you here. So, we have a few little things we got to do, okay? A few little things we have to do. And one of them is we're going to take a group photo in a few minutes, in about 2 minutes, and then we'll be finishing. So in 2 minutes, I will get you kind of to stand up. Khalil, you don't look like you want to stand up, okay? Okay, you got to stand up, and I'll get you to come forward, turn around, and a photographer should be up here, I believe, and they'll take the photograph. But before we do, I have two other things I want to do. And number one is a quickie. And one here is, I have a very wonderful book in my hands on documentary credits in practice by Pavel Andele. I read his earlier book, and I thought, Pavel, your earlier book was good. Okay, I thought it was good. Not brilliant, but it was good. But I tell you, this one is amazing. You've really done a great job. And so, really, really great. Excellent. Okay, top class. Okay, so what we're going to do is we're going to have a competition. And during today, we were talking about letters of indemnity, we were talking about bills of lading, insurance, etc. So I'm going to ask a question. We're going to have a quiz, okay? And whoever shouts out the answer gets the book, gets Pavel's book. And I'm going to give you a hint. The answer is a number, okay? Now, when I ask the question, I don't want someone to shout, a number, okay? You got to say the number, okay? Okay? So today we talked about bills of lading, and someone asked a question on the chat about bills of lading and documents of title, and they're asking about bills of lading. Then they asked about charter party bills of lading. Under UCP 600, what article is charter party bill of lading? That was definitely a lady. Alex, you are not a lady, okay? Just let's be clear about this. So could you come forward and we present you with your book? Could we give her a nice little round of applause, okay? Please come forward. Yes, okay. We get a photo later on, Pavel. Thank you very much. Okay, thank you.
I said in the range of 19 to 25.
Well, next time. The next thing is just to remind you that this evening we have the welcome reception. Don't forget it. We want to see you there. We want to network. We want to talk. And it's right here at the Sheraton next to Emirates MBD around the swimming pool. And it starts at 7:30. We will get together. We will have a coffee. We'll have a drink. We'll chat. Some food as well. So see you at 7:30. And the last thing I just want to say is I really thought it was a great day today. And, I learned a lot myself, but something kind of stuck on my mind. And it came from our de-risking panel that, You know, it's getting really tough because, you know, the way sanctions unfolded earlier, for example, many banks did something that was legal, that was correct, that we heard it, the practical stories, moving your dollar correspondent from one jurisdiction to another, because maybe you were being de-risked, not that you were doing anything wrong, but a major bank thought it just didn't make economic sense to have you anymore. So then they find somewhere else, okay? Some other place where they can have their dollar correspondent account. And now the world has changed again. But these banks have to survive. Their people have to survive. They have to trade. So what's been happening is, you know, in this crazy world of ours, the unintended consequences are that people will have to do things that are illegal in the current environment to survive, okay? And this is unfortunate, and this is something we must really think about as we go forward. So back to better and warmer things, or happier things. Please, we're going to get your photo, okay? And I want you all to stand up and come close to me. Now, don't worry, I don't bite anyway, not until after midnight, okay? So come closer, and we'll be looking up here, yes. You look at the light. Oh, yeah, someone can come up here on stage. Oh, dress code tonight is smart casual, but leaning towards casual, okay? So whatever. So some of you come up.